We move to question 4. Question 4. I wrap this, assuming we have taken it down. Okay, so we move to question 4 of the paper. Question 4 is all computation. Part A is testing taxation of insurance companies. Part B is testing VAT. So let's start with Part A. Riziki Insurance Company Limited was incorporated in the year 2019. The company deals with different classes of insurance. The following trial balance was extracted from the books of account as of 31st December 2021. So we have a trial balance balancing at 23,420,000 shillings. So it is a trial balance, meaning it has balances of assets and liabilities, it has revenues, it has expenses and all that. So it is upon us, therefore, to differentiate, separate the items that we need and only pick those that we shall use to answer the question. So we have a trial balance. Additional information 1 says, claims intimated and outstanding as of 31st December 2021 amounted to 750,000 for motor vehicle insurance and 480,000 shillings for fire insurance. So this is a question testing taxation of general insurance. Remember, the activities of an insurance company could be in the form of general insurance and life insurance. So the rule is, where an insurance company offers both general insurance and life insurance or life assurance, then the two are treated as separate businesses and they are taxed separately. So this is on general insurance. And general insurance, again, can have different classes. Like in this case, we have motor vehicle insurance and fire insurance. So let's analyze the additional information. 1 says, claims intimated and outstanding as of 31st December 2021 amounted to 750,000 for motor vehicle insurance and 480,000 shillings for fire insurance. Now, claims are almost the major expense of an insurance company. So just like in any other businesses, we can have claims outstanding at the beginning and at the end of the year. So here we have 3 figures that we shall have to adjust for each of these. We have claims outstanding, that is accrued claims brought down, that is at the beginning of the year. We have claims paid during the year and claims outstanding or accrued at the end of the year. So in short, we shall have to adjust the claims account so that we determine the figure to the income statement. 2, an earned premium is maintained at 80% and 50% of the net premiums received for motor vehicle and fire insurance respectively. An earned premium is maintained at 80% and 50% of the net premiums received for motor vehicles and fire insurance respectively. Now what do we do? In tax, the government taxes taxpayers on income earned, not necessarily what is received. So what we shall do here is simple. We shall work out the net premiums received. Net premiums received is simply total premiums received less premiums returned. In insurance business, as a company, you can receive premiums from your insured, but then because of certain reasons you may have to return. So net premiums received is simply the difference between the two. So what we shall do is simple. Determine the net premiums received, then deduct the unearned premium so that we only tax that which has been earned. 3, investment allowances have been agreed with the commissioner at 1.2 million shillings for the year ended 31st December 2021. Investment allowances have been agreed with the commissioner at 1.2 million shillings for the year ended 31st December 2021. Now, this insurance company has non-current assets, like the first item in the trial balance is property, plant and equipment at 10.2 million shillings. We know this depreciates, but for tax purposes, depreciation is a disallowable expense. Instead of depreciation, we allow for what we call capital allowances or investment allowances, which are computed at a uniform rate for all businesses. 4, so we shall allow this as an expense instead of depreciation. 4, investment income analysis. So in the trial balance, we have an item they are calling investment income, a total of 4.15 million, sorry, 4,150,500, 4,150,500. So this is the analysis. 1, we have interest received from government securities, 2,040,000 shillings net. Net here means after withholding tax has been deducted. So interest received from government securities, 2,040,000 shillings net. Now, interest income is subjected to withholding tax at the rate of 15%. So net here means this figure is 85%. Now, the next thing is, how do we treat interest income received by a company? This is a company. Now, for companies, withholding tax of 15% on interest income is not final tax. So what we shall do is simply to gross the amount given, that is get 100% of it, tax the 100%, but when computing the tax liability, we shall deduct the withholding tax of 15% already paid. Next we have interest received from local banks. Interest received from local banks, 760,500 shillings net. Net again means after withholding tax of 15% has been deducted. The treatment is the same. We shall gross the amount, tax the gross amount, deduct the withholding tax already paid when computing the tax liability. 3, we have dividend received from a Ugandan company. Dividends received from a Ugandan company. That reminds you to remember your treatment and classification of dividends. Now, this is dividend received from a Ugandan company, meaning it is a dividend income received from outside Kenya. The rule is that is an exempt dividend. So remember your classes of dividends. We have exempt dividends, qualifying and non-qualifying. So this being an exempt dividend of 450,000 shillings gross. Gross means without, or rather before any taxes. We shall leave it out as an untaxable income. We have dividend received from a local company of 900,000 shillings net. 900,000 shillings net again means after withholding tax has been deducted. For dividend income, withholding tax rate is 5%. So that means this is 95% of the figure earned. So this is dividend received from a local company. Now the correct classification is this is a qualifying dividend. So what we shall do is simple. Qualifying dividends are dividends whose withholding tax is final tax. So we shall not tax it again. We shall not tax this again because it is already net of withholding tax. 5. Fees paid to investment managers amounted to 750,000 shillings for the year ended 31st December 2021. Fees paid to investment managers. This is an allowable expense, and so we shall show it as one of such. Required: 1. Taxable income or loss for Riziki Insurance Company for the year ended 31st December 2021, and 2. Compute the tax payable, if any. So this is what we do. We say we are answering question 4A. So we show each class in a separate column. So we have motor vehicle insurance, motor vehicle insurance. We have fire insurance. Then we have total here. Then show the currency. Okay, so we start with the premiums. So if you look at the trial balance keenly, there are a number of items touching on premiums. So 1, we have gross premiums received from direct clients. So we can start with that. Gross premiums received from direct clients. So motor vehicle, we have 3 million. Fire is 2.5. The sum should be 5.5 million. Next, we have gross premiums received from agents. So gross premiums from agents. Motor vehicle is 2 million. Fire is 1.2 million. That should be 3.2 million. You can get, if you go to the trial balance again, down we have what they are calling premiums returned. That is payments that were received from clients, but paid back again. So we have motor vehicle is 800. We deduct. This is 700. A total of 1.5 million. Another thing touching on premiums is whether here up to here we can get net premiums received. Net premiums received. So net premiums received, total premiums received less what was returned. So for fire we have, this is motor vehicle, this is 5. 5 minus 8 is 4.2. So we write here 4.2 million. This is 37 minus that is 3 million, a total of 7.2 million. Then we use information 2 to work out unearned premiums. So we say less unearned premiums. That is 80 and 50% respectively. 80% for motor vehicle and 50% for fire. So we begin, we get 80% of 4.2 million. That is 3360. 3360. So up to there we can get earned premiums. So that will be 3360 from 4200. I get 840,000. We move here. 50% of 3 million is 1.5 million. Less that is 1.5 million. So total earned premium for the year will be the sum of the two. 840 plus 1.5. That should be 2340. This is 15 plus 3360. 4860. Good. Next, we add other taxable income. So we say add other taxable incomes. Add other taxable incomes. We only pick those that are taxable. So we make use of the trial balance and the additional information. One, we have what they are calling commission. Sorry, before we go to other taxable income, there's something else touching on premiums. We have what they are calling reinsurance premiums paid. That is, insurance premiums paid by this company to a reinsurance company. So we should deduct that so that we have what we call net premiums. So we say reinsurance premiums paid. So for motor vehicle it is 400. For fire it is 150. That is 550. So we get the difference again. We get net premiums. This is 440. This is 1340. 1350. 1350 plus 440 should be 1790. Up to there, we now bring in other taxable income. So say add other taxable income. So we separate the other incomes and only use those that are taxable. One, we have what they are calling in note 4 investment income. Investment income. One, we have interest from government securities. So we write here interest from government securities. So the amount is net, so we gross it. So we shall do 100 over 85 of 2040. We do that together. 100 over 85 times 4, 2040. That gives me 2400, 2.4 million. We add it here. Next we have interest from local banks. Interest from local banks. The same process, 100 over 85 times 760.5. We do it together. I get 894.71. Yes. Dividend from Ugandan company not taxable. Now in exams, if you don't make use of any item provided in the question, please explain why under your notes and assumptions. So you can say under notes and assumptions, one, that dividends from a Ugandan company is an exempt dividend, hence not taxable on Riziki Insurance Company. Again, I repeat, dividends from a Ugandan company are exempt dividends, therefore not taxable on Riziki Insurance Company. Two, dividends received from a local company are qualifying dividends because withholding taxes have already been deducted. So you can say dividends received from a local company are qualifying dividends, hence not taxed beyond withholding tax. Dividends from local company are are qualifying dividends, hence not taxable beyond withholding tax. We go to other incomes, if they are there. We have what they are calling commission on reinsurance ceded. That is a taxable income. Commission on reinsurance ceded. So that reminds you to be able to understand what we call commission on reinsurance ceded and commission on reinsurance accepted. So commission on reinsurance ceded is a taxable income. Commission on reinsurance accepted is an allowable expense. We bring it here. We say commission on reinsurance ceded. For motor vehicle, we have 700. This is 300, a total of 1 million. Any other income? We do not have any other, so we can get total income. Total income. So remember, we are asked to get total taxable income of the company. So we are basically interested in this column here. So we have 1790 plus 2400 plus 894.71 plus 1 million. That should be 6,084.71. That becomes the total income of the business. Because we are using the gross profit approach, we move to the next step and say less allowable expenses. We only use those that are allowable. So we go to the additional information 1, which is about claims. So we run claims as working 1. So I want to run working one, which is about claims. I can do it here, then we shall wrap. So working one, claims. So we run claims account. Claims account. So we start with motor vehicle. We are carrying 3 zeros. So if you look at the trial balance keenly, we have what they are calling claims outstanding as at 1st January 2021. That is accrued claims brought down. So motor vehicle, we have 1.1 million. So we write here, balance brought down 1.1 million. Then have balance carried down, information 1. Claims outstanding as of 31st December 2021 amounted to 750,000 for motor vehicles. So we write here 750. Then we debit the account with the claims paid. So we write here bank. So claims paid for motor vehicles 2770. 2770. Balance of the account. We do it together. 2770 plus 750 is 3520. 3520. Income statement, that is allowable claims, will be that minus 1100, which I get to be 2420. So that will be the allowable claims for motor vehicles. We do it for fire, claims account fire, insurance. The same procedure with the same rules. Balance brought down, that is accrued claims at the beginning of the year. For fire is 840,000. Balance carried down, that is information 1, is 480. Claims paid, bank, fire is 2110. Balance of the account, 2110 plus 480 is 2590. 2590. Income statement, that is allowable claims for fire insurance, index 840, 1750. And with that we have the allowable claims. So here we have 2420. Here we have 1750. Get the sum of the two. I get 4170. And with that we are done with the claims. We are done with this working, so we can wrap it. We move to other allowable expenses. We have information 3, which is about investment allowance. So I said those are allowable instead of depreciation. So we write here investment allowances or capital allowances, given at 1.2 million total for the year, that is. Information 4 we have talked about, that is the analysis of investment income. Information 5 is about investment managers fees paid. So investment managers fee, a total of 750,000 for both. And up to there we are done with the additional information. We go back to the trial balance and identify any other allowable expenses. So be very keen. 1, we have commission on reinsurance accepted. Commission on reinsurance accepted. For motor vehicle is 600. Fire 200, a total of 800. Next we have sundry receivables, that is a balance, not an expense. Bank balance is a balance, an asset, not an item, not an expense. We have directors fees. This is a company, so directors fees are allowable expenses. Directors fees is 495 in total. We bring it here. 195. Reinsurance premiums paid we have dealt with. Claims outstanding at the beginning of the year we have dealt with. Claims paid we have dealt with. Legal costs on claims are allowable expenses. Legal expenses on claims. Motor vehicle is 280. This is 130. 130 plus 280 should be 410. 410. Sundry expenses on motor vehicle claims are allowable expenses. Sundry expenses on motor vehicle claims, a total of 220. Nil for fire, so total is 220. Management expenses are allowable expenses. So management expenses. Motor vehicle 450, 380. That should be 830. Investment income we have dealt with. Premiums returned we have dealt with. Profit and loss account is a balance, not an income, not an expense. So up to there, we can now get taxable income. So taxable income will simply be total income less total allowable expenses. So there are two ways of doing it. You can either deduct each of these from the total income. So that would mean we bracket each of them, or we can get total allowable expenses, have it here, then we deduct it from our total income. So let's use the first method. Good. So this is what we are interested in. So we get total taxable income. Be very keen. So taxable income is total income less allowable expenses. So we have 84.71 less, we are here, 4170, 1200, 750, 800, 495, 410, 220 and 830. 830. I have 279, 2790, 2790.29, but negative. So in short, this company realized a loss during the year 2021. So that is part A, Roman 1. Part A, Roman 2 is asking, compute the tax payable, if any. Tax payable, if any. Now, tax is imposed on income. And for a business firm, income is basically profit. So because this particular firm made a loss or realized a loss in this particular year, it is not liable to any tax. So we simply give an explanation for that. So we say part 2, you can write, Riziki Insurance Company Limited is not liable for taxation for the year 2021 because it realized a loss and not a profit. So the company is not liable for taxation in the year 2021 because it realized a loss and not a profit. Then you can go ahead and say tax is imposed on incomes or profit, that is for business purposes. Tax is imposed on income, in bracket profits, but not losses. Yes, so that explains why for this particular year, this company would not have to pay any corporation taxes. And that marks the end of part A of question 4. The topic being tested here is advanced taxation of business income, that is advanced aspects of taxation of business income. The topic is a must in the exam, and in each paper you'll meet at least 2 questions from that particular topic. So be very keen and make sure you understand every bit of it. With that, I want us to move to part B of question 4. Let me wrap this. Part B of question 4. Now, part B of question 4 is a mathematical question again, testing VAT. So that reminds you to have VAT at your fingertips. Know the theory around VAT, it's so much, and then know how to compute VAT and the applicable rules. So I read, be very keen. Zawadi Associates provides consultancy services to various clients whose terms of contract allow clients to pay for the services either before or after the provision of the service. The following information is provided regarding the firm's transactions for the months of October, November, and December in the year 2021. The following information is provided regarding the firm's transactions for the months of October, November, and December in the year 2021. So we have a table of 4 columns. The first column is the nature of the service or transaction. Second column is value of the transaction. The third column is service provision date. And then the last column is payment date. So we have a number of transactions and then all those details. Additional information 1. Silock Investments was declared bankrupt on 30th November 2021. Now, Silock Investment was one of the customers, one of the clients, and we are told it was declared bankrupt on 30th November 2021. Let's look at the table and understand what happened in that transaction. So, the transaction was management consultancy to Silock Investment. The value of the service was 1,440,000. The service provision date was 13th November 2021. Payment date was 40% paid on 30th November 2021. 40% paid on 13th November, meaning 40% of the amount was paid on the service delivery date, and the rest was to be paid later. Then come to information 1. This client was declared bankrupt on 30th November. What does that mean? If a debtor is declared bankrupt, it means you cannot recover the debt from them. So it means you have to write it off. And that means you'll have to, it will reduce the amount of VAT you will collect from this debtor. So what we do is simple. We shall show this as a transaction, yes, but it will be a reduction under output tax. 2. On 5th November 2021, Zawadi Associates renewed its National Industrial Training License for 30,000 shillings and paid for legal fees of 360,000 shillings to follow up on clients who were not paying as per the agreed date. So it had 2 transactions. One was renewal of industrial training license fee at 30,000. Then 2, it incurred a legal fee of 360,000 to follow up on clients who are not complying with the terms of the contract. So we have to determine if these are vertible or non-vertible items. Now, renewal of industrial trading license fee is not, renewal of national industrial trading license is not a vertible item. So yes, this is an expense, but it will not attract VAT. Legal fees are professional services, and so they will attract VAT. 3. Electricity bill paid on 10th November 2021 was 270,000, out of which 100,000 shillings was payment for outstanding bill for October 2021, and 20,000 shillings was in respect of additional deposit as demanded by the power company. So let's get it keenly. Total amount paid was 270,000 on 10th November. 100,000 out of that was payment for October, and then 20,000 was a deposit for the following month. Now, what does that mean? It means, in short, not the entire 270,000 was relating to November. So what we shall do is simple. We are going to explain what we call tax point, and in this case we shall have to split this 270,000 for 3 months. 100,000 for October, 20,000 for December or after November. Then the difference, that is 270,000 minus 100 minus 20, that should be 270 minus 120, which is 150, is the amount relating to November. Good. For fuel consumed for partners' vehicles amounted to 90,000 during the month of November 2021. Fuel is a vertible expense, and so we shall charge VAT on that. So we are told it was 90,000, and we are told it was for partners' vehicles. So this means it was for business purposes. Remember, one of the rules in VAT is you can only claim input tax on business expenses or business items, but not private or personal expenses. Computers purchased for business use cost 240,000 in November 2021. Again, this is for business, and so it will attract VAT. Zawadi Associates paid rent for the month of November 2021 amounting to 180,000 on 5th November 2021. Zawadi Associates paid rent for the month of November 2021 amounting to 180,000 on 5th November 2021. Now, rent is not a vertible item, so we can show it, yes, under input tax, but the rate will be nil. It is an exempt item. 7. Transactions have been stated inclusive of VAT at the rate of 16% where applicable, unless otherwise stated. Now, when computing VAT, the figures given may be inclusive of VAT, to mean the figures already have the VAT amounts within them. So that means if the VAT rate is 16%, then the figures are at 116%. So in that case, be very keen. The VAT rate applicable will be 16 out of 116. So this is where the figures are given inclusive. But where the figures given are exclusive of VAT, it means they do not have the VAT amounts within them. So the figures are around 100%. So it means the VAT rate will be 16%. So this is exclusive. Be very keen on that. Many students confuse the two and they end up with wrong figures, and that makes them fail. Required. 1. Compute the VAT payable by or refundable to Zawadi Associates for the month of November 2021. November 2021. So remember, we have transactions affecting, or rather touching on October, November, and December. So the question is, compute the VAT payable or refundable to Zawadi Associates for the month of November 2021. Now, this means we have to understand something called tax point. Now, tax point in simple terms is simply the date or the time when VAT is deemed due and payable. The date or time when VAT is deemed due and payable. Now, for local supply, that is for transactions within the country, tax point is the earliest of 4 dates. The earliest to mean that which comes first. 1, the date the services are supplied or the products are supplied or sold. 2, the date when the date when an invoice is issued or received. 3, the date payment is made for part or full settlement of the transaction. And 4, the date a certificate is received. That is in case of transactions requiring supervision, like in constructions where an architect certificate has to be issued and all that. So what we do is simple. Look at each and every transaction, locate the tax point, and if the tax point is November, then we shall capture that transaction in November. If it is not in November, we shall leave it out, because the question is, we compute the VAT payable, refundable for the month of November. So let me use the first transaction for example. The first transaction was audit services to XL Supermarkets. Audit services to XL Supermarkets. Value of service was 700,000. Service provision date 25th October 2021. Payment date was 5th November 2021. So you can see the service was provided on 25th October, but then the payment was on 5th November. So what does that mean? This transaction should be captured for VAT purposes in the month of October, but not November. So what we do is simple: analyze each transaction, then locate the tax point. If it is within November, capture it under November. We answer that. So this is question 4B. So we say Zawadi Associates value added tax computation for the month of November, for the month of November 2021. So we start with output tax. Output tax is the VAT on sales. Output tax. We arrange it like this. We have date, we have details, we have gross amount in shillings, VAT rate, then VAT amount in shillings. So remember, we have to determine the tax point. So transaction 1 was audit services to XL supermarkets. The service provision date 25th October. Payment date is 5th November. So that was captured in October. We don't bring it under November. Next we have training services to Kyle Securities, provided on 3rd November and not yet paid for. So that means the tax point is November. So we write here 2021 November. So the date was November 3rd. The customer was Kyle Securities. The value of the transaction was 240,000. And we are told this is inclusive of VAT. So that means the VAT rate is that 16 out of 116. So we do 16 out of 116 times 240,000. I get 33,103. Sorry, 33,000. Sorry, 16 out of 116 times 240,000. 33,103.45. Next, accountancy services to a total children's home on 5th December 2021, the service provision date. Payment date was 20th November. So November comes before December. So tax point is November 20th. Watoto Children's Home. Watoto Children's Home. Now Watoto Children's Home is, the value is 600,000. This is a service provision to an NPO, a non-profit making organization. So for such, it is nil. That is nil. Debt collection services to Zoella Computers. Service provision date 9th November. Payment date 30th November. So again, this is a November transaction. We take November 9th. That is Zoella Computers. Zoella Computers. 820,000. 16 out of 116. 16 out of 116. 820,000. I get 113, 103.45 again. Next we have strategic plan development to Bazo, that is Rwanda Limited. So the company is in Rwanda. So what does that mean? This was an exported service. For exports, we know VAT rate is nil, 0%. So we write here, the service provision date was 10th November, not yet paid for. So it means it is a November transaction. So we say Bazo in bracket Rwanda Limited. The amount is 2,150,000. The rate is 0%, meaning the amount is 0. We have management consultancy to Siloc Investment, service provision date 13th November, 40% paid on 13th November, the rest not yet paid, meaning it is a November transaction. The tax point is in November, that is. So we write here Siloc Investments, 1440,000, 16 out of 116, 16 out of 116 times 1440,000. I get 198 620.69, 620.69. Lastly, we have financial consultancy to before that we have internal controls reviewed of Lema Limited, value 960,000, service provision date 18th November, but then payment date was 7th October. So it means the payment came before the service provision date. So that means the tax point is in October. So we don't capture that in November. Lastly, we have financial consultancy to W Limited. Service provision date 20th November. Payment date 1st December. So we pick 20th November. So we say W Limited. 1.2 million. 16 out of 116. 16 out of 116 times 1.2 million. 165,000 517.24. Then we have information 1, that is Siloc investment being declared bankrupt on 30th November. So that will reduce the VAT from that in client. So let's understand it. When the service was provided on 13th November, 40% of the amount was paid. That is 40% of 1440,000. Then the rest was not yet paid. And this is on 30th November. So we are not losing the entire amount. What we are losing is simply the VAT on 60% of 1.44 million. So that is what we need. So 60% of 144 million, I get to be 864,000. We should deduct times 16 out of 116. I get 119, 172.24. We deduct because it was a loss, a bankrupt issue. All the rest are transactions affecting input tax. So up to here we get what we call total input tax. Total output tax. That is total VAT on sales. We be very keen. 33,103.45. 113, 103.45. 198, 620.69. 165, 517.24 less 119, 172.24. I get 391, 172.59. That gives me total output tax. That is step 1. Step 2 is to get out input tax, that is the VAT on purchases and expenses. The same arrangement, so but we are getting input tax. So we are going to follow the same procedure, but now we are looking at expenses and purchases. Again, we must be keen on which expenses and purchases attract VAT, which ones do not. So I move to information 2, which is about renewal of National Industrial Training License at 30,000 and then legal fees of 60,000 paid on 5th November. So I come here, write 5th November. One, we have National Trade Industrial Training License at 30,000. That does not attract VAT, so the VAT rate is nil. Still on the same date, there was legal fees incurred or paid of 360,000. Legal services are professional services attracting VAT, so 16 after 116 times 360,000 should be 49,655.17. Information 3 is electricity paid on 10th November. So we write here electricity, but we have to break down the figure. Total amount paid was 270,000. 100,000 out of that was for October, then 20,000 was a prepayment for December, meaning the amount relating to November is only 150,000. So write that. Electricity is a variable expense, so we charge. So 16 after 116 times 150,000. I'm getting 20,689.66. 4, we have fuel for the partners' vehicles at 90,000 paid in November. So we can write here 10 fuel. That is at 90,000. Fuel is a petroleum product. Petroleum products attract VAT currently at 8%. So if this is inclusive of VAT, it means it will be 8 out of 108. So we shall have 8 out of 108 times 90,000. That is 6,666.67. Then we have computers purchased in November at 240,000 for business purposes. So computers 240,000 for business purposes. I am getting 33,103.45. Note 6. Zawadi Associates paid rent for the month of November amounting to 180,000 on 5th November. So rent is not a variable expense. The amount was 180,000. The rate is nil. The amount is nil. Transactions have been stated inclusive of VAT. So up to here we get total input tax. Total input tax. The sum of all that 49,655.17 plus 2,689.66 plus 666.67 plus 33,103.45. I get 110 114.95. That is total input tax. The next step now is to compute VAT payable or refundable. Now in this case, this trader had both taxable supplies and non-taxable supplies. So what we do therefore is to restrict the deductible input tax. So we say VAT payable or refundable is equals to output tax less deductible input tax. Deductible input tax is equals to taxable supplies divided by total supplies times input tax. Taxable supplies are simply those supplies attracting VAT, that is, sales at standard rate and sales at zero rate. Total supplies will be taxable supplies plus now the exempt sales, or those sales attracting VAT at nil rate. So we go back to our output tax table. So if you are keen, we have supplies attracting VAT at standard rate, those at nil rate and those at zero rate. So to get the numerator here, this figure here, we add all the transactions attracting VAT at nil rate, at zero rate and at standard rate. So look at the table keenly. We pick everything, that is the gross amount for every transaction, except those attracting VAT at nil rate. So if you are keen, if you are there, we have the list. There is one transaction attracting VAT at nil rate, that is the supply to Watoto Children's Home, which I said is an NPO. So it means we get the sum of everything except that 600,000. So do it with me. We have 240,000 plus 820,000 plus 2150,000 plus 1440,000 plus 1.2 million, then minus 864,000, that is the budget written off. So I get 4986,000. So we say this is equals to 4986,000. To get the numerator, simply add exempt transactions to that figure. And in our case, we only have one of 600,000. To that figure, we add 600,000. I get 86,000 times input tax. Input tax is here, 114.95. So we get it together. So we have 4986,000 divided by 5586,000 times 114.95. I get 98,287.35. Therefore we say VAT payable, it is VAT payable where the total output tax, our total output tax we got to be 391,152, is more than the deductible input tax, which is 98,287. Where it is the other way around, it becomes VAT payable, so it's VAT refundable. So we say therefore VAT payable will be equal to 391,152.12 minus 98,287.35. We do that. So 391,152.12 minus 98,287.35 287.35. I get 292,864.77, and that becomes the VAT payable for this particular month of November 2021 by this firm. And that marks the end of question B, part 1. We move to part B, Roman 2 of the question. It says, Zawadi Associates is planning to engage a firm of financial management consultants from South Africa to facilitate online training on financial management assignments. Zawadi Associates is planning to engage a firm of financial management consultants from South Africa to facilitate online training on financial management assignments. Advise Zawadi Associates on the tax point in respect of such services. Advise Zawadi Associates on the tax point in respect of such services. This is again touching on what we have been talking about. Now, in this case, this company is planning to engage a firm of consultants from South Africa. So what does that mean? It means, in short, it will be importing this particular service from South Africa. Now, the rule is that for imported products, that is for imported goods and services, tax point is the earliest of 3 dates. Earliest of 3 days. Number 1 is the date when the service is provided. 2, the date when payment is made in full or part settlement for the contract. And 3 is the date when the invoice is issued. So, in short, you can say tax point for imported services is the earliest of the following 3 dates. Tax point for imported services or products is the earliest of the following 3 days. 1, the date when the services are rendered or provided. 2, the date when an invoice is received. And 3, the date when payment is made in full or part settlement for the contract. So in short, for Zawadi Associates, the tax one, that is the date when they have to account for that particular transaction under VAT, will be earliest of those 3 particular days. And that earns you the 3 marks awarded there. And that marks the end of question 4. Yes. Again, that reminds you that VAT is a very common exam area. Be very familiar with it, know the theory part of it and the computation part of it. The rules as well around VAT computation. A very important part is to know the classification of supplies. We know not all supplies are VATable, so we should know which supplies are VATable at standard rate, which ones are VATable at 0 rate, and which ones are VATable at which ones are exempt supplies. Yes, and that is it.
Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Lingwiri and I practice within the financial services industry in Kenya. Today, ladies and gentlemen, we are going to learn about portfolio management. The focus will be on contemporary issues and emerging trends. We are going to narrow down our discussion towards case studies on application of portfolio management. I will read out to you case studies and provide for you some multiple choices, and then we can be able to try and answer together. So, first question reads as follows. Jane Smith has an investment portfolio of $5 million. She is 68 years old, retired, and has no children. After her death, she wishes to leave her portfolio to a local art museum that has given her relatively free access to art exhibits over the past decade. Her health is better than average, and she maintains an active lifestyle consisting of frequent swimming, biking, and playing tennis with friends at her country club. Smith estimates that to maintain her standard of living, she needs approximately $250,000 per year. Expenses are expected to grow at an expected inflation rate of 2%. She states that as a retiree, her tolerance for risk is below average. Smith has come to you for assistance in investing her assets. So the questions I pose to you are right down there, ladies and gentlemen. Smith's return objective is closest to A, 3%, B, 5%, and C, 7%. Number 2, Smith's ability to take risk is most appropriately characterized as A, below average, B, average, C, significantly above average. Number 3, in terms of Smith's time horizon and liquidity constraints, Smith most likely has A, active investment strategy, B, risk controlled active investment strategy, C, enhanced index strategy. So ladies and gentlemen, we start by solving part A. And you can see there I have actually summarized to you on the screen. Smith states that she needs $250,000 annually to maintain her standard of living. This amount of annual expenditure represents what proportion? The proportion is 5%. How do we get the 5%? We get 250,000, which maintains her living standards, and we divide by the 5 million, which is part of the investment of her investment portfolio. Accounting for expected increase in expenses at the anticipated level of inflation indicates a return objective of 7%. How do we get 7%? We get the 5% as indicated as the annual expenditure amount, which is 5% of the total portfolio value, and then we adjust that for expected inflation, which amounts to 2%. So adding them up together, 5% plus 2% gives us 7%. So in this case, our option that we are going to select is option C, which gives us 7%. Part 2, we're being asked, Smith's ability to take risk is most appropriately characterized as. So we are saying that although her stated willingness to take risk is below average, the size of her portfolio, her good health, and relatively long time horizon indicate an ability to take average risk. But as a retiree, ladies and gentlemen, sensitivity to substantial declines in portfolio value is probably a concern. So even if it is said that she states that as a retiree her tolerance for risk is below average, we are saying that her ability to take up risk is average. And in this case, we are saying the answer to select is B. The third question is saying, in terms of Smith's time horizon and liquidity constraint, Smith most likely has, we are saying that barring any unexpected health related costs in terms of going to hospital and the rest, the inflation adjusted income needed will probably not change dramatically. Smith's concern for liquidity primarily relates to unusual cash flows. For example, healthcare costs, emergency spending, and so forth. That might take place during her retirement years, and hence she has no significant liquidity constraints at the moment. Smith has essentially a long-term time horizon for her portfolio until the end of her life, which could be another 20 or so years. So in this case, we select option C, a long-term time horizon and no significant liquidity constraints. So ladies and gentlemen, we can move forward to the next question. The next question is on your screen and it reads as follows. Joe Firmingham is a 38-year-old, married, and has 2 children, ages 12 and 7. He recently received an inheritance of $300,000 and is considering real money for the first time. Firmingham likes to read the financial press and indicates that if he had money to invest in the past, he could have taken advantage of some undervalued security opportunities. Firmingham believes he has an average tolerance for risk-taking in investment activities, but he also enjoys skydiving every other weekend. The questions that are posed to you right down are indicated to you right down there. Firmingham's ability to take risk is most appropriately characterized as A, below average, B, above average, B, average, and C, above average. The next question is asking the most appropriate investment strategy for Firmingham to take advantage of his stated propensity for finding undervalued investment is A, active investment strategy, B, risk control active investment strategy, and C, enhanced index strategy. Firmingham, so the next question over there, or in trying to answer that question right there for you guys, we are saying that in Joe's case, the first question is asking Firmingham's ability to take risk is most appropriately characterized as, we can say, or we can see from the question, that Firmingham appears to have the ability and willingness to take risk. He frequently enjoys risk-seeking activities such as skydiving. His relatively young age indicates a somewhat long time horizon for his investment portfolio. These facts couple ability and willingness to take an above average level of risk. So in this case, ladies and gentlemen, we can say that Firmingham's ability to take risk is most appropriately characterized as above average. The next question posed was the most appropriate investment strategy for Firmingham to take advantage of his stated propensity for finding undervalued investments is, we are saying that Firmingham indicates from the question that he follows the financial press, and has spotted what he considered to be undervalued securities. This activity indicates that Firmingham pays attention to security valuation issues and that he probably will do so in the future. His portfolio, therefore, should follow an active investment strategy. And in this case, that is option A. So, ladies and gentlemen, this brings us to the end of case studies on application of portfolio management. If there are other case studies that you would be able to present through the portal or the comment section right there on Manifested Publishers website, please feel free to post them on the comment section of the Manifested Publishers website, and we will be glad to answer them. Thank you for being with Manifested Publishers, and God bless you.
Welcome to the lesson. Candidates, the subject is Advanced Auditing and Assurance. We are answering questions that were tested in August 2024. We've so far done question 1 up to question 3. Today we are moving to question number 4. Part 4A reads, Auditor independence is part of the foundation of the auditing profession. An independent, reliable, and ethically sound audit gives a company credibility and allows the public to trust in the accuracy of the results and the integrity of the accounting profession. With reference to the Institute of Certified Public Accountants of Kenya Ethical Guidelines, justify 5 reasons why professional independence is considered important to the auditor. With reference to the Institute of Certified Public Accountants of Kenya Ethical Guidelines, justify 5 reasons why professional independence is considered important to the auditor. Importance. Reasons for the importance. That's a question. August 2024, question 4. A. Reasons for the importance of the auditor's independence. Now, the auditor is required to be independent, meaning that he should not be influenced by anyone. He should be free from any undue influence from the management, from the any source. He's supposed to be objective, independent, make decisions without any influence. So what do you think, candidates? So what do you think? What are the reasons for the importance of auditors' independence? Auditors' independence. Auditors' independence, candidates have said, is a freedom and the objectivity of an auditor to carry out their work without any undue influence or conflicts of interest. It means that the auditor can make impartial judgments and decisions without being swayed by personal, professional, or financial considerations. The question is, what are the reasons for the importance of the auditor's independence? The auditor is required to be free to carry out his work without undue influence, without conflicts of interest. He should be impartial and should not be swayed by financial considerations, professional or personal considerations. The auditor should ensure that he has no blood relations with the management team, because that can compromise his independence. The auditor should ensure that he has no financial interest in the company that he is auditing, because again that can influence his judgment, that can make him that can influence the way he makes decisions. So he should ensure that he does not find himself in a situation where he is not impartial. Any considerations, anything that will hinder his objectivity and independence, he is supposed to ensure that he is free from such. So what do you think that is important? And if you read the root, candidates, the root says, or the question, auditor independence is part of the foundation of the auditing profession. An independent, reliable, and ethically sound audit gives a company credibility and allows the public to trust the accuracy of the results and the integrity of the accounting information. So see, right there, candidates, you can get a point. Public trust and confidence. An independent auditor provides assurance that the financial statements are reliable and free from material misstatements, and that enhances public trust in the financial statements or financial reporting process and the capital markets. So one reason for the importance of the auditor's independence is in relation to public trust. When the auditor is independent, that boosts the trust of the public, that boosts the confidence of the public in the reliability and even credibility of the financial statements or financial reporting process. It enhances public trust. When the public know that the auditor is impartial. The auditor does not have financial interest in the company. The auditor is free to do his work. That boosts public confidence and trust. Now, looking at the route again, candidates, we are reading here things like an independent, reliable, and ethically sound audit gives a company credibility and allows the public of the blah 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 blah. So another reason for the importance of the auditor's independence is in relation to objectivity. Objectivity and impartiality. There's no way an auditor can be impartial without being, first of all, independent. Independence allows auditors to maintain objectivity and impartiality in their judgment so that they can assess financial information without bias or without undue influence from the client. Do you understand? Impartial. Impartiality. The auditor can only be impartial if he is independent. So that's one reason for the auditor's independence, because in examining financial statements, the auditor is required to be objective. The auditor should be objective. The auditor should maintain objectivity. The auditor should make judgment without any bias. That can only happen if the auditor is independent. 3, independence is also important due to what we call professional skepticism. Because you know, being skeptical from the auditing point of view means having a questioning mind. An independent mindset, candidates, fosters a questioning attitude which enables auditors to critically evaluate evidence and identify potential risks and errors. We know that the auditor should not believe all the information that is provided by the client. The auditor should seek to gather corroborative evidence, and that can only happen if he is independent. But when the auditor's independence is threatened, then the auditor may not maintain professional skepticism. The auditor may not have an independent mind, because you see, he will be in a position that will hinder such or threaten his independence. So another reason for the importance of the auditor's independence is professional skepticism, fostering a questioning mind. The auditor can only maintain a questioning mind if he is independent. 4, unbiased decision making. Unbiased decision making is the reason for the importance of the auditor's independence. Independence ensures that the auditors can make unbiased decisions without fear of repercussions or without any pressure from the client. 5 is also, another reason is to maintain what we call professional reputation. Maintaining professional reputation. To maintain professional reputation. You can see here we've read that an auditor's independence is part of the foundation of the auditing profession. You see that? Auditor independence is part of the foundation of the auditing profession, because independent auditors are required to uphold the integrity of the accounting profession by avoiding conflicts of interest and also adhering to ethical standards. And that contributes to the overall reputation of the profession. So these are 5 reasons for the importance of the auditor's independence. 1, public trust. 2, objectivity and impartiality. 3, professional skepticism. 4, unbiased decision making. 5, maintaining professional reputation. Have you understood? An independent, reliable, and ethically sound auditor gives a company credibility and allows the public to trust in the accuracy of the results and the integrity of the accounting profession. So part of the ISPAC ethical guidelines is the auditor's independence. The ISPAC guidelines require the auditor to maintain independence, to be independent. The auditor is required by ethical standards to be independent, to be free, and to have objectivity in carrying out their work without any undue influence or conflicts of interest. Auditors are also required to make impartial judgments and also make decisions without being swayed by personal, professional, or financial considerations. So that is part A of question 4. Part B reads, you are a senior auditor in the audit of Jasiri Limited, a medium-sized manufacturing company. The audit of the financial statements for the year ended 30th June 2024 is almost complete, and you are reviewing the audit files for the period. The following issues have prompted the senior auditor to call for a meeting with the client's top management to be held in a week's time. Now, currently, you see there is a problem with the structuring of the question, because you see in the first sentence you are reading from the question that you are a senior auditor. Then in the third sentence you are reading that the following issues have prompted the senior auditor. The question should have read that you have called a meeting. So when the question continues, then the focus is on this senior auditor. So the question cannot now read the following issues have prompted the senior auditor, because the question here is addressing the candidate. The one who is sitting the exam should put his shoes in the legs in the shoes, or he should put himself in the shoes of the senior auditor. So the question would have read, you are a senior auditor in the audit of Jasiri Limited, a medium-sized manufacturing company. The audit of the financial statements for the year ended 30th June 2024 is almost complete, and you are reviewing the audit files. You are reviewing the audit files for the period. You have called a meeting with the client's top management to be held in a week's time. The following issues have prompted the senior auditor. Okay, so you have called a meeting with the client. So the following issues are: number 1, there were questions concerning the accuracy of the depreciation charged in the financial statements, and a preliminary investigation revealed that the computerized accounting system had failed to compute depreciation of equipment correctly, resulting to an overstatement of the depreciation value of 780,975. The book value of the equipment had been overstated by 1,128,340 shillings. The equipment value for the year ended 30th June 2024 was 7,135,725. So that's the first issue. The second issue, at the beginning of the year 2024, the company had issued a loan to Sarah Hagoi, one of the members of the top management, amounting to $500,000. On further examination of the records, it was discovered that the loan had not been disclosed in the financial statements because it was considered immaterial. 3. During the year ended 30th June 2024, the company made a reduction on its provision for customer warranties recognized in the financial statements. During the past 2 years, the provision has been made at the rate of 10% of sales for 3 months. The management has, however, decided to reduce it to 5% on the claims that the quality assurance processes had improved, and therefore customer warranty claims were likely to reduce. Further investigations, however, revealed that warranty claims have by far remained the same as in the previous periods. So these are 3 matters required. Discuss how the auditor would be expected to treat each scenario mentioned above for the purpose of reporting. The question should have read, discuss how you would be, or discuss how you would treat. You should have read, discuss how you would treat each scenario mentioned above for the purpose of reporting. Discuss how you, and you here is the senior auditor. You are the senior auditor. As the senior auditor, discuss how you would treat each scenario mentioned above for the purpose of reporting. Number 2, propose how you would treat each scenario mentioned above in the auditor's report, assuming the management of the Limited does not correct the misstatements. 6 marks. So there are 3 issues. There are 3 issues. Kasneb Limited is experiencing, no, that is a different issue. The first issue, there were questions. First of all, candidates, you can see that we read that the audit of the financial statements for the year ended is almost complete. So the report is yet to be finalized. So the audit is almost complete. So when the report is almost complete, you see the supervisor, the audit supervisor has done his work, and so is the report, the working papers now are on the desk of the senior auditor. And as a senior auditor, you are reviewing the audit files for the period. And there are issues that have come to attention as you are reviewing the audit files. So these issues have prompted you to call for a meeting with the client's top management. And you can see one of the issues. Number 1, there were questions concerning the accuracy of the depreciation charge in the financial statements. Depreciation charged in the financial statements. There were issues. There were questions. And a preliminary investigation revealed that this is investigation maybe carried out by the audit staff, revealed that the computerized accounting system had failed to compute the depreciation of equipment correctly, resulting to an overstatement of the depreciation value. So the depreciation value is overstated by 780,975. The book value of the equipment had been overstated by 1,128,340. So you can see there, candidates, that the depreciation charge is overstated. The book value is as well overstated. The equipment value for the year ended 30th was 7 million. So this is a problem, and the question now is, discuss how the senior auditor, you as the senior auditor, would treat this scenario for the purpose of reporting. So that is the question. How would you treat this matter? And you recall the stage at which the audit is at the stage of just reviewing the audit files. Because candidates, we know that the overstatement of depreciation and the resulting overstatement of the net book value of the equipment could impact the financial statements accuracy. That will affect the accuracy of the financial statements, obviously, because depreciation directly affects both the profit and the net asset value. B. We're answering part B. Part B, Roman 1. The auditor, obviously, candidate should assess the accuracy. The auditor has to assess the accuracy of the depreciation figures to ensure that the financial statements reflect the true and fair view of the asset value. So the first thing the auditor can do here is to identify the misstatement. Identify the misstatement. Identify the misstatement. The auditor should first of all identify the misstatement. Clearly identify the overstated depreciation and the overstated book value of the equipment. Identify it. Then, after identify, the auditor should assess the materiality of the misstatement, because the depreciation charge is overstated, the net book value of the equipment is overstated. So after identify the misstatement, the auditor should assess the materiality of the misstatement. The auditor should determine whether the misstatement is material to the financial statements. And the auditor ought to consider both the qualitative and quantitative factors. Is the misstatement material or is it immaterial? After assessing the materiality of the misstatement, then the auditor obviously should consider the impact on the financial statements. Consider the impact of the misstatement on the financial statements. Because as I said, this misstatement of depreciation charge and the misstatement of the net book value of the equipment affects both the profit and loss account and the balance sheet. So the auditor, after assessing the materiality of the misstatement, should consider the impact of the materiality in the financial statements. That is, if it's material, then what is the impact of this material of this misstatement on the financial statements? Consider the impact. evaluate the impact on the income statement because an expense is overstated, and the impact of the overstatement of the net book value of the asset on the balance sheet. Another step, another thing to do is to discuss with the management, just as the question has suggested. Discuss with the management and request appropriate adjustment. Discuss with management and request appropriate adjustment. Because you recall, candidates, the audit report has not been issued. The audit is being finalized. So this one matter has come to the attention of the senior auditor. So before the auditor makes any opinion on the matter or the problem, because obviously it's a problem, is it not? So the auditor should, after meeting, because here we are you are seeing that we read that the following issues have prompted the senior auditor to call for a meeting with the client's top management to be held in a week's time. So within this week's time, the auditor should identify the misstatement, assess the materiality, consider the impact on the financial statements. Then the auditor, as he meets the management, should discuss this problem with the management and request for appropriate adjustment of the problem on the overstatement of the depreciation charge and the overstatement of the net book value of the equipment. Then Roman 2, Part 2, the second issue, reads, at the beginning of the year 2024, the company had issued a loan to Sarah Hagoi, one of the members of the top management, amounting to 500,000 shillings. On further examination of the records, it was discovered that the loan had not been disclosed in the financial statements because it was considered immaterial. So what do you think, candidates? And by now you should be ringing in your head is related party. The loan has been given to one of the members of the top management. A member of top management is a related party. Money is being given to a top management member. That is a related party. So that is what the examiner expects you to, first of all, acknowledge. So the auditor has to consider the implications of the undisclosed loan to Sarah Hagoi, who is a top management member. And we know the provisions, candidates of International Accounting Standards, is it number 24? Related party disclosures. The standard, that is IAS 24, related party disclosures, requires loans to key management to be disclosed in the financial statements, regardless of materiality. But here, because you see, we read that on further examination of the records, it was discovered that the loan had not been disclosed in the financial statements because it was considered immaterial, small money. So that's why it is not disclosed. But what does the standard state? According to IAS 24, loans to the top management, loans to key management members require disclosure in the financial statements, regardless of materiality, because they reflect potential conflicts of interest and affect the user's perception of the management's accountability. But that's just an observation, candidates. The question is, how would you treat that scenario? This is the second scenario. This is an undisclosed loan. Undisclosed loan to a member of the management team. So number one, assess materiality. Why candidates? Because we read from this question that on further examination of the records, it was discovered that the loan had not been disclosed in the financial statement because it was considered material. That is what the management stated. But you see, professional skepticism requires that you do not take such information as gospel truth. You are supposed to have a question in mind. Any information that you get from the client, you have to question it. You have to approach it with an element of healthy doubt. You have to doubt it. That's why, as much as on investigation we are told that the loan was considered immaterial, you are safe to assess materiality. Determine whether the loan is material to the financial statements, considering both quantitative and qualitative factors. That's the first thing to do. Number two, consider related party disclosures. Consider related party disclosures. Consider related party disclosures. That is to mean, evaluate if the loan meets the definition of related party transactions and if adequate disclosures are required. Then, of course, you may discuss the non-disclosure with management and request appropriate adjustments. Request appropriate adjustment. All right. Request appropriate adjustment. You see how easy these questions are? There are many ways, there are many points, there are many ways you can put across the way you would treat it. But you see, the assumption also could have been that the loan was approved. You see, the issue at hand is the disclosure, the non-disclosure. Because related party transactions are not prohibited. What is required is disclosure. Do you get the point? So the loan was given, but there was not disclosed. On further investigation, we are told that the loan was not disclosed because it was considered immaterial. But we know, according to the standard IAS 2024, the disclosure is required regardless of the materiality. So that is the second problem. Now the third problem, during the year ended 30th June 2024, the company made a reduction on its provision for customer warranties recognized in the financial statements. During the past 2 years, the provision has been made at the rate of 10% of sales for 3 months. During the past 2 years. The management has, however, decided to reduce it to 5%. Do you see that? It has gone down from 10% to 5% on the claims that the quality assurance processes had improved and therefore customer warranty claims were likely to reduce. Further investigations, however, revealed that warranty claims have by far remained the same as in the previous periods. Now, first of all, candidates, what is a warranty provision? The company made a reduction in provision for customer warranties. Now here you need to understand, candidates, that a warranty provision is just an accounting entry that sets aside funds to cover potential costs associated with the product warranties. Because when a company sells a product with a warranty, it is essentially promising to repair or even replace the product if it fails within a specific time frame. Do you see that? And we've seen, not some of you have bought items from, say, the supermarket. You buy electronics from the supermarket, like the iron, there is the electronic devices, refrigerators. They come with warranties, 1 year, 2 years. That means if the customer is unable to use that product within a given time because of failure, or the product requires repairs, then that means that the supermarket or the company is promising through this warranty to repair it or to replace it. Do you understand? So to account for the future expense, because the company is promising in future to replace or to repair, so the company has to set aside some money through the provision for the warranty. The company creates a warranty provision. Do you understand? So during the year ended 30th June 2024, the company made a reduction. So it's reducing the provision. Okay. During the past 2 years, the provision has been made at 10%. Now it is reducing from 10 to 5. And the reason is the company is arguing that quality assurance processes had improved, and therefore customer warranty claims were likely to reduce because they have improved on the quality. But you see, further investigations reveal that the warranty claims have by far remained the same. That's the problem. That is the problem. So a warranty provision is just a provision. It may be like the provision depreciation. When a company creates a provision for depreciation, a company sets aside money every year. Okay, as the asset wears out, puts aside money until the end of the economic life of the asset, when the money that is set aside is now used to replace that asset. You understand? But that's the idea. So, and that is a problem. We've seen the problem. So the question now is, how would you treat this scenario, this problem? Can I hear from you? Reduction in warranty provision. Roman 3. Reduction in warranty provision. And you see, this is reduced from 10 to 5 under statement of liabilities, because you see that provision is a liability. So if the company is halving, it's reducing by half from 10% to 5%, that means that the company is understating the its liabilities in relation to these warranties by half. It will lead to understatement of liabilities. And that is dangerous, candidates. So, what is the first thing to do? Assess the reasonableness of the provision. The auditor should assess the reasonableness of the provision. Should assess the reasonableness of the provision. The auditor should evaluate whether the management's rationale for reducing the provision is supported by evidence and sound judgment. The auditor may also consider the impact on future periods. Consider the impact on future periods. Consider the impact of this reduction on future periods. The auditor should assess the potential impact of the reduced provision on future periods, especially if actual warranty claims remain high. And here, candidates, the actual, according to the information we read from the question, actual claims will remain high. It's not that what we read is likely to remain high. Why? The management has, however, decided to reduce to 5% on claims that the quality assurance processes had improved, and therefore warranty claims were likely to reduce. Further investigation, however, revealed that warranty claims have by far remained the same. You see, the warranty claims have remained the same, yet the provision has reduced. So the company has not set aside money to meet these claims where customers are maybe returning the products. The company has not set aside money, and we see that is a risk, poses a risk to the organization. The company may not be able to meet its liabilities and when they fall due. You understand? So the auditor has to consider the impact of this reduction in warranty provision on future periods. Then the third action is to discuss the concerns with management and request a review of the provision. Request a review of the provision from management. So the management may review it, may not review it. Because the adjustment should be to make it more appropriate. More appropriate means that reduction should be done away with. It should still be 10% because that has been the case before the reduction. Review of the provision, potentially adjusting it to a more appropriate level. So you see, candidates have just been giving 3 points because I'm guided by the question. When you are faced with this question, candidates, you try and see how marks are allocated. You can see, discuss how the auditor would be expected to treat each scenario. 9 marks. That means that each scenario you should give at least 3 points. At least 3 points. And we've seen candidates, the last point is constant. That one has to happen. You have to have a discussion with management, because this is the senior auditor. The senior auditor candidates, the role of the senior auditor, the auditor was not involved in the day-to-day audit of the work. He was not involved. The auditor was not involved. The senior auditor. The senior auditor here is reviewing the audit files for the period. The audit files have been brought to his table. So the audit of the financial statements is almost complete. When the audit is almost complete, the senior auditor has to review the audit files before the report, the opinion is expressed in the final report. The senior auditor has to review the audit files. So he has reviewed the audit files and he's come across these issues. All right. So I'm saying, look at them. For those who are going to do exams, please be guided by how the marks are allocated. Then let's look at the second part of the question, which reads, propose how you would treat each scenario mentioned above in the auditor's report, assuming the management of Jasiri Limited does not correct the misstatements. Because you see, in each scenario, the second part gives a hint on what should be the answers in the first part of the question. Because at first part of the question, the matters are to just be referred to the management, because the problems are brought about by the management. Okay, the top management. So the buck stops with the top management before the auditor expresses his opinion. So assuming the management does not correct the misstatements, because these are misstatements, the question now is, propose how you would treat each scenario mentioned in the auditor's report. Let's go back to the first scenario. The first scenario, this was the problem of the depreciation charge. It's part 2 of the question. Second part of the question, we have the overstatement. So the overstatement of depreciation charge and the net book value of the equipment. These two are overstated. Depreciation charge, that's depreciation for the year, and the net book value of the equipment. Now assuming, just as we had discussed in part 1 of the question, that the auditor should discuss with management and request for appropriate adjustment. So the management is required to make an adjustment to the depreciation charge and the net book value. Now, assuming that the management refuses to make the adjustment, what should the auditor do? That's the question. Issue except for qualified opinion. What is the rationale? Why would you do so? Due to non-disclosure. Because IAS 2024 requires that such a transaction be disclosed. So the report will be qualified due to the non-disclosure of related party transaction. To non-disclosure of related party transaction. The law requires that the management should disclose. The senior auditor has had a discussion with management and requested the management to disclose it. The management have refused to disclose it. So when writing the report, the auditor should qualify it, except for. Because the omission affects the integrity of financial statements. As related party disclosures provide transparency on management's transactions and relationships that might influence decision making. That is a point. Reduction in warranty. What will be a treatment of the management's refusal to review the provision from 5% to 10%? So because we had said that the auditor should request the management to review the provision warranty to bring it back from 5% to 10%, but the management has refused to do so. What are you required to do? third scenario, Sue says adverse. So are you guessing? Because it is qualified, so you guess just be adverse, so that it doesn't appear like all of them will be qualified except for. And always remember, candidates, and I emphasize in our last lesson, and I continue to emphasize, you will have a question on if you are going to sit for the exam on types of audit opinion. An adverse opinion is only issued where a misstatement or an omission is not only material but also pervasive. So before you say adverse, you need to establish if this misstatement is pervasive, meaning widespread. Is it widespread? Or is it affecting only the warranty provision? Let that be your guide. Okay? So if management does not adjust the warranty provision, the auditor should consider a qualified opinion except for, because the warranty may be materially understated. So the reduction in provision is not supported by evidence of decreased warranty claims. It's not supported. In fact, we are told that the warranty claims have remained the same for the last 2 years. So by reducing the warranty, yet the actual claims have not reduced, raises concerns about the accuracy of the reported liabilities and could mislead the users regarding the potential future cash flows and even related customer claims. So again, here issue except for, issue except for qualified opinion.
Hello learner, welcome to Manifested e-learning platform. My name is FAM Lingwiri, and today, ladies and gentlemen, we are discussing about the financial modeling and data analytics paper, December 2023 sitting. The focus is on question 23, and you are presented with the following information right on the left of your screen here. You'll be given the stock name, Z-Term Kenya Limited, Car Assemblers, Ujenzi Centum and Cement, Kilimo Bora, Nairobi All Share Index, and you've been given the ticker symbol right over here. You've also been provided with the portfolio compositions, and all of these total to 100%. And how you can be able to just quickly check is by scrolling down over here, and you can see that the sum is 100% right here. You are presented with the weekly returns for all of those companies, or all of those 4 companies, including the Nairobi All Share Index. Now, you are required to calculate the weekly returns for each of the individual stocks and the Nairobi All Share Index, calculate the wage portfolio, the average portfolio return for the historical period. You're told to calculate the standard deviation for each of the individual stocks and the Nairobi All Share Index. Then you're told to calculate the standard deviation for the portfolio returns to assess its risk, and to calculate the beta each individual stock of the portfolio, which measures its sensitivity to the market movements. And you can see these are 20 marks. This is 20 marks question. So the way I've decided to arrange the information is to arrange it as you can see on the right of your screen over here, to calculate the weekly returns for each of the individual stocks of the WB All Share Index. So we just pick average, not average A, you can see the average right over here. And the average of what? We want to pick the average for Z term Kenya, to pick the average values right here. Up to there, close the brackets, then you enter. So we're saying that the average return should be negative 0.2%. Let's put it to maybe say 2 decimal places. That 2 decimal places is up to there. And if we were to drag it moving towards the right, we wouldn't be wrong, because we're saying that it picks the average for car assemblers. You can see car assemblers, it picks it right there. So that's what they're saying, the average, the weekly returns is given to us right there. Escape. We move ahead and answer part B of the question. You're told to calculate the average portfolio return over the historical period. We have been given the portfolio composition, and the portfolio composition can be linked with this top part right here. The portfolio composition is there. Enter. And we link it with all of them towards the right, Control R, like that, so that you can be able to pick the portfolio composition. Remember, we have computed the average weekly returns above here. So we just link it with up above there, and then we drag it, Control R, like that, the same values, excluding the all share index. Because this, all of these portfolio composition total to 100%, as you can see down here, we cannot be able to include the all share index into our portfolio. How do we get the average portfolio return? Pick plus, we open the brackets, that value times the average weekly return plus that value times that value, close the bracket, the portfolio composition multiplied by the average weekly return, close the bracket, and then we add finally the portfolio composition for Kilimo Bora, and we multiply that with the average weekly returns, like that. Oops, that, close the brackets, and we enter. So I think I didn't put open a bracket here, that's why it's giving me those values there. So we open a bracket over here, and then once we close it like that and we decide to enter, it will actually be okay. So we only want it into the 2 decimal places, so we just sort of reduce it like so to 2 decimal places, like that, 0.35%. Now once we've gotten our portfolio return as 0.35%, we can move on to part C. Calculate the standard deviation for each of the individual stocks and the Nairobi All Share Index. That's 4 marks. So average standard deviation would be, we pick STD, stud dev, not P, because we're not picking for the entire population. We want stud dev, standard deviation for the sample. So we double click that, and we can be able to just pick the value for these values here. We highlight this value for Z term. So we highlight it down like that, and it picks to calculate for us the standard deviation for Z term. And we move up over here like this, we can be able to see we already have that given to us there. And if we were to drag it moving towards the right, like so, up till all share index, it will actually pick the standard deviation. Remember, for example, this one is picking the standard deviation of the sample for the index, for the Nairobi all share index right here. Part D, we asked to calculate the standard deviation of the portfolio returns to assess the risk. And we're saying for us to be able to do that, we will need to consider the weights. And the weights would mean that we've already have the standard deviation over here, compared to us over here, but now we need to factor in the weights. And we're saying it's going to be, we pick that standard deviation times its corresponding weight over here. The corresponding weights were given to us over here. We can use that, or we can even use this portfolio composition right over here. So we close the bracket and we open another one over here so that it can actually pick the values as the way we want them. Then we add the standard deviation over here. I forgot to open the brackets, so we open it right above over here. You can see it on the formula bar here. So we open the brackets there, and then we multiply that with co-assemblers, corresponding portfolio composition weight. We open the brackets, we pick Ujenzi Bora standard deviation, weekly standard deviation, times the Ujenzi cement over here. Then we close the brackets, plus we pick this value here and we multiply that against that value there. Open the brackets and we close the brackets like that, and we just click enter. So we can be able to put it in form of weights, and we can say it's about 06.02% standard deviation. So standard deviation of the portfolio is given to us there. So we pick the standard deviations of the individual securities and we multiply them by the corresponding weights. Then finally, we are asked to calculate the beta for each individual stock in the portfolio, which measures its sensitivity to market movements. The beta is given by covariance of the market and stock, so you can put it like so, covariance of the market and the stock. Then we divide that against the variance of the market, like that. And that's what we're saying we're going to do. Covariance of the market and stock, or variance of the market. So we pick covar S, because we look at a sample, covariance, and we open it up right over here. Covariance of what? Covariance of the market. This is the market over here, so we highlight that part. Covariance of the market, and on the second array here we put the stock itself over here, bearing in mind like that, covariance of the market and stock like that, and you can see what we've done, covariance of the market and stock. So we can lock the one for the market. So we are saying this one for G is one that you can be able to decide to lock. F4 and F4. Why are we locking it? Because we want to ensure that the covariance of the market remains like that. And then we do what? We divide now, divide by, you can see the variance like this. We divide against variance, or we just put it like that, variance of the market. But now, before we do the variance like that, we can say okay, like that, because that's just the covariance, like that, because you can see from the formula by just the covariance. Then we continue and say divided by the variance, not var p but var s, sample, variance of the market, based by this variance of the market. So we pick the variance of these values here and we lock it. So press F4 like that and we close the brackets. That there, that's our beta, 0.0932. And if you were to drag it moving towards the right, let's just confirm. Covariance, remember we have locked, that's the purpose of locking. This one, covariance of the market. Look, this one has moved from initially Z term to now car assemblies. You can check the previous one over here, escape, check the previous one, you see it is now currently at Z term over Z term here. Now we move on to the second one, it actually picks, but it remains, this one remains, the variance of the market remains, the covariance of the market remains. So we can be able to say that the model is foolproof. Control R. But let's see if we're actually doing this the correct thing. We want to try and prove if we were to pull it towards the right, if you're going to get a beta of 1. You can see we already have beta of 1. Beta of the market is always 1, because it's covariance of the market, it's covariance of the market against the market divided by variance of the market. We always have that value being 1 there. And so with that, ladies and gentlemen, we have come to the end of question 23. Thank you for being with Manifested Publishers. We always here for you. Be blessed.
Hello and welcome to the lesson. The subject is company law. Today we are going to answer question number 3 from the April 2022 sitting that was done by certified public accountants and certified secretaries. Part 3 has 4 parts, A, B, C, and D. Part A says, summarize 6 grounds for disqualification of directors, 6 marks. B, explain 4 grounds for disqualification from being registered as a company secretary, 4 marks. C, outline 5 rights of auditors under the Companies Act which relate to company meetings, 5 marks. D, explain 5 circumstances under which a company might decide to undergo a corporate restructuring, 5 marks. Company law, April 2022, question 3. Part A of this question. Grounds for disqualification of directors. What are the grounds for disqualification of directors? The first ground is conviction of an offense. Conviction of an offense. Conviction of an offense. If a director is convicted of an offense, then that is sufficient ground for his or her disqualification. Another ground is breach of duty, fraud, and breach of duty, or breach of duty is another ground for disqualification of a director. That is disqualification for fraud or breach of duty committed while the company is in liquidation or under administration. Number 3, we are outlining the grounds for disqualification. The third one is if he or she becomes of unsound mind. If a director loses his or her mind, then such a director ought to be disqualified, because for you to function effectively as a director, you need to have a sound mind. But if a director loses his or her mind, then that will be ground sufficient for disqualification. Absence. Absence from duty. Absence. Now, if a director is absent without permission for a long period of time, say 6 months or 7 months, and if a director is also not present when meetings are called, the meetings of directors that are held within that period, then that director should be disqualified from his duties. Absence. If he or she is absent without permission. Absence without permission. A director may also be disqualified if he or she resigns. Resignation. Resignation. If a director resigns his office by notice in writing to the company, then that will be sufficient ground for his disqualification. Then number 5, if he is undischarged bankrupt. If a director is declared bankrupt by a court of law, then such a director should also be disqualified from his station or from operating or functioning or carrying out his duties as a director. Okay? So these are 1, 2, 3, 4, 5, 6. These are 6 grounds for disqualification of a director. A director may also be disqualified, I can say, on conviction of offense involving failure to lodge returns or other documents with the registrar. If a director fails to lodge returns or other documents to the registrar, then that can lead to his disqualification. 6 points, 6 marks. Now let's answer part B of this question. Explain 4 grounds for disqualification from being registered as a company secretary. B, grounds for disqualification secretary. What are the grounds for disqualification from being registered as a company secretary? As a company secretary. The first ground is that one related to conviction. If convicted by a court of competent jurisdiction in Kenya or elsewhere involving fraud or dishonesty, then that is a ground sufficient for disqualification from being registered as a company secretary. Conviction by a court of law, competent court of law. 1, I've said conviction. by a competent court of law. Conviction by competent court of law in Kenya or elsewhere involving fraud or dishonesty. That is sufficient ground for disqualification from being registered as a company secretary. Next is undischarged bankrupt. Undischarged bankrupt. Another ground is that one in relation to unsound mind. If he or she is unsound mind and has been certified to be so by a medical practitioner. Unsound mind. And that means that the mind of the company secretary has to be certified by a medical practitioner to be unsound. That will be sufficient ground for disqualification from being registered as a company secretary. Then lastly, we can say that a company secretary can be disqualified from being registered if the registration board determines that he or she shall not be registered. For example, if a person is guilty of professional misconduct, guilty of professional misconduct. A certified secretary is a professional who is expected to adhere to the code, the professional code of ethics. So if the company secretary is guilty of misconduct, guilty of professional misconduct, then such a secretary can be disqualified from being registered as a company secretary. So these are 4 grounds, 4 marks. Part C, outline 5 rights of auditors under the Companies Act which relate to company meetings, 5 marks. Rights of auditors under the Companies Act which relate to companies meetings. The first right is that a company auditor is entitled to receive all communications, okay, relating to any written resolution proposed to be agreed by the company. So a company auditor has a right to receive communications. A company auditor has a right to receive all communications relating to any written resolution proposed or to be agreed by the company, because we know that resolutions are held through meetings. So an auditor has a right to receive all communications. All communications. All communications. That's the first right. The next right is that this auditor, company auditor, has a right, or you can say is entitled to all notices. Entitled to all notices. A company auditor is entitled to all notices and other communications relating to the general meetings which is a member of, which other members of the company are entitled to receive. Is entitled to all notices of and
also other communication relating to any general meeting which a member of the company is entitled to receive. So any notices that a member is entitled to receive, any communication that a member is entitled to receive, then an auditor is likewise entitled to receive such notices, such communications of the company. The third right of auditors under the Companies Act which relate to company meetings is that the auditor has a right to attend any general meeting of the company. Right to attend any general meeting of the company. Has a right to attend any general meeting of the company. Another right relating to meetings is that an auditor has a right to be heard. He has a right to be heard at any general meeting, to be heard at any general meeting. Right to be heard means he has a right to speak, because he cannot be heard without speaking. So he has a right to do what? To be heard at any general meeting that the auditor attends. And he has a right to be heard in relation to any business of the meeting in his or her capacity as the auditor. So these are rights, outline 5 rights. We can also say that an auditor has a right. Now, if the auditor is a firm, the right to attend or be heard at a meeting is exercised by a natural person authorized by the firm in writing to act as its representative at the meeting. So these are rights of auditors under the Act which relate to company meetings. Part D. Part D, explain 5 circumstances under which a company might decide to undergo corporate restructuring. Circumstances under which a company might decide to undergo corporate restructuring. What is corporate restructuring? Corporate restructuring. Corporate restructuring is defined as the process involved in changing the organization of a business. And it can involve making dramatic changes to a business by cutting out or merging departments. It may also involve or imply rearranging the business for increased efficiency and profitability. In other words, it is a comprehensive process by which a company can consolidate its business operations and strengthen its position for achieving corporate objectives or synergies and continuing as competitive and successful entity. So that is corporate restructuring. The question is, what are the circumstances under which a company might decide to undergo corporate restructuring? Now, a company may decide to undergo corporate restructuring, number one, in order to focus on core strengths. One, to focus on constraints. I've just said corporate restructuring may involve dramatic changes to business by cutting out or merging departments. So there are some departments that the company can decide to do away with in order to focus on core strengths, in order to focus on the core business, in order to focus on the key business activities. So that is one circumstance. If a company decides that the company is engaging in many activities, a company can now choose to focus on core strengths by carrying out corporate restructuring, to focus on core strengths, to focus on operational synergy, to focus on operational. The company can decide to want to focus on operational synergy, and also efficient allocation of managerial capabilities and infrastructure. So then second circumstance is in relation to consolidation and economies of scale by expansion and diversion to exploit extended domestic and global markets. Consolidate. To consolidate is to aggregate. I just say that corporate structuring implies rearranging the business for increased efficiency and profitability. I just said that it is a comprehensive process by which a company can consolidate its business operations and strengthen its position for achieving corporate objective. So one circumstance that under which a company might decide to undergo corporate structuring is consolidation and economies of scale by expansion. Another circumstance could be, the third circumstance could be revival and rehabilitation of sick units. Sick units. Having sick units can be a circumstance under which a company can decide to undergo corporate restructuring. If a company has sick units, then the company may want to revive or to rehabilitate the sick units by adjusting losses of the sick unit with the profits of the healthy units. Number 4, the fourth circumstance is in relation to purchase of raw materials or acquisition of raw materials. Acquisition of raw materials, acquiring constant supply of raw materials. If a company has a need, if the company has a challenge in acquiring raw materials, then the company can carry out reconstruction, can carry out corporate restructuring in order to acquire a constant supply of raw materials and access to scientific research and technological developments. Number 5, the fifth circumstance under which company might decide to undergo corporate structuring is in relation to capital restructuring. If there is need for capital restructuring, the need for capital restructuring. The need for what? Capital restructuring. Now, that is by way of appropriate mix of loan or debt and equity funds in order to reduce the cost of servicing and improve return on capital employed. So the need for capital restructuring can also be a circumstance under which a company might decide to undergo corporate restructuring. So capital restructuring involves coming up with an appropriate mix of debt and equity funds. And the reason why a company would want to do that is so that the weighted average cost of capital can be reduced, so that the return on capital employed is improved. Another circumstance is the need to improve performance. The need to improve performance, corporate performance, improve corporate performance in order to bring it to a par with competitors by adopting the radical changes brought by, say, information technology and so on. So the need to improve corporate performance can be a circumstance which under which a company might decide to undergo corporate restructuring. So these are 6 circumstances. Number 1, the need to focus on core strengths, operational synergy, efficient allocation of managerial capabilities, and infrastructure. Then there could also be the need to consolidate, the consolidation and economies of scale by expansion and diversion to exploit extended domestic and global markets. So the need to go global, to extend across the borders, can be a reason why a company can carry out corporate restructuring. Then there is the issue of the sick units. The sick departments, okay? The sick branches. That can be a circumstance under which a company can decide to undergo corporate structuring. And the company can do that by rehabilitation of the sick units, so that the losses of the sick units can be adjusted with the profits of the healthy units. Then there is the need to acquire raw materials. Let me use the word acquire. The need to acquire. The need to acquire raw materials. The need to acquire raw materials is also a circumstance under which a company can undergo corporate restructuring. Constant supply of raw materials. You may find companies struggling to acquire raw materials for manufacturing or conversion of the raw materials into finished products. That can be a very big challenge. So a company can decide to restructure so that it can position itself to have constant supply of raw materials for production purposes. So these are six circumstances. Candidates were expected to give 5. These are 6 to earn 5 marks. 1, 2, 3, 4, 5, 6, any 5 marks. Part C, rights of auditors under the Company Act, which relate to company meetings. 1, 2, 3, 4, 5 marks. 5 marks. Then grounds for Disqualification from being registered as company secretary, 1, 2, 3, 4 points, 4 grounds, 4 marks. 4 grounds, 4 marks. Then part A, grounds for disqualification of directors, 1, 2, 3, 4, 5, 6. 6 grounds, 6 marks. 6 grounds, 6 marks. So this is 6 plus 4, 10. 10 plus 5, 15. 15 plus 5, total 20 marks. I've answered April 2022, question number 3. In our next lesson, I'm going to answer question number 4. Try and attempt question number 4 before coming to the next session. I remain truly yours, Philip Sagwa. Bye-bye. Bye-bye.
Welcome to Manifested Publishers.
So once we have that, we can then just move ahead to the base, to the optimistic case. We just, first of all, before we group, we just copy this part, again, copy, and we can skip this part towards the right there, Control V. Even if you are to just delete this part over here now, delete it, that, or we can just undo and undo, and we select this part and just say cut instead of copy. Cut there, and then we paste it right here, Control V, so that now we don't get disturbed by the space. And we copy this part up to 2022, like that again, copy. Sorry, I said cut, this should be copy. And we put it right above, right here, Control V. And this case is what? Optimistic case. Optimistic case. In a similar font, just put that right there. And here we can just be able to group it right over here. So we group. Where do we group? We come to data. We come to group. You can see group here. We press the above one. Group, that thing comes. This kind of grouping comes. In terms of the outline, let's group it there. So we have even this one for the base case. Let's group it. We want our forecast to be from 2023 to 2027. So you can see I click this one, copy 2023 to 2027, like that, copy, and then we reduce the grouping right over there and compress Control V, it comes. Now let's look at systematically, step by step, what changes we have to make. So we again go through this, clear the font, no fill, we make adjustments. Revenue growth rates are the forecast under the 3 scenarios, namely base case, optimistic case, and pessimistic case. The base case growth rate for the first year and forecast is 2022 CAGR. This is expected to reduce by 2% annually until the last year of the forecast, subject to a minimum of 15%. Optimistic case is 20% above the base case. So we can come right over here to 21A down here, and we are saying it is 20% above. Here is a pessimistic case. We said it was 10% below. So you can come over here, optimistic, here, and say that it is plus this one, sorry, plus this one times, open the brackets, 1 plus, not minus, 1 plus 20%. It's above. Above. So 20%. So for purposes of consistency, like that, 25%. So you increase 21% by 20%, it comes to 25%. So what are we told? We come back to tab B. 20% above the base case. So the base case was 21%, yes. So we are saying that it is expected to reduce like that. And we can say that now, come back over here, plus 22 like that, times, open the brackets, 1 plus, we come to this value here, that value, close the brackets, enter, 119. So for font, keep the font the same. Once you have 119, it's expected to reduce by what percentage? By 2%. So plus this one minus 2%, 23%. Then plus this one minus 2%, that 21%, and so on and so forth. As you move along, move along up to there. So what are we saying? This is 2023, and we can be able to increase like that until 2027. So fill series. So this will be the rates for the years over here. This is the years, bold that. These are going to be the rates right here. So we've picked 25% for 2023. Now we need to pick 23% for 2024. So we pick plus that value times, open the brackets, 1 plus what? The one for 2024. We come back to tab A. 2024 we can see is that one there. Close the brackets, enter, like that, and you do the same. Plus that value times shift, open the brackets, 1 plus what? We are picking 2025. We come to tab, this next tab over here. 2025 you can see is 21%, and close the brackets, enter, like that, and then plus that value over there times, open the brackets, 1 plus what? We are picking 2026. So we come back over here, 2026, and right over here is 19%. Like that. You close the brackets, and then we press enter. And then we are saying we press plus that value times, open the brackets, 1 plus what? We are picking 2027. Come back over here, 2027 is 17%. It's not reached the threshold of 15%. Like that, we close the brackets, and we press enter like that, and that gives us the revenue under the optimistic case. How about cost of sales? We already have the gross profit margin. So we can be able to compute the gross profits very easily like that. So we just come over here, highlight like that, the same format, painter there. We're saying it's just going to be given as the sales times gross profit margin. So plus that times the gross profit margin for 2023, that over there, gross profit margin is that. Once we have that, we just drag the formula moving to the right there. And then for us, it's going to be is equals to minus, so we open the brackets right over here, that one minus that value, and we close the bracket like that, so you can be able to get it consistently as a negative value there. So for format painter, you move across like that, and then you can now drag the formula moving towards the right. So to just check, so plus that gives us, so you can see this answer is the same as that one there, and even if you were to drag it moving towards the right, of course you can see that one is the same as that. Of course the decimal places over here come into play, but don't worry about that, it's actually the same. These are actually the same values there. So delete that for now. How about the operating expenses? We have the operating ratio. They are given to us there. We've been told, so revenue is done, put pitch there. Gross profit margin is done. We've done that. Operating expenses are modeled 3-year averages for the period 2020 to 2022. These are assumed to remain constant of the forecast period. So we just pick the expense ratio. To get the operating expenses is just the sales times expense ratio from 2023. Sales times expense ratio. So plus, so is equals to minus, because it's a formula like that, times the expense ratio, because it's operating expenses, expense ratio 2023, ndio hiyo iko hapo, like that, close the bracket, enter. Move up, so negative value, formatting, come to format painter, like that. Of course, in the exam, you don't need to just really bother yourself with the format, but I'm just doing it because of to ensure that we have consistent results there and consistency in terms of presentation. That's it. We just drag the formula like that. How about operating profit? Plus that should give us, that's so. I said plus that value plus that value should give us 44 there. Just drag it like that. It gives us the same, gives us consistent answers. Format painter. Depreciation. We've been told that depreciation, we finished operating expenses, we're told depreciation down over here to revenue ratio is assumed to remain constant over the 3-year average for the period 2020 to 2022. So we should remain here 0.9%. So it's just going to be the sales times depreciation ratio. So it's just going to be plus sales times depreciation ratio 2023 there, enter. Once we have that, we drag the formula towards the right and we can be able to ensure consistency. So minus, then we open the brackets, close the bracket like that, enter. But now here it should be negative. Oops, like that. How about the profit before tax, before interest and tax? Plus that, get the answer straightforward, move towards the right. Format painter, there. Finance costs, ladies and gentlemen. We are saying finance costs, we've already done depreciation right over there. Come to finance costs. They are expected to reduce steadily as the loans are repaid. Use the reduction rate in 2022 over the forecast period there. So in a similar fashion, plus that one minus, this is the depreciation rate, reduction rate. So 2023 there. Oops, it should be plus, this is 2023, that one minus that. I'm pressing minus or plus, sorry. Plus that one plus 1,000, yes, 2023, that. Yes, that's the correct value. Sorry, using this wrong formula. We drag it like that. Format painter. Profit before tax plus that, get that. We drag the formula like that towards the right and we use format painter. Finally, or rather semi-finally, second to final, income tax expense. We've been told the income tax expense and the finance cost we've done. Income tax expense, calculate the historical average effective tax rate. Highlight that to show that you've done it, and it's just going to be plus that times this value here, that. But because it's a negative, so you put negative minus, open the brackets, close the bracket, enter. So we drag there. Finally, we have the profit before tax plus that should be able to have those values like given to you there. So format painter, you can see the values right there. So 2023, I need to ensure that there's consistency in terms of the presentation of the outlook over there. You can be able to see that we have concluded the optimistic case. So we have answered part B of the question. Prepare 5-year forecast statements for profit and loss for Sepetuka Limited from 2023 to year 2027. So just to recap what we've discussed, we were told to prepare a base case income statement, a pessimistic case income statement. You can compare, the 42 represents the base case, and the 40,000 represents the worst case or the pessimistic case, and towards the right over here you can see the optimistic case is 50, it's slightly higher as compared to the previous two there. So this answers part B. Hope you have enjoyed the lesson. Thank you for being with us, and God bless you.
Welcome to Manifested Publishers.
Let us move on to question 17. Two challenges of big data and analytics is inaccessibility of data and low speed of access to data. Which of the following actions by an organization will address the two challenges? A, providing access to all data to specified employees. B, providing access to selected data to all employees. C, restricting access to all data for specified employees. D, database management system. So the question tells us that two challenges of big data and analytics is one, inaccessibility of data, and two, low speed of access to data. Now we'll answer this question by eliminating some of the choices given. The question required candidates to identify a method or an action that an organization can put in place to solve the problem of inaccessibility of data and low speed of access to data. And you can see A, providing access to all data to specified employees. That cannot be a solution. Providing access to all data to specified employees is not a solution. Rather, this approach may create additional challenge in terms of data security. Where employees are given access to all data, then there is a risk of data insecurity. So that cannot be a solution. B, providing access to selected data to all employees. That is again not a solution. That will not solve the problem of inaccessibility. When you provide selected data, then you are providing, you are not providing the required data, the necessary data. That is limiting accessibility. So that cannot solve the inaccessibility problem. Restricting access to all data. Restricting access to all data, again, is not a solution. Is an additional challenge in terms of accessibility and also compliance with data protection laws. So the only solution here Having knocked out A, B, and C, the solution is a database management system. A database management system will be the best action to solve the problem of inaccessibility of data and low speed of access to data. Why? Because a database management system is a software application that is used to manage, to store, and retrieve data from a database. It is designed to handle large amounts of data. All right, a database system is designed to handle large amounts of data efficiently, and it can be used to improve the accessibility and speed of access to data. So therefore, candidates, by implementing a DBMS, organizations can improve the way they manage and analyze big data, and they can also be more effective in analyzing data. They can more effectively leverage the insights that big data analytics can provide. So a database management system can solve the challenge of inaccessibility of data and low speed of access to data. That's the answer to question number 17, December 2022, business data analytics.
Hello everyone, and welcome to the revision session for ICT. We are going to revise question number 5 that was done in August 2022. Question 5A reads, explain 6 reasons that would cause an information system project to fail during the implementation stage. 6 reasons that could do what? That could cause. Six reasons that could cause an information system project to fail during implementation phase. When implementing an information system project, what are the reasons that could lead to its failure? The first point is inadequate planning. Inadequate planning. When undertaking any project, not just an information system project, any project, if there is poor planning, that can lead to a lack of clarity and regarding project goals. It can affect timelines, resource allocation, and so on. So insufficient planning can result in miscommunication, can result in delays and ineffective coordination during the implementation phase. So that is one reason. Lack of stakeholder engagement or involvement. Lack of stakeholder engagement or involvement. Now, if key stakeholders, such as the users or the managers or executives, are not actively involved or their input is disregarded, then it can lead to resistance, dissatisfaction, and lack of ownership. So without stakeholder buy-in, the implementation process can face significant challenges. Because when implementing the information system project, one may need the support of the stakeholders. But if stakeholders were not involved at the planning stage, then that could lead to failure
of the information system project at the implementation phase. Insufficient training. Insufficient training and change management. Insufficient change management. Insufficient training and insufficient change management. Users and employees need proper training to effectively adopt and utilize the new system. And if training is inadequate or if training is overlooked, then users may struggle to adapt to the new processes and functionalities. Change management also should address potential resistance to change and ensure smooth transition and user acceptance. So if there is insufficient training, then that can lead to failure of an information system at the implementation phase. Inadequate communication is yet another reason. Inadequate communication. Inadequate communication is another cause, because clear and effective communication is vital throughout the implementation process, and therefore lack of communication can lead to misunderstanding, can lead to confusion and also conflicts. So project teams, the stakeholders and the users should have open channels of communication to address issues, provide updates, and then also gather feedback. Poor scope management is another reason. Poor scope management, or what we call scope creep. Scope creep. Scope and scope creep. Now, scope creep refers to uncontrolled expansion of project requirements. Uncontrolled expansion of project requirements, often resulting from inadequate scope management. If project boundaries and deliverables are not well defined, if they are not well managed, then additional features, requests, or changes can emerge, leading to project delays, leading to cost overruns and compromised quality. So, poor scope management and scope creep can cause an information system project to fail during the implementation phase. Number 6, technical challenges. Technical challenges and system compatibility. Technical challenges and system compatibility. Now, technical issues such as software bugs, hardware failures, integration problems with existing systems can significantly impact the implementation phase. And incompatible technologies, inadequate infrastructure, or unreliable technical support can also hinder successful deployment and utilization of information systems. Technical challenges and system compatibility is the 6th reason that could cause an information system project to fail during the implementation phase. These are 6 reasons, 6 marks. Inadequate planning, lack of stakeholder engagement, insufficient training and change management, inadequate communication, poor scope management and scope creep, then technical challenges and system compatibility. 6 marks. That is part A. Part B reads, in each of the following explain how a spreadsheet program is used. How a spreadsheet program is used. I repeat, in each of the following, explain how a spreadsheet program is used. Roman 1, accounting. Roman 2, forecasting. How a spreadsheet is used in 1, Roman 1, accounting. Part B, how a spreadsheet is used in Roman 1, accounting. How is a spreadsheet used in accounting? Now, a spreadsheet program such as Microsoft Excel or even Google Sheets is commonly used in accounting for various purposes. One is creation of financial statements. It allows for creation of financial statements. A spreadsheet like Excel allows for creation of financial statements, such as an income statement, balance sheets, and also cash flow statements. And that it does by organizing and calculating financial data. Another way in which spreadsheet can be used in accounting is by utilizing formulas and functions for automated calculations, including summing up of expenses, calculating profits, applying accounting formulas, and so on. Applying accounting formulas. A spreadsheet can also be used in calculations, all right, automated calculations, summing up expenses, so candidates, spreadsheets program can perform very many functions in accounting. Candidates were to give just two. Given you 3 here, there are more features that you can have in Excel, like data validation, conditional formatting, and those are functions that can be used to ensure accuracy and consistency in accounting process. Data validation. Data validation. Now, to learn more on use of spreadsheets in accounting, just go to your computer, check the spreadsheet, open the Microsoft Excel and look at the functions. There are numerous functions, many functions that can be used to carry out accounting processes. That is Roman 1. Roman 2, forecasting. Forecasting. What are the, we are to explain how a spreadsheet program can be used in forecasting. Now, candidates, spreadsheet programs are also used for forecasting and financial analysis. They allow users to enter historical data and then use various mathematical and statistical functions to analyze trends. Analyzing trends. A spreadsheet program can be used to analyze trends. Do you understand? By entering historical data, the spreadsheet can help to forecast, to analyze trends, to make predictions, to make projections, projections or even predictions. As the software can predict future outcomes, and users can create charts, can create graphs and visual representation of data to aid in understanding and communicating forecasts. Visual presentation. Graphs, head maps, and so on. So a spreadsheet can generate visual presentations, representations of data to aid in understanding and communicating forecasts. So spreadsheets also, candidates can provide functions like regression analysis, moving averages. We may also even have exponential smoothing that can be used to generate forecasts based on historical data that can support decision-making processes in areas such as sales, forecasting, budgeting, in areas such as financial planning, and so on. So these are some of the ways in which a spreadsheet program can be used in accounting and forecasting. Creation of financial statements. Applying formulas and functions. Summarizing expenses. Carrying out data validation. This was to earn 2 marks. Then forecasting, I've listed many functions, 2 marks. C. Describe each of the following ethical issues in regard to computer technology. C. Roman 1. Trademarks. Trademarks. Now, candidates' trademarks refer to the distinctive symbols or logos or names that identify and differentiate products or services of a particular company or a brand. The question is, describe each of the following issues in regard to computer technology. So we're supposed to explain trademarks in regard to computer technology. Describe each of the following ethical issues in regard to computer technology. So a trademark, first of all, it's a distinctive symbol. It's a unique symbol. It could be a logo or just a name that identifies or differentiates a product or a service of a particular company or brand. So the question is, what are the ethical issues that are related to trademarks? So the ethical issues related to trademarks arise when individuals or organizations infringe upon or misuse another entity's trademark. Infringement. Infringement or misuse of another entity's trademark. You understand? That's an ethical issue. So that can involve, that infringement can involve using a similar or identical trademark to deceive customers or gain unfair advantage in the marketplace. If company A has a logo or a symbol, infringement can arise where company B mimics that logo or uses a similar logo or an identical trademark to deceive customers so that when they are buying the product of company B, they may be deceived that it's a product for company A, where then company B receives or gets an unfair advantage in the marketplace. So ethical considerations require respecting and honoring established trademarks and avoiding conflicts or misleading customers or consumers, and also upholding fair competition. So that is an ethical issue, infringement. Infringing or misusing. Misuse. Infringement or misuse of another's trademark. That is an ethical issue that may arise when dealing with trademarks, infringement or misuse. And this misuse can be intended to deceive consumers at the marketplace. Patent rights. Patent rights. What are the ethical issues related to patent rights? Now, patent rights are meant to protect inventions or new technological innovations. They are meant to protect inventions. Patent rights are rights that are rights aimed at protecting new inventions or technologies. New inventions, or even we can say new technological inventions. Patent rights exist to grant exclusive rights to the inventor of the inventions. The inventor of the invention for a specific period of time. So what are the ethical issues related to patent rights? Now, ethical issues related to patent rights arise when individuals or organizations infringe upon the technologies or even the ideas or processes without permission. Infringement without permission. You've said that inventors may have exclusive rights, but where other people infringe on these rights without permission of the one holding the patent rights or one that has exclusive rights, then there is an ethical issue, infringement. And that can involve unauthorized use, because we said patent rights protect inventions or technological innovations, granting exclusive rights to the inventor for a specific period of time. So where other parties get or enjoy these rights without permission of the one who has been granted exclusive rights, then there is unauthorized use, and that is an ethical issue in relation to patent rights. Unauthorized use, it could be replication or distribution, replication, and even duplication or distribution of patented inventions, or violating the rights and efforts of the original inventors, violating rights of original inventors. These are the ethical issues related to patent rights. So candidates respecting patent rights ensures fair compensation for inventors. It also encourages innovation and promotes a culture of respect for intellectual property. Do you understand? Of course you do. Part C, we have answered it. 2 marks each. 1 mark, 1 mark, 2 marks. Any points here? 1 mark, 2 marks. That is part C. Then part D. Most organizations align their information systems functions to their business strategy plan. Explain 3 benefits of this alignment. I repeat, most organizations align their information system functions to their business plan, strategic plan. Explain the benefits of this alignment. Benefits of aligning information system functions with business strategic plan. What are the benefits of aligning information system functions? These are the functions of the information system with the business strategic plan. One obvious benefit is that such alignment leads to improved decision making. Leads to improved decision making. Improved decision making. Alignment between information system functions and the business strategic plan ensures that the right information is available to support decision making processes. And by aligning systems and data with strategic goals, organizations can access accurate, timely, and relevant information to make informed decisions, and that leads to improved efficiency, effectiveness, and agility in responding to business challenges and opportunities. That's point number 1. We are to give how many points? 3 points. Number 2, enhanced operational efficiency. Enhanced operational efficiency. That's yet another benefit of aligning information system functions with business strategic plan or goals. Now, when information system functions are aligned with the business strategic plan, there is a better integration of processes, systems, and workflows. And such integration streamlines operations. It also eliminates redundancies and reduces inefficiencies. So by aligning technology and business objectives, organizations can optimize resource allocation, they can improve productivity, and also achieve cost savings. Can lead to increased competitive advantage. Aligning information system functions with the business strategic plan enables organizations to leverage technology to gain competitive advantage or competitive edge. So by aligning systems and processes to support strategic initiatives, organizations can enhance customer service, can also innovate new products and services, and differentiate themselves in the market. And such alignment facilitates agility and adaptability, allowing organizations to respond quickly to market changes, and also it helps the organization to stay ahead of competition. So these are benefits of aligning information system functions or aligning technology with business strategic plan. 1, improve decision making. 2, enhances operational efficiency. 3, it leads to increased competitive advantage. How many marks? 6 marks. 6 marks. So that effectively brings this lesson to a close, where we've answered question number 5 from the August 2022 sitting. In our next session, we are going to answer question number 6. Thank you for attending the lesson. Bye-bye. Greetings and welcome back. Today we turn to question 2, December 2022. The subject is meetings, compliance, and administration. Question 2A reads, identify 5 parties that may petition a court to liquidate a company. 5 marks. 5 parties that may petition a court to liquidate a company. The first party, creditors. Number 2, shareholders. Number 3, directors. Number 4, registrar of companies. Then 5, contributories. Those are 5 parties that may petition a court to liquidate a company. I repeat, number 1, creditors. Number 2, shareholders. Number 3, directors. Number 4, registrar of companies. Then 5, contributories. That is the solution to question 2A. Question 2A. Parties that may petition the court to liquidate a company. 1, creditors. 2, shareholders. 3, I mentioned registrar of companies, directors. 4, registrar of companies, 5 contributories. These are the 5 parties that can petition the court to liquidate a company. Creditors, candidates who are owed outstanding debts by the company may petition the court for liquidation if attempts to recover the debts have been unsuccessful. Here they seek to have the company's assets liquidated to satisfy their outstanding debts. Creditors. Then we have shareholders. Shareholders may petition the court for liquidation if they believe that the company's affairs are being conducted in a manner prejudicial to their interests. And that could be due to, say, mismanagement, that could be due to fraud, or other actions that harm the shareholders' investments. Directors or officers may also petition the court to liquidate a company. The registrar, in certain cases, the directors or officers of the company may themselves initiate the petition for liquidation if they believe that the company is insolvent and there is no reasonable prospects of being able to bring it back. All right? Directors. If the directors feel that the company is insolvent, then they can petition the court to liquidate the company. Registrar of companies or the relevant regulatory authority overseeing companies' registrations may petition the court for liquidation if the company has failed to comply with legal requirements, such as filing annual returns, filing financial statements, or other regulatory obligations. Then lastly, we have contributories. Contributories are individuals or entities who are liable to contribute to the assets, who are liable to do what? To contribute to the assets of the company. Contributories. And these individuals are liable to contribute to the assets of the company in the event of winding up. They are individuals who are liable, I repeat, to contribute to the assets of the company upon its winding up. So they may petition the court for liquidation if they believe that the company is unable to pay its debts and they want the liquidation process to commence. So these are 5 parties that may petition the court to liquidate a company: creditors, shareholders, directors, registrar of companies, contributories. 5 marks. That is part A. Then part B, assess 5 circumstances under which a member of the National Assembly may move a motion for the removal of the Speaker or Deputy Speaker. Circumstances under which a member of Parliament may move a motion to remove the Speaker or the Deputy Speaker. The first circumstance is misconduct. Misconduct. if the speaker or deputy speaker is found to have engaged in serious misconduct such as corruption, abuse of power, or violation of parliamentary rules, a member of the National Assembly may move a motion for their removal. Misconduct. 2. Incompetence. 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 If the speaker or the deputy speaker is deemed to be incompetent or incapable of effectively performing their duties, a motion for their removal may be initiated by a member of the National Assembly. 3. Loss of confidence. Loss of confidence. If a significant number of members of the National Assembly have lost confidence in the Speaker or the Deputy Speaker's ability to lead and represent interests of the Assembly, then a motion for their removal may be proposed. 4. Breach of constitutional provisions. Breach of constitutional provisions. Breach of constitutional provisions. If the Speaker or the Deputy Speaker consistently fails or is found, we can say if the Deputy Speaker or the Speaker of the National Assembly is found to have violated constitutional provisions, such as the separation of powers or the rights or privileges of the National Assembly, then a motion of their removal may be proposed or may be initiated. It may be initiated. A motion for removal can be moved. Non-compliance with parliamentary rules. If the Speaker or Deputy Speaker consistently fails to adhere to parliamentary rules and procedures, resulting in disruption or inefficiency in functioning of the National Assembly, then a motion of their removal may be initiated by a member of a parliament. By a member of a parliament. So these are 5 circumstances under which a member of parliament may move a motion to remove the Speaker or Deputy Speaker of the National Assembly. Number 1, misconduct. Number 2, incompetence. Number 3, loss of confidence. Number 4, breach of constitutional provisions. Then lastly, non-compliance with parliamentary rules. 5 circumstances, 5 marks. That is part B of question 2. Part C reads, explain 5 objections, explain 5 objectives, explain 5 objectives of insurance regulatory in your country. Objectives of insurance regulatory in your country. Now, the first objective of insurance regulatory in Kenya is consumer protection, protecting consumers. 1, consumer protection. Consumer protection. Insurance regulation aims to protect consumers by ensuring that insurance companies operate fairly, transparently, and in accordance with consumer rights. And that includes monitoring insurance practices, that includes monitoring insurance policies, and pricing, insurance pricing, to prevent fraud, misleading advertising, as well as unfair treatment of the policy holders. So the first objective of insurance regulation, the question says insurance regulatory, but I think this should be insurance regulation. The question says regulatory, but let's change it to objectives of insurance regulation. Now the second objective of insurance regulation is financial stability. That's yet another objective of insurance regulation. Insurance regulation seeks to maintain the stability of the insurance industry and protect policyholders' interests by monitoring the financial soundness and solvency of insurance companies. And that involves setting capital requirements, conducting financial audits, and also implementing risk management frameworks. Market competition. Market competition. Insurance regulation promotes what we call competitive insurance markets. By doing what? By preventing anti-competitive practices, ensuring a level playing ground or field for insurers. It involves monitoring market concentration. It involves prohibiting unfair trade practices. It may also involve promoting market entry and innovation. That is how insurance regulation manages market competition. The fourth objective is in relation to the policy holders. Policy holder confidence. Policy holder confidence. Insurance regulation aims to instill confidence. It aims to instill confidence in the industry. That is the insurance industry. It aims to instill confidence in the insurance industry by establishing standards, by establishing codes of conduct that insurers must adhere to. And that includes enforcing ethical conduct. That includes handling of claims, as well as prompt resolution of disputes to maintain policyholders' confidence and trust. Policyholder confidence. Number 5, we are discussing the objectives of insurance regulation in Kenya. Compliance. The last objective has to do with compliance with legal, and regulatory requirements. Compliance with legal and regulatory requirements. Insurance regulation ensures that insurance companies comply with relevant laws, comply with regulations and licensing requirements. And that includes licensing and supervision of insurers. It may also include approval of insurance products and enforcement of compliance with anti-money laundering and fraud prevention measures. So these are 5 objectives of insurance regulation in Kenya. 1, consumer protection. 2, financial stability. 3, market competition. 4, policyholder confidence. And lastly, compliance with legal and regulatory requirements. 5 marks. That is part C. Then part D, highlight 5 details contained in the register of directors. Details contained in the register of directors. Register of directors. Now, the register of directors is an important document that contains essential details about the directors of a company and candidates. While the specific requirements may vary based on the jurisdiction and the local company laws, there are some common details often included in the register of directors. And these are the details I'm going to list. 1 is the full name of the directors, full names of the directors, full name. The register will list the full legal names of all directors associated with the company. 2, residential address. The residential address. It will contain the residential addresses of the directors, and this information may be used for official communication and legal purposes. Nationality. Nationality. The nationality of each director is typically recorded in the register of directors. 4, date of birth. The date of birth of each director is included in the register. This helps to uniquely identify individuals with similar names. The date of birth can be used to uniquely distinguish the directors with similar names. Date of appointment, number 5. Date of appointment. The date of appointment. The register will note the date on which each director was appointed to the position. Why? Because it helps to track the tenure and changes in the directorships over time. If the date of appointment is known, then it's possible to tell the tenure of each director. So these are some of the details contained in the register of directors: full names, residential addresses, nationalities, date of birth, and date of appointment. 5 marks. 5 marks. So 5 plus 5 plus 5 plus 5 is equal to 20 marks. That's how to score 20 marks in meetings, compliance, and administration paper. We've done question number 2, December 2022. In our next session, we will answer question number 3. Thank you. Bye-bye. Hello and welcome back to the revision session for ICT. The paper is December 2021. Today we are going to answer question number 3. Part A, Roman 1 reads, outline 3 models used in classifying e-commerce applications. 3 models used in classifying e-commerce applications. Now, candidates, e-commerce applications refer to software platforms and systems that facilitate e-commerce, which involves buying and selling products or services over the internet. The candidates were required to give 3 models, and the first model is known as business to business, abbreviated as B2B. The second model is known as business to consumer, abbreviated as B2C. Then number 3 is consumer to consumer, abbreviated as C2C. So those are 3 models, and they are not the only models. There are more models. We will only focus on the 3 models in answering this question. Question 3, A Roman 1. Three models. The first one is business to business, B to B, business to business. Number 2, business to consumer, B to C. The third model is known as consumer to consumer, C to C. B to B, B to C, C to C. B to B, B to C, C to C. B to B, B to C, C to C. Now, B to B is a model that involves transactions and interactions between businesses. Business to business. Transactions and interactions between businesses. B to B. And it refers to the exchange of goods and services, or even information between 2 or more companies. Examples include online marketplaces where businesses purchase raw materials or software, or even software providers selling their products to other businesses. Business to business. Then we have business to consumers. It involves transactions and interactions between businesses and individual consumers. It refers to the online selling of products or services directly to consumers. Examples include online retail shops, food delivery services, and even online booking platforms. B2C, business to consumers. Then consumer to consumer model involves transactions and interactions between individual consumers, and it refers to the exchange of goods, services, or information between individuals through an online platform. Examples include online classifieds, peer-to-peer sharing. We have platforms where peer-to-peer share information or goods or services. And another example is online auction websites. Online auction websites, consumer to consumer. So these are 3 models used in classifying e-commerce applications.
Roman 2, explain 2 security challenges encountered in digital marketing of e-commerce. 2 security challenges encountered in digital marketing of e-commerce. Roman 2. Security challenges encountered in digital marketing of e-commerce. This is a common question. Security challenges. The first one is data privacy and security. Data privacy and security. Number 1, data privacy and security. Data privacy and security. Digital marketing involves the collection, the storage and processing of customer data, and ensuring the privacy and security of this data is crucial to maintain customer trust. So challenges arise in protecting customer information from unauthorized access, from data breaches and cyber attacks. So candidates, therefore, safeguarding customer data through encryption, secure authentication methods, and cyber security measures becomes essential. Data privacy and security is a security challenge encountered in digital marketing of e-commerce. The second challenge is fraud and identity theft. Fraud and identity theft. Fraud and identity theft. Now, the digital marketing landscape provides opportunities for fraudulent activities and identity theft. Attackers may engage in activities such as phishing, credit card fraud, or even account takeovers to exploit customer information, and therefore ensuring security payment gateways, implementing strong authentication measures, and educating customers about potential risks can help address such challenges. Fraud and identity theft. So these are 2 security challenges encountered in digital marketing of e-commerce. These are how many marks? These are 2 marks each. Part A of the question, 3 marks. 1, 2, 3. 2, 2. So here 3 marks. 4 marks. That is part A. Part B reads, most companies have embraced the use of cloud technology though they are facing challenges in its use. I repeat, most companies have embraced the use of cloud technology though they are facing challenges in its use. Explain 3 such challenges. Challenges in using cloud technology. All right? Challenges in using cloud technology. Now, candidates, cloud technology, often referred to as cloud computing, is a model of delivering computing resources and services over the internet. Candidates were to highlight challenges in using cloud computing or cloud technology. The first challenge is data security and privacy. Data security and privacy. Companies using cloud technology face concerns regarding the security and privacy of their data.
and storing sensitive information on remote servers managed by cloud service providers introduces risks such as unauthorized access, data breaches, or compliance violations. So organizations need to implement security measures to establish clear data privacy policies, and also select reputable cloud providers to address such challenges. So data security and privacy is a challenge that one can face in using cloud technology. Reliability and downtime is another challenge. Reliability and downtime. Now, reliance on cloud technology means that companies are dependent on the availability and reliability of cloud infrastructure and services. And network outages, system failures, or even service disruptions can impact business operations and productivity. And therefore, it is important for organizations to assess the reliability and the uptime guarantees that are provided by cloud service providers, and organizations should have contingency plans in place to mitigate potential downtime. Reliability and downtime is a challenge using cloud technology. Candidates were to give 3 challenges. The third challenge: vendor lock in and or vendor lock in is another challenge. Vendor lock in, and maybe you can discuss it with interoperability. Interoperability is another challenge. These are 2 challenges in one. Vendor lock-in. This means that moving to the cloud may result in what we call vendor lock-in. If a company is to move to, say, seeking cloud services from a cloud internet service provider, moving to such an internet service provider means a company may become heavily reliable on a specific cloud service provider. And such a client the one who moves to, say, cloud service provider A, may have challenges in transitioning to another provider, or even integrating with other systems. So that's what we are referring to as vendor lock-in. These are challenges. Vendor lock-in can result into challenges related to transitioning to another provider or integrating with other systems. There also could be interoperability issues that can arise when different cloud platforms or on-premises systems need to communicate or share data. And therefore, organizations should consider adopting open standards. Organizations should consider implementing data portability strategies and conducting thorough vendor evaluations to address vendor lock-in and interoperability challenges. So these are 3 challenges in using cloud technology: data security and privacy, reliability and downtime. These are 2 challenges in one. Then we have vendor lock-in and interoperability. 3 marks.
We've answered part B. Then part C reads, define each of the following terms as used in systems theory. These are just definitions of terms. And what are the terms? C Roman 1. The first term is functional decomposition. What is functional decomposition? Functional decomposition. Now, candidates, functional decomposition is a process in systems theory where a complex system or problem is broken down into smaller and more manageable components or functions. Decomposition, breaking down of functions. Decomposition, functional decomposition, is a process in systems theory where complex problem is broken down. It's where a complex problem is broken down into smaller and manageable function. It is where a complex problem or a problem is broken down into smaller and more manageable components or functions, and it involves analyzing the system's structure and identifying the individual functions or tasks that need to be performed to achieve the system's overall objectives. And candidates, by decomposing or breaking down the system, it becomes easier to understand, to design, and manage the various components. That's the meaning of functional decomposition. Then the second term to define is functional cohesion. Functional cohesion refers to the degree to which components or functions within a system are related or focused on a common purpose. You understand? It is the degree to which components or functions, functional cohesion means unity. It means bringing together. And therefore, a functional cohesion, I'm saying, is a degree to which the components of a system, all right, or functions within a system are related or focused on a common purpose. So the key word here is common. Related functions, where functions are related or focused on a common purpose, cohesion, unity. And candidate, it measures how closely related the tasks or functions within a system are to each other. And therefore, high functional cohesion would mean that the components within a system are closely related and perform similar or what we call complementary tasks, leading to better system performance and maintainability. That's the second term. Then we have feed forward. Number 3, feed forward. Now, feed forward is a concept in systems theory that involves providing information or inputs to a system
It involves providing inputs to a system. Feed forward. It involves providing inputs into a system. It involves providing inputs into a system in anticipation of a future event. In anticipation of a future event, which may be an outcome or an output. So feeding into a system, there could be the stage of processing the input, then coming out with an outcome or output. And it is a mechanism, candidates, through which a system can proactively adjust or adapt its behavior based on the expected degree of the changes that are expected. And therefore the feed forward allows what we call a system to be preventive or corrective. Do you understand? I'm expounding what feed forward can allow. I've said it allows a system to take preventive or even corrective actions before the actual event occurs, and therefore reducing the potential negative impact on the system's performance. Feed forward. So these are definitions of the three terms: functional decomposition, functional cohesion, and feed forward. 2 marks each. 2 marks. Proper explanation, 2 marks. Feed forward, 2 marks. 2 marks. Then lastly, we will answer part D, which reads, describe 4 features of systems approach to information systems. Features. Features of system approach to information systems. Features of systems approach to information systems. Number 1 is a systems approach has what we call holistic perspective. Holistic perspective. Holistic perspective. The systems approach considers an information system as a whole, viewing it as an integrated and interconnected set of components and processes, and it emphasizes understanding the interrelationships and interactions between different elements within the system. So that's the first feature of systems theory, of systems approach, holistic perspective. Then we have systems boundary. Systems boundary is yet another feature. Systems boundary. Now, candidates, the systems approach defines clear boundaries for the information system, distinguishing it from external environment, and it recognizes that the system interacts with its environment. It interacts with its environment, receiving inputs and generating outputs, and considers such interactions in its design and analysis of the system. 3, input stroke processes stroke output. Input stroke processes stroke output framework. Input, process, output. Input, process, output. Now, the systems approach adopts the input, process, output framework, which defines the inputs that are transformed or processed, okay, through processes in order to produce desired outputs. And it focuses on understanding the flow of information, the flow of data, and also resources within the system and how they contribute to achieving the system's objectives. So these are 3 features of systems approach to information system. 1, holistic approach. It considers an information system as a whole, viewing it as an integrated and interconnected set of components. Number 2, systems boundary. The system defines clear boundaries for the information system. This approach, the systems approach, defines clear boundaries for the information system, distinguishing it from the external environment. Number 3, input, process, output. Input, process, output, a framework. The systems approach identifies the inputs and also the processes that are required to transform these inputs into desired outcomes. So these are 3 features of systems approach. Describe 4 features. Supposed to be 4 features. Now let's identify the 4th feature, number 4. Feedback and control. Feedback and control. Now, the systems approach emphasizes the importance of feedback loops and control mechanisms within an information system. And feedback allows the system to monitor and evaluate its performance, comparing it with desired outcomes and making necessary adjustments. The control mechanism ensures that the system operates within defined parameters and objectives. So we have feedback and control as a feature of systems approach. And candidates, these are 4 characteristics. But all in all, candidates, the systems approach recognizes the complexity of interdependence, the complexity and the interdependence of components within the information system. It also considers the dynamic interactions with the environment and aims to optimize the system's performance by understanding its structure, the processes, and the feedback mechanisms. 4 features, 4 marks. 4 features, 4 marks. We've answered question number 3. Thank you for your time. We take a short break. When we come back,
we are going to answer question number 4. Bye-bye.
Welcome to Manifested Publishers.
We can be able to move on towards the right of the screen. I had initially mentioned we'd move down, but because we already have the formulas working down, we can be able to just move on towards the right here. We copy the pessimistic case, right over here, pessimistic case. Pessimistic case, and of course, because it's capitalized, so pessimistic. That. For consistency, just pick that. Format painter, you can see format painter. Also good for presentation. We copy the years 2020 to 2022, like that. Because we're talking about the forecast period for the pessimistic case is going to be different from the base case. Copy. We can, right there, Control V. So we move towards the right, and one of the skills that you should also do or know is that we can be able to just hide this part here. Question is, will we be able to use all of this? We need them over here. So what I can do first of all, guys, before I hide, is to first of all pick these values over here. I'll just copy this, cut this, paste it right over here. Control V. So it moves towards the right. Now, if you allow me, I can pick right over here, up to that point, hide. How do you hide? You can, or you can be able to even group it. You can either right click and hide. You can see hide. It will hide. But we are accountants and we are experts like that. What we are saying is that we need to just put groups. So you come to data, then you group. Just click group. It will create this kind of thing. So you just click on this and it will just hide the data like that. If you want to unhide the data, you just click the plus. You open it up like that. That's what true accountants are actually supposed to do. So let's use the grouping outline. Now we come to pessimistic case. The reason for doing that is so that I can be able to look at the question and adjust them based on the inputs that, or these assumptions which have actually been provided right over here. So in a similar fashion, we forecast these values here, and we've already done that. So I ungroup this and allow me to pick these forecast values here like that. Copy. I press it back there. Control V. That. Now let's see how it actually changes the pessimistic case. We start all over again. I can put a white background home so that we can highlight as we make the changes. No fill, like that. Now we are doing the pessimistic case, guys, so please pay attention. Revenue growth rates are forecast under 3 scenarios, namely base case, optimistic case, and pessimistic case. The base case growth rate is the first year forecast in year 2022 CAGR. This is expected to reduce by 2% annually until the last year of the forecast, subject to a minimum of 15%. The optimistic case is 20% above the base case, while the pessimistic case is 10% below the base case in all forecast periods. So 10%. So what are you saying? 2022 CAGR over here. You can see in section, I can come down over here, 2022. The CAGR is down over here. You can see it right here. So we are saying what? We are saying that we are going to increase our revenue by, for the pessimistic case, is going to be 10% below the base case. So we are saying that even if the CAGR is increasing by 21%, the pessimistic case is going to be below by 10%. So we can come and say, right over here, the revenues, like in the pessimistic case, so you can click right over here, you can see is 115. So we're increasing this from the previous value, this one multiplied by 1 plus the growth rate which was there in M21A over there. And then once we have that, it's going to reduce by, it's going to be reduced, yes, by 2%, but it's going to be 10%. So pessimistic case, what we can do, we can just pick plus this value times, open the brackets, so 10%, 1 minus 10%, close the brackets like that, and you enter. We are accountants, analysts, we need to highlight that, put a bracket for consistency. Then we are saying that that is for pessimistic case because it's 10% below. And if that's the case for 2023, like that, then you are saying it's going to reduce by 2%, like that. So even if we were to decide to go this other direction, guys, like that, if you're able to go like this, plus that value times, we go to question 21A, this one times 1 minus, we're saying 10%, 10%, it gives us 18, but perhaps the formula should be delete that. No, it's not giving us that value, correct value, so pardon me for that. Let me just undo that. We are saying that it should be able to go down by 20, so 21%, it should reduce by 10%. And tab 21B, you can see here, and we feed in the formula plus that sales, we multiply into brackets 1 plus this pessimistic rate over here, like that. Then we close the brackets like that and you press enter. So you can see it comes to 113. Because it is like the worst case scenario, we are saying compare that value or this 113 value over here, which I can put in a different color like that, with the one under the base case. Under the base case, you can see is 115 over here. So you put the same color like that. So you can see this is 115 base case, and this we're saying is pessimistic case or the worst case. It comes down like that. So I just undo like that, and then I proceed on. So once we have that, we come back now to what the question was actually saying. So the revenue growth rates, so the pessimistic case, optimistic case is 20% above the base case, while the pessimistic case is 10% below the base case in all forecast periods there. So we then reduce, this is expected to reduce by 2% annually until the last year of forecast subject to a minimum of 15%. So that is the limiting factor. That is the limiting factor over here. So plus this one times, open the brackets, and we need the rates over here first of all, sorry. So we come back to 21A over here, 19. So we pick pessimistic case plus that value minus 2%, we get 16.87, but now we are saying we want it to be consistent like that. We want to reduce the percentages to be only with no decimal places, so it's 17%. Then plus that one times, we're reducing it by by 2%. Remember what we did over here, minus 2%. So plus that one minus 2%. Like that. We're saying we're getting 14.87. So because 14.87 is less than 15%, so we're saying the constraint is 15%. So this is 2023, 2024, 2025 should be 15%. So we're saying that now this is our 2023 value, 2024, 2025, and right over there. But 2025 should be 15%. Remember from the question, let me come to tab 21B right here. The question was saying subject to a minimum. You can see it over here. Subject to a minimum right over here of 15%. Subject to a minimum of 15%. So what does this mean? We're saying that we can come over to this other side over here as we try and populate this part. So we're saying it's plus that value times, shift, open the brackets, 1 plus for 2024. So we come back to 2024, we're saying it's 17%. That, we close the bracket, enter. Then these others will be 15%, 15%, 15% over here. So plus that value times, open the brackets, 1 plus 15%. 15%. That is the maximum, or the minimum. We cannot go beyond that, beyond that value. We do the same, plus that one times, open the brackets, 1 plus 15%. We close the bracket, enter that. Then we can be able just to, even if we drag that, it would be able to pick like that. It's that value like that. So I was just doing it slowly so that we can be able to just see the values there. The cost of sales, we've been given the gross profit margin. What have we been told in the gross profit margin in the question? Right here you can see the gross profit margin. Let me just put it in beige, somewhat color like that. The gross profit margin for the first year forecast is the 3-year average for the period 2020 to 2022. So this is expected to reduce by 2% annually until the last year of forecast, subject to a minimum of 50%. So what is the gross profit margin? So I can come over here, move towards the right, and we reduce this base case scenario here. How did we do the gross profit margin? The gross profit margin is gross profit over sales. So the gross profit over sales, this one we've already done it like that based on 2020 values. So you can see, even if you're to pick this value over here, or we pick, let's say 2020, you can just decide to pick it over here, plus gross profit, which is over here, gross profit divided by sales, like that. It's 0.5. So for consistency's sake, we do the same right over here, 50%. And it applies all through until 2022. So we are saying that as far as gross profit margin is concerned, we are expected to apply these same rates that we have right above over here. So I can comfortably delete this one over here like that. I delete and say that now for me to be able to get the gross profit, I'll just get, you can see the gross profit right over here. You just multiply gross profit margin times the sales. So gross profit, so get plus gross profit margin 57% multiplied by the sales. There, get it like that, 64. So I drag the formula like that and it picks. So for us to get the cost of sales, we just get plus 113, but because it is minus, we open the brackets, you can see on the formula bar right over here, we just delete that, say is equals to minus that value minus that value there. We close the bracket, say enter. And we drag this towards, pardon me, undo. So plus or is equals to minus, open the brackets, 113 minus 64, close the brackets, enter 4, then we drag the formula until we get the plus sign like that. We drag the formula like that, then we put it in terms of the format, just put it like that. So we can try and check, plus that plus the cost of sales, we're getting 64,381 to 2.29. So we can just, put it like that, and you can see we've gotten the correct answers like that. So we delete operating expenses. We go back to the question, right down here, highlight in peach. Operating expense ratio are modeled as the 3-year averages from period 2020 to 2022. These are assumed to remain constant over the forecast period. So what are we saying? We are saying that the expense ratio will also apply across. You can see the expense ratio just down here. So we pick, for us to be able to compute the operating expenses, because we've already done that in first part here. The operating expenses is just the sales times the expense ratio. So for us to get this, it is just plus the sales times the expense ratio. The expense ratio is right over here. Enter. But remember, it is negative. So we put a minus there and we open the brackets like that. Picks negative. And we just drag it, formula, like that, and it picks. Do the same thing as we've done above, format, that it picks the same format. How about operating profit? Let's see what the question is saying about operating profit. There's nothing about operating profit. It's a formula. So it's only operating expenses was there. So plus, it should be the same, plus that, you should get 42. Drag it like that. Let's see what they say about depreciation. Yes, there's something on depreciation. It's right there. Depreciation to revenue ratio is assumed to remain constant as the 3-year average for period 2020 to 2022. So we apply the same formula we've done just over here. You can see it right here. For us to be able to get the depreciation value, sales times depreciation ratio. So we come back towards the right over here, pick like that, time plus sales times depreciation ratio for 2023. Is that correct? Yes. Enter. And that's it. We drag it. That. It picks. But you can see clearly it's not the same format as this other one. So we do the same thing. Minus, open the brackets, close the brackets, enter. And then now we can redrag it again. Just drag it like that. It picks the negative sign, format, just do it like that, and that's it. Then we can just say profit before tax plus that plus that. That. And of course, because this also requires the formula, you can see it will not change anything. But the format will change. So let's just undo that. We ensure that the format is the same as the previous income statement. So we just copy it like that, and that's it. What are they saying about finance costs? The finance costs down here, the finance costs are expected to reduce steadily as the loans are repaid. Use the reduction rate 2022 over the forecast. So you can see here reduction rate is 1,000 based on the base case. Like that. Let's see how much it's reducing by in this case over here. It's reducing by still 1,000, 1,000, 1,000 like that. So how do we feel it? We just say plus this one plus that, so that we can be able to get 7,000. And we just apply it across. Format painter, do the same there. Profit before tax plus that plus this value. And we drag like that. How about the income tax expense? Let's move over to the right, to the left rather. Finance cost we've just done. Let's go to income tax. Is calculated as the historical effective tax rate. Put it as pitch, because we are saying it's just going to be plus that value times the 30% 2023 value there. That's it. Because it's negative, do the same thing. Negative, open the brackets, put it in brackets, like so. So you come over there and just drag it like that. Yeah. We drag the formula as we move across like that, and then we get the final profit after tax. Plus that, enter. That's the final value that we have. So you can compare. You can see in the year 2027 forecast, we are getting 40,000 as the profit after tax. In the this whole part like that. And that's what we've done. That. So once we have that, we can then just move ahead to the base, to the optimistic case.
Welcome to Manifested Publishers.
Hello and welcome to the revision of the ICT paper that was done in December 2022 by certified public accountants and certified secretaries. Question 1 reads, A. State 4 disadvantages of implementing information systems in an organization. Disadvantages of implementing information systems in an organization. The first disadvantage is cost. All right? The cost for hardware, software, infrastructure, training, and so on. The second disadvantage is resistance to change. Employees may resist such changes. Number 3 is security risks. 4, technical issues. So those are 4 disadvantages we are going to discuss in answering the first question. State 4 disadvantages of implementing information systems in an organization. This is question 1. Question 1. Disadvantages of implementing information systems in organizations. Number 1, cost. Cost. Implementing information systems can be expensive, involving costs for software, hardware, infrastructure, training, and maintenance. So organizations may need to allocate significant financial resources to acquire and maintain the necessary technology, which can be a strain on the organization, a strain on the budget of an organization. 2, resistance to change. Resistance to change. Implementing information system often requires changes in business processes and workflows. So employees may resist
such changes, fearing job loss or even increased workloads. So resistance to change can slow down the implementation process and may even hinder the adoption and utilization of the new information system. Security risks. Information systems candidates stores and process sensitive data, making them vulnerable to security breaches such as hacking, data theft, and unauthorized access. And organizations need to invest in robust security measures as well as protocols to protect their systems and data from potential threats. 4. Technical issues. Technical issues. Information systems can encounter technical challenges such as hardware and software failures, compatibility issues, system crashes, or even network disruptions. And these issues can result in downtime, reduced productivity, and frustration among users. So organizations may need to have proper technical support and contingency plans to address such issues effectively. So these are 4 challenges of implementing information system. 1, cost. 2, resistance to change. 3, security risks. 4, technical issues. 4 marks. That is part 1. Part 2 reads, explain 5 computer hardware components that are required when establishing a multimedia platform for e-commerce. Computer hardware components required when establishing a multimedia platform for e-commerce. The first hardware component is the central processing unit. The CPU. The CPU is the brain of the computer system and handles the processing of data. It performs calculations, executes instructions, it manages the overall operation of the system, and so on. So a powerful CPU is essential for handling multimedia tasks effectively and efficiently. Graphics processing unit. Graphics processing unit. One may also need the graphics processing unit, which is responsible for rendering and processing graphic intensive tasks such as high resolution images, videos, animations, and so on. It accelerates the processing of visual data, ensuring a smooth playback and also display of multimedia content. So when installing multimedia platform and establishing a multimedia platform, is important to have the graphics processing unit. 3, random access memory. Random access memory, the RAM. RAM is a temporary storage that holds data and instructions that the CPU needs for immediate processing. And for the multimedia platforms or applications, a sufficient amount of RAM is required to handle the large data sets and facilitate smooth multitasking and multimedia processing. Random access memory. 4. Hard drive disk. Hard drive disk. HDD. Right? Or what may be required, if not a HDD, is what we call solid state drive. The solid state drive, the SSD, the solid state drive. Now, candidate storage drives are essential for storing multimedia files such as images, videos, audio files, and other e-commerce content. So HDDs provide larger storage capacities at a lower cost, while SSDs offer faster data access and improved system performance. So when establishing a multimedia platform for e-commerce, a hard disk drive or a solid state drive may be essential. 5, computer. These are 4. Then number 5, sound card and speakers. Sound card and speakers. For multimedia platforms, a sound card is necessary to provide high quality audio output, and combined with speakers or even headphones, it enables users to experience audio content that is associated with e-commerce, such as product demos, testimonials, background music, and so on. So candidates, these are the components, and these components work together to support multimedia content creation, storage, processing, and presentation in an e-commerce environment. Number 1, central processing unit. Then we have the GPU, graphics processing unit, the random access memory, the hard drive disk, the solid state disk, and sound card and speakers. These are 5 components, 5 marks. Part C reads, using an example, explain how one would use a goal-seek function in a business. How one would use goal-seek function. How one would use goal-seek function. Using an example, explain how one would use a goal-seek function. Now, first of all, what is this goal-seek function? What is a goal-seek function? Now, a goal-seek function is a tool. It is a tool that is available in spreadsheet software such as Microsoft Excel that allows users to find the input value needed to achieve a desired result. And it is particularly useful in business scenarios where users want to determine the required input value to reach a specific goal or target. That's why it is being referred to as goal-seek. Goal-seek. For example, let's consider a business that wants to determine the number of units it needs to sell in order to reach a desired profit level. And we know businesses have fixed costs, variable costs per unit, and even the target profit amount, So by using the goal-seek function, the user can input the target profit as the desired result and then instruct the software to find the corresponding number of units that are needed to be sold in order to get the profit target. So that is an example of, the question says, using an example, explain how one would use goal-seek function in a business. And that is how one would use goal-seek function. I've given you an example of where a business would want to achieve a certain profit, but it does not know the number of units to produce. So that goal-seek function that is found in Excel, in spreadsheet software like Microsoft Excel, can be used to find the input value needed to achieve a desired result. So it is a tool that is found in spreadsheet software. It is a tool found in spreadsheet software like Microsoft Excel. It is a tool that is found in spreadsheet software, or a tool that is available in spreadsheet software like the Microsoft Excel, that allows users to find the input value, that allows users to find the input value. I've given an example where an organization would want to achieve a certain target profit, and the profit candidates is an output. There are things that you do before you hit a certain target profit, say 10 million. If an organization has a target of, say, 10 million, then the company has to work towards achieving that target. The company has to sell certain amounts of units. A business may want to determine the number of units that may be needed to, say, earn a profit of Kenya shillings 10 million. How many units can be sold for company A to hit a target of profit of 10 million, target profit of 10 million? So a goal-seek function that is available in spreadsheet software like Microsoft Excel can be used by the user to find the target input, to find the input, you understand, that will help the company achieve the target profit. And we know a business may have fixed costs, variable costs per unit, and so on. Because we know profit is a function of fixed costs, variable costs, and sales. Do you understand? So by using the goal-seek function, the user can input the target profit as the desired result and then instruct the software to to find the corresponding number of units that needs to be sold. Number of units that need to be sold. The number of units that needs to be sold with the fixed cost that a company incurs, the variable cost per unit, with these inputs, then the desired profit can be attained. But the starting point is the target profit. The software can help the user to determine the number of units to be sold in order to achieve the profit of 10 million. So that is how one would use a goal-seek function. The question is, using an example which I have given here, explain how one would use a goal-seek function in a business. So explaining what I've explained would earn you the 5 marks. I repeat, part D, explain 3 problems that could be encountered when using a computerized accounting software. Problems that could be encountered when using a computerized accounting software. The first problem is technical issues. The second problem is data integrity and security. Then the third one is learning curve and training. Learning curve and training. Technical issues. Technical issues. Computerized accounting software relies on technology infrastructure, and technical problems can arise, such as software glitches, such as e.g. software glitches. We may have crashes, system crashes. The system may crash. There could also be compatibility issues. So these are some of the technical issues that one may encounter when using a computerized accounting software. We are talking of compatibility. This is compatibility, issues to do with compatibility with other systems or other software, or even troubleshooting. Problems with troubleshooting to resolve issues. So that's the first problem that one can encounter when using a computerized accounting software. Data integrity, number 2. Data integrity and security. Data integrity and security. Computerized accounting software manages what we call sensitive financial data. So we are talking about accounting. Accounting has to do with finances or financials. So a computerized accounting system manages sensitive financial data, and maintaining data integrity and security is crucial. And problems can occur if there are no data entry errors. Right? If there are data entry errors, then problems can occur. If we have data corruption, then problems could also occur, or even problems to do with unauthorized access to the system. And therefore, adequate data backup, adequate access controls, and security measures should be implemented to mitigate such risks: data integrity and security. 3, learning curve and training. Learning curve and training. Candidates, transitioning to computerized accounting software may require employees to acquire new skills and to adapt to new processes. And some users may encounter challenges in learning the software functionalities, or even struggle with understanding complex accounting concepts in a digital environment. So adequate training and support are essential to ensure effective use of the software and minimize user errors. So candidates, these are some of the problems. They are not the only problems. There are many problems, but all in all, it is important for organizations to be aware of these potential problems and take appropriate measures such as regular software updates, data backup procedures, training programs, in order to address and mitigate any issues that may arise when using computerized accounting software. So these are 3 problems, 6 marks, 2 marks, 2 marks, 2 marks total, 6 marks, 6 marks. So thank you for attending the lesson. We've answered question 1, December 2022. In our next session, we are going to answer question number 2. Bye-bye. Greetings and welcome back to the lesson. We are going to answer question 4, December 2022. The subject is meetings, compliance, and administration. Question 4A reads, explain 2 circumstances that may lead to members present at a general meeting to elect one of themselves to preside at the meeting. Question 4A. 2 circumstances. Two circumstances that may lead to members present at a general meeting to elect one of themselves to preside over the meeting. To preside over the meeting. The first circumstance is absence of the chairperson. In the absence of, where the chairperson is not present, then obviously the members can elect one of themselves to preside over the meeting. If the chairperson of the meeting is absent or unable to preside over the meeting, he may be present or she may be present but maybe not feeling well. So in such a case, the members may elect one of themselves to act as a temporary chairperson, and that ensures that the meeting can proceed and decisions can be made in the absence of the designated chairperson. 2, conflict of interest. Conflict of interest. In situations where the chairperson has a conflict of interest in a particular agenda or matter being discussed, then it may be deemed appropriate for the members to elect someone else to preside over that specific agenda item to ensure impartiality and fairness in decision-making process. So these are two circumstances that may lead to members present at a general meeting to elect one of themselves to preside over the meeting. One is in the absence of the chairperson, or if the chairperson is present but unable to preside over the meeting. Number two, if there is any conflict of interest between the chairperson and any of the agenda items being discussed at the general meeting. Two circumstances, 4 marks. Part B, you have been engaged as a company secretary for provision of consultancy services to a members association where delegates represent members in the annual general meeting of the association. Describe 4 provisions you would include in the constitution of the association to ensure that the members are protected from the arbitrary powers of the board of directors. 8 marks. Provisions that you would include in the constitution of the association to ensure members are protected from arbitrary powers of the board of directors. We read that you have been engaged as a company secretary for the provision of consultancy services to a members association where delegates represent members in the annual general meeting of the association. So, what are the provisions that would include in the constitution of the association to ensure that members are protected from arbitrary powers of the board of directors? Clear roles and responsibilities. That is one provision. There ought to be clear roles and responsibilities. Define the roles and responsibilities of the board of directors and clearly outline their limitations and accountability to the members. And that ensures that the board operates within its mandate and does not exceed its authority or power. Clear roles and responsibilities. You can also have provision on term limits. Term what? Limits. There could also be rotation. Term limit and rotation. Introduce term limits for directors to prevent concentration of power and promote regular rotation of board members. Why? Because that prevents the board from becoming entrenched. It also allows for fresh perspectives and diversity in governance. 3, member representation. Member representation. Include provisions for adequate representation of members on the board. And that can be achieved through the election of members as directors or the establishment of what we call members' council that provides oversight and input into the board's decisions. Member representation. 4, transparency and accountability. Transparency and accountability. Establish mechanisms for transparency and accountability, such as regular reporting to members, financial audits, as well as disclosure of conflicts of interest. Why? Because that ensures that members have access to relevant information and can hold the board accountable for their actions. So those are some of the ways or provisions that you would include in the constitution of the association to ensure members are protected from arbitrary powers of the board of directors. 1, clear roles and responsibilities. 2, term limits and rotation. 3, member representation. 4, transparency and accountability. This would earn 8 marks. And the last part of this question says, appraise 8 steps necessary to develop a strong compliance strategy in an organization. 8 steps to develop strong compliance strategy. 8 steps to develop a strong compliance strategy. Now, the first step in developing a compliance strategy is to identify applicable laws and regulations. Identify applicable laws and regulations, because we are talking of compliance. This is a strategy to ensure that the organization complies with the laws and regulations. So in developing a compliance strategy, it's important first of all to identify what are these laws, what are the regulations that the company is expected to obey. So first of all, identify and understand the specific laws, regulations, industry standards that apply to the organization's operations. Why? Because that forms the basis of the compliance strategy. It forms the foundation of the compliance strategy. Then you can carry out number 2, risk assessment. Assess the risks. Conduct a comprehensive risk assessment, and the purpose for doing that is to identify potential compliance risks and prioritize them based on the potential impact. Why? Because that helps in focusing resources and efforts on areas of highest risks. These are compliance risks. Do you understand? Then 3, develop policies and procedures. Develop policies and procedures. Develop robust policies and procedures that clearly define expected behaviors, that clearly define expected guidelines, and also controls to mitigate compliance risks. Such policies should align with legal requirements and industry best practices. That is step number 3. 4, training and awareness. Training and awareness. Implement a training program to ensure that employees are aware of their compliance obligations and that they understand the organization's policies and procedures that have been developed in step number 3 and the general procedures of the company. And training should be ongoing. It should not be a one-off event. Training should be ongoing to keep employees updated on regulatory changes. 5, internal controls. Internal controls. Establish strong internal controls. Establish monitoring systems in order to detect and prevent compliance breaches. And that includes regular audits, that may include internal reviews, and also implementation of checks and balances. Internal controls. Then 6, reporting mechanisms. Reporting mechanisms. Implement effective reporting mechanisms such as anonymous hotlines, whistleblower channels that will encourage employees to report potential compliance violations or even concerns without fear of retaliation. 7, compliance testing and monitoring. Compliance testing and monitoring. Regularly, the organization should monitor and test, test and monitor and test compliance controls to ensure their effectiveness. And that may involve internal audits, that may involve self-assessments, that may involve independent reviews in order to identify areas for improvement and address any compliance gaps. Improvement. Continuous improvement. Foster a culture of continuous improvement by regularly reviewing and updating the compliance strategy. Regularly review. Look at the various stages. Review if it's developing policies, come up with better policies. If it is changing the training programs, depending on the changes in the environment, review the training programs, initiate new internal controls. Reporting mechanisms, come up with better ways of reporting, timely reporting. So review the strategy, compliance strategy, continuous improvement. All right? Why? In order to adapt to changing regulations, in order to adapt to emerging risks. And that may include staying informed about new developments in compliance landscape. It may include incorporating best practices. So candidates, by following these steps, organizations can develop a strong compliance strategy that mitigates risks, ensures legal and ethical conduct, and protects the organization's reputation. These are 8 steps. 1, identify applicable laws and regulations. 2, carry out risk assessment. 3, develop policies and procedures. 4, train employees and create awareness. 5, initiate, establish internal controls. Put in place proper reporting mechanisms. Test and monitor compliance. Then there ought to be continuous improvement. 8 steps, 8 marks. 8 steps, 8 marks. We've answered question 4 in our today's lesson. In our next lesson, we are going to answer question number 5. Bye-bye.
Publishers.
So once we have that, we can then just move ahead to the base, to the optimistic case. We just, first of all, before we group, we just copy this part, again, copy, and we can skip this part towards the right there, Control V. Even if you are to just delete this part over here now, delete it, that, Or we can just undo and undo. And we select this part and just say cut instead of copy. Cut. There. And then we paste it right here. Control V. So that now we don't get disturbed by the space. And we copy this part up to 2022. Like that again. Copy. Sorry, I said cut. This should be copy. And we put it right above, right here. Control V. And this case is what? Optimistic case. Optimistic case. In a similar font, just put that right there. And here we can just be able to group it right over here. So we group. Where do we group? We come to data. We come to group. You can see group here. We press the above one. Group, that thing comes. This kind of grouping comes. In terms of the outline, let's group it there. So we have even this one for the base case. Let's group it. We want our forecast to be from 2023 to 2027. So you can see I click this one, copy 2023 to 2027 like that, copy, and then we reduce the grouping right over there and compress Control V. It comes. Now let's look at systematically, step by step, what changes we have to make. So we again go through this, clear the font, no fill, we make adjustments. Revenue growth rates are the forecast under the three scenarios, namely base case, optimistic case, and pessimistic case. The base case growth rate for the first year and forecast is 2022 CAGR. This is expected to reduce by 2% annually until the last year of the forecast, subject to a minimum of 15%. Optimistic case is 20% above the base case. So we can come right over here to 21A down here. And we are saying it is 20% above. Here is a pessimistic case. We said it was 10% below. So you can come over here, optimistic, here, and say that it is plus this one, plus this one times, open the brackets, 1 plus, not minus, 1 plus 20%. It's above. So 20%. So for purposes of consistency, like that, 25%. So if you increase 21% by 20%, it comes to 25%. So what are we told? We come back to tab B. 20% above the base case. So the base case was 21%, yes. So we are saying that it is expected to reduce like that. And we can say that now, come back over here, plus 22 like that, times, open the brackets, 1 plus, we come to this value here. That value, close the brackets, enter, 119. So for font, keep the font the same. Once you have 119, it's expected to reduce by what percentage? By 2%. So plus this one minus 2%, 23%. Then plus this one minus 2%, that 21%, and so on and so forth. as we move along, move along up to there. So what are we saying? This is 2023, and we can be able to increase like that until 2027. So fill series. So this will be the rates for the years over here. This is the years, bold that. These are going to be the rates right here. So we've picked 25% for 2023. Now we need to pick 23% for 2024. So we pick plus that value times, open the brackets, 1 plus what? The one for 2024. We come back to tab A. 2024 you can see is that one there. Close the brackets, enter, like that, and you do the same, plus that value times shift, open the brackets, 1 plus what? We are picking 2025. We come to tab, this next tab over here. 2025 you can see is 21%, and close the brackets, enter, like that, and then plus that value over there times, open the brackets, 1 plus what? We're picking 2026. So we come back over here, 2026, and right over here is 19%. Like that. You close the brackets, and then you press enter. And then we are saying we press plus that value times, open the brackets, 1 plus what? We're picking 2027. Come back over here, 2027 is 17%. It's not reached the threshold of 15%. Like that, we close the brackets, and we press enter like that, and that gives us the revenue under the optimistic case. How about cost of sales? We already have the gross profit margin. So you can be able to compute the gross profits very easily like that. So we just come over here, highlight like that, the same format, painter there. We're saying it's just going to be given as the sales times gross profit margin. So plus that times the gross profit margin for 2023, that over there, gross profit margin is that. Once we have that, we just drag the formula moving to the right there. And then for us, it's going to be is equals to minus, so we open the brackets right over here, that one minus that value, and we close the bracket like that, so you can be able to get it consistently as a negative value there. So for format painter, you move across like that, and then you can now drag the formula moving towards the right. So to just check, so plus that gives us, so you can see this answer is the same as that one there, and even if you are to drag it moving towards the right, of course you can see that one is the same as that. Of course the decimal places over here come into play, but don't worry about that. It's actually the same. These are actually the same values there. So delete that for now. How about the operating expenses? We have the operating ratio. They are given to us there. We've been told, so revenue is done, put pitch there. Gross profit margin is done. We've done that. Operating expenses are modeled 3-year averages for the period 2020 to 2022. These are assumed to remain constant of the focus period. So we just pick the expense ratio. To get the operating expenses is just the sales times expense ratio from 2023. Sales times expense ratio. So plus, so is equals to minus, because it's a formula like that, times the expense ratio, because it's operating expenses, expense ratio 2023, ndio hiyo iko hapo, like that, close the bracket, enter. Move up, so negative value, formatting, come to format painter, like that. Of course in the exam you don't need to just really bother yourself with the format, but I'm just doing it because of to ensure that we have consistent results there, and consistency in terms of presentation. That's it. We just drag the formula like that. How about operating profit? Plus that should give us like that. So I said plus that value plus that value should give us 44 there. Just drag it like that. It gives us the same, gives us consistent answers. Format painter. Depreciation. We've been told that depreciation, we finished operating expenses, we've been told depreciation down over here to revenue ratio is assumed to remain constant over the 3-year average for the period 2020 to 2022. So it should remain here 0.9%. So it's just going to be the sales times depreciation ratio. So it's just going to be plus sales times depreciation ratio. 2023, there. Enter. Once we have that, we drag the formula towards the right, and we can be able to ensure consistency. So minus, then we open the brackets, close the bracket like that. Enter. But now here it should be negative. Oops, like that. How about the profit before tax, before interest and tax? Plus that, get the answer straightforward, move towards the right. Format painter, there. Finance costs, ladies and gentlemen. We are saying finance costs, we've already done depreciation right over there. Come to finance costs. They are expected to reduce steadily as the loans are repaid. Use the reduction rate in 2022 over the forecast period there. So in a similar fashion, plus that one minus, this is the depreciation rate, reduction rate. So 2023 there. Oops, it should be plus, this is 2023, that one minus that. I'm pressing minus or plus, sorry. Plus that one plus 1,000, yes, 2023, that. Yes, that's the correct value. Sorry, using this wrong formula. We drag it like that. Format painter. Profit before tax plus that, get that. We drag the formula like that towards the right, and we use format painter. Finally, or rather semi-finally, second to final, income tax expense. We've been told the income tax expense and the finance cost we've done. Income tax expense, calculate the historical average effective tax rate. Highlight that to show that you've done it, and it's just going to be plus that times this value here, like that. But because it's a negative, so you put negative minus. Open the brackets, close the bracket, enter. So we drag there. Finally, we have the profit before tax plus that, should be able to have those values like given to you there. So format painter, you can see the values right there. So 2023, I need to ensure that there's consistency in terms of the presentation of the outlook over there. You can be able to see that we have concluded the optimistic case. So we have answered part B of the question. Prepare 5-year forecast statements for profit and loss for Sepetuka Limited from 2023 to year 2027. So just to recap what we've discussed, we were told to prepare a base case income statement, a pessimistic case income statement. You can compare, the 42 represents the base case, and the 40,000 represents the worst case or the pessimistic case, and towards the right over here you can see the optimistic case is 50, slightly higher as compared to the previous two there. So this answers part B. Hope you have enjoyed the lesson. Thank you for being with us, and God bless you.
Welcome to Manifested Publishers.
Welcome to Manifested Publishers. We pick it on question 2. We read the question. We say that with an aid of a well-labeled diagram, explain the concept of production possibility frontier. That is PPF. We put it on the board. We say with that's 2A, with the aid of well-labeled diagram, explain the concept of production possibility frontier. Production possibility frontier. With the aid of a well-labeled diagram, explain the concept of production possibility frontier. That is PPF. That is PPF. With the aid of a well-labeled diagram, explain the concept of production possibility frontier. The first thing that we need to understand is that what is a PPF? A PPF, we need to understand, is a locus or point joining together different combination of two goods that can be produce an economy when resources are fully and efficiently utilized. So we have the diagram. On this other end, we can call it consumer goods. We can have down here producer goods. So we have our PPF. So there's a point along the PPF curve. We can call it P. We have Q. We have R. We have S. And then finally we have T at this. Then we have points that are inside the PPF curve. And then we have points that are basically outside the PPF curve. So very important is to understand that this is the PPF curve. This is the PPF curve. And to the core, we need to understand what basically happens at each and every point of the PPF curve. The first point is the point on the PPF curve. So we say that P, Q, R, S, and T, we say represents, those ones basically represents attainable with the country, with the country's level of resources, with the country's level of resources, with the country levels of resources and technology, assuming that the resources have been basically have been fully employed. That is attainable. So we can look at a point that is point N, that is into bracket outside. We call it outside the PPF curve point. That is outside the PPF curve. A point that is outside the PPF curve. A point that is N outside cannot be attained. That one cannot be attained with the given, we say with the given level of resources, and technology. So that point that is outside the PPF curve, that is N is unattainable. Then we have point M, that is inside. We call it inside the PPF curve. That is a point that is basically inside the PPF curve. So represent, this is basically represent, we say represents unemployment. Unemployment represents unemployment. That point basically inside represent unemployment or inefficient or inefficient use of resources or inefficient use of resources. Just to emphasize what we have done, we say that number one, that the PPF curve is a locus of point joining together two different combinations of goods that can be produced by a farm when resources are fully and efficiently utilized. So we have the points that are on PPF curve. Those points are attainable with the country levels of resources and technology, assuming that resources are being fully employed and no wastage. We need to and no wastage. Assuming that resources have been fully employed and there's no wastage. The second one is the M. That is the point that is outside the PPF curve. We said cannot be attained with a given level of resource and technology. Then we know that the point that is inside the PPF curve, that basically represents unemployment or efficient use of the resources, inefficient use of resources. Some of the areas that as learners need to maybe be emphasized on is uses of the PPF curve. You know, as you look at that question, one of the things that needs to come into your mind is what are the uses of PPF curve? What are the uses of where do we apply the PPF curve? That is a good area that learners need to actually emphasize on, and that is how we tackle that question. That is question 2, Roman A. Question 2, Roman B. Argue 3 cases in favor of foreign direct investment, that is FDI, in least developed countries. We put it down. We say B, that is 2B. Argue 3 cases. 3 cases in favor of foreign direct investment, into bracket FDI, in least developed countries. On that particular question, one of the first things that needs to be understood is what is the FDI? That is a direct investment by a host country in the productive asset of a foreign country. So in this case, for example, you have countries investing in productive assets in the least developing countries. So what are arguments in favor? When you talk about arguments in favor, we are basically talking about advantages of the FDI in the least developing countries. One of the first advantage that we know that fill the gap in resources, fill the resource gap in least developed countries. Number one, fill the gap, fill the resource gap in the least developed countries. Fill the resource gap in the least developed countries. The second advantage or in favor of FDI, we basically talk about promote creation of employment, promote creation, what we call creation of employment, promote creation of employment in the, we say, in the least developed countries. In the least developed countries. Number 3, we can talk about promote investment, what we call promote investment in the least developed countries. We say number 4, we can talk about promote transfer, promote transfer of technology, transfer of the technology through skill transfer, through the skills transfer, through the skills transfer. So promote what we call technology through the transfer of the skills. But apart from that very question that we've talked about, we can also look at, as learners, you can also look at areas, for example, factors that will promote FDIs in the developing countries. Again, an examiner could also ask on the next maybe exam that are to come in the future, arguments against now the disadvantages of FDI. So those are some of the areas that needs also to be assessed by learners, needs also to be looked at by the learners. That is how we tackle that question. That is question 2, Roman B. We pick it on the next question, that is question 2, Roman C. C, Roman 1, explain the term consumer equilibrium. So say we write the question, that is C, Roman 1, explain the term consumer equilibrium. Explain the term consumer equilibrium. When you talk about consumer equilibrium, we basically say that consumer equilibrium is a point where the budget line is basically tangent to the indifference curve. So consumer equilibrium is the point where the budget line is tangent to the indifference curve, where the budget line is basically tangent to the indifference curve. We say that consumer equilibrium is a point where the budget line is basically tangent to the indifference curve. Key things that we are able to establish when we are defining, or when we draw, or when we look at consumer equilibrium, because we have two commodities, that is on the y-axis could have good y, on the x-axis we could have good x. So at that very point we are able to establish equilibrium quantity of good y, and at the same time we are also able to establish the equilibrium quantity of the good x. That is how we go about that question. We pick it again on question 2, Roman C, that is C, Roman 2. Using a well-labeled diagram, using a well-labeled diagram of indifference curve, illustrate the consumer equilibrium position. Illustrate the consumer equilibrium position. So we draw that consumer equilibrium position. So we have it on this other end, consumer equilibrium position. We can have the budget line. First of all, the budget line, we call this A, and we call that B. We call that A, and we call that B. We have indifference curve 1, so that is IC1. We have indifference curve 2, that is IC2. We have indifference curve 3, that is IC3. We have indifference curve 4, that is the IC4. So where is the consumer equilibrium? It is basically established at indifference curve 2. Basically established at indifference curve 2. So this is good Y on this end. I have good X on this. So I have XE on this, then I have basically YE at that very point. So we have established equilibrium position. So we know that IC1 to IC3, IC1 to IC3, IC1 to IC4, IC1 to IC4 is the indifference curve. Then you have here is E, indifference curve. We have that as the indifference curve. We know that point E is what you call consumer equilibrium. We call it consumer equilibrium point. That is E is what you call consumer equilibrium point. And then we are also able to have YE, equilibrium quantity of Y. Then XE, that is equilibrium quantity. We call it quantity of X, equilibrium quantity of X. We know that that is equilibrium quantity of X, equilibrium quantity of X, that is for XE. Something that we also need to establish, we need to understand that AB is basically the budget line. AB is basically what called the budget line. So the explanation, we need to understand that a consumer will always want to be at higher indifference curve. If you look at that, consumer will definitely would want to be a consumer will always want to be at higher indifference, what you call the higher indifference curve, because we know that because there is higher what you call higher satisfaction. And the point that we know that E the consumer equilibrium position, and we find it at IC2. E at IC2, consumer equilibrium position, where the budget line is tangent to indifference curve 2, where the budget line is basically tangent to the indifference curve 2. So when you look at that, this particular question, one of the things that we are able to establish, is that the first part is the diagram. Though the diagram indicate what each level means, so together we've drawn the diagram, we've indicated, and we've also shown the equilibrium position that the examiner requires, and we've also explained that point and what happens to the indifference curve and why a consumer would want to be at a high indifference curve. We know that the higher the indifference curve, the higher the level of satisfaction. That is how we approach that very question. We pick it on question 2. That is Roman D. Summarize 4 types of unemployment in least developed countries. So that is D. Summarize. Summarize 4 types of unemployment in least developed countries. Least developed countries. So the first thing that we need to understand is to understand the question, what is unemployment? And the second thing is least developed countries. So whenever we talk about unemployment, is a scenario where we have people who have the qualification to work and are willing to work, but there is not employment. Least developed countries, these are countries that are not yet there in terms of at higher level of development. That is what we call least development countries. So what are these type of unemployment that are there in least developed countries? One of it we can talk about open unemployment or naked. Naked, open, stroke, naked unemployment. Naked unemployment. Naked unemployment. So whenever we talk about naked unemployment, we're basically saying that people are willing to work, but there's no work to do. People are willing to work, but basically there's no work to do. And that's we experience in least developed country. That is to say, this is a condition in which people have no work to do. This is a conditions in which people have no work to do. They are willing and able to work, but there is no work. There is no work to do. There is no work basically to do. So we proceed to what we call the second one, what we call structural unemployment. We said that on the structural unemployment, these are what we call due to structural changes. What are these structural changes? Change in demand, change in taste, and change in fashion would cause unemployment. So we have it what we call structural unemployment. Structural unemployment. We say this is due to the structural. This is due to the structural changes. Structural changes in the economy. Structural changes in the economy. Structural changes in the economy. We say, for example, changes in fashion, tastes, and demand. These are some of the factors that we find that in a least developed country would cause unemployment. That is a structural unemployment. We proceed to the next. The next we can call it, we can have what we call unproductive. What we call number 3, unproductive. We call it the unproductive unemployment. We call it the unproductive unemployment as one of the unemployment that occurs in least developing countries. So when you talk about unproductive, workers do not have necessary tools of work. As a type of employment, it occurs as a result of workers not having necessary tools to work. Occurs when workers do not have what you call necessary tools of work. Necessary tools of work. When workers do not have necessary tools of work. We can have the four. We can call it seasonal. Seasonal unemployment. Seasonal unemployment. So whenever we talk about seasonal unemployment, we are basically looking at temporary. When we talk about type of employment, we know that results from temporary. The word is temporary. Results from temporary work. Results from the temporary work. Results from the temporary work. For example, where do we get them? Construction. Where do we get them? I.e., when you talk about seasonal is common changes in season, not temporary, but that should be change in the season. Change in the season, not temporary. Temporary should be casual. This we call it due to changes in the seasons. Seasons. For example, we say tourism, where we have a peak and off-peak season, seasons, where we have peak season and then we have off-peak season. So where we know that, for example, the periods, when you talk about, for example, periods that are peak season, where we know that there's a lot of employment. Peak season and off season. Peak season, there is employment, especially the December. Peak season, there is employment, and off-peak season, off-peak seasons, there is unemployment. There is unemployment that in tourism sector. That is what we call seasonal unemployment, that we basically experience what we call off-peak season. We can have the last one. We just discussed the last one. Casual unemployment as one of unemployment. Casual unemployment as one of the type of unemployment that we basically experience. In the least developed countries. These are temporary. We call it temporary employment. Employment. For example, i.e., in the construction, we call it in the construction sector. So when you talk about constructions of road, this, remember, basically a casual employment where you have them for a particular time. They're very temporal. And after that time, the individuals that are basically engaged in such works will definitely lose their work. Lose the work. And as we conclude on that, key areas that learners need to assess. You need to look at why is unemployment a major policy issue in the least developing countries. What causes unemployment? What causes unemployment? What is the relationship between unemployment and relationship? That is the Phillips curve. That's also a very good area that learners or those that are particularly preparing for exam need to look at. And that is how we assess that very question.
Question 5. Audit supervisor's responsibilities. Question 5A. Audit supervisor's responsibilities. And these responsibilities are in relation to the audit assistant's work. Audit supervisor's responsibilities. We are answering August 2024, question 5. So question 5A, what are the audit supervisor's responsibilities? Planning and assignment of work. Planning. That is correct. Planning. Now planning, candidates, is says also monitoring. Planning we can get 2 points from planning. One is developing an audit plan. Developing an audit plan. Another responsibility in relation to planning is assigning tasks. That's the work of the audit supervisor. First of all, the audit supervisor creates a detailed audit plan outlining the scope, outlining the objectives, and even the procedures for the audit. And that plan ensures a systematic and efficient approach to the audit. The supervisor may also assign tasks. The auditor, the supervisor may assign tasks by delegating the specific task to the audit assistants based on their skills, experience, and even complexity of the tasks. Assigning tasks, and that ensures optimal utilization of resources and efficient execution of the audit. Planning. Number 2 is supervising and guidance. After assigning the tasks, after developing the plan, then the audit supervisor may be required to provide supervision, like what Aisha says here, monitoring. Could be through monitoring progress, This is on day to day. The supervisor has to monitor the progress, regularly monitor the progress of the audit assistant's work to ensure that they are adhering to the audit plan and timelines. It may also be required to provide guidance, providing guidance and support to the audit assistants as needed, answering questions, explaining complex issues, and also resolving any problems that might arise while the audit assistants are carrying out their work. Supervision and guidance can also be executed through reviewing of working papers. Reviewing of working papers. The supervisor reviews the working papers that are prepared by the audit assistants to ensure they are accurate, they are complete, and also well documented, because that then would help to identify any errors or even omissions, and then ensure the quality of the audit work. 3, quality control. Anyone with another point? Yes, Aisha says quality control and final review. Quality control and final review. Now, quality control is attained through what we call compliance with standards. The supervisor has to ensure compliance with standards. We all know, candidates, that auditing is a highly regulated profession, and the auditors are required to adhere to international standards on auditing. So when executing an audit engagement, the audit has to be executed, has to be carried out in accordance with international standards on auditing. So the supervisor ensures that the audit is conducted in accordance with the relevant auditing standards, with the relevant ethical guidelines, and that helps to maintain the integrity and the credibility of the audit process. Ensures compliance. The supervisor may also identify and address risks. Identify and address risks. The supervisor identifies, first of all, the potential risks before the risk happen, before the audit firm is affected by risk actually. The supervisor identifies the expected risks or the potential risks, then assesses the impact of such risks on the audit. The auditor assistant, while doing so, may also take appropriate steps to mitigate such risks and ensure the reliability of the audit findings. Do you understand? So we are discussing the responsibilities of the audit supervisor. For another obvious responsibility is that one of communicating and coordination. Communication and coordination. So first of all, the supervisor coordinates or communicates with the audit team. Communicates with the audit team, because he's the lead. Maintains open communication with the audit team, keeping them informed of any changes to the audit plan or any significant issues that may arise. He coordinates also with the client. It is the responsibility of the audit supervisor to coordinate with the client in order to obtain necessary information and documentation, to answer any questions and even address any concerns that the client may have. 5. Review and evaluation. The audit supervisor has a responsibility to review and to evaluate. The supervisor reviews the final audit report, then evaluates the performance of audit assistants. You understand? So the audit assistants may review the audit report that is prepared by the audit assistants to ensure it is accurate, complete, and free from errors. The supervisor also evaluates the performance of the audit assistants, providing feedback on their strengths and weaknesses, and also identify areas for improvement. That is part A of the question, 4 marks. B, in the context of audit assurance engagements, describe how attestation engagements differ from direct reporting. difference between attestation and direct reporting. Difference between attestation and direct reporting. You recall when we were going through the syllabus candidates, we defined the meaning of attestation. To attest. What is to attest? So in the context of audit assurance engagements candidates, the attestation engagements and direct reporting engagement represent different approaches to providing assurance. So, first of all, this is the first difference. The attestation engagement, the responsible party typically the management makes specific assertions about the subject matter. So the responsible party in an attestation engagement is the management. So the management makes an assertion about a specific subject matter. So the auditor's role is to evaluate such assertions against an established criteria and issues an opinion on their fairness and accuracy. And a good example is just the audit of the financial statements. The responsible party is the management. The auditor comes in to evaluate the financial statements against an established criteria. And that criteria could be the International Financial Reporting Standards. The management is required to prepare the financial statements in accordance with the International Financial Reporting Standards. The auditor comes in to attest, to confirm that the management indeed prepared the financial statements in accordance with the applicable financial reporting framework. On the other hand, direct reporting candidates, direct engagements, the auditor independently evaluates the subject matter without relying on assertions from the responsible party. So the auditor collects and analyzes relevant information to form an opinion on the subject matter itself. Do you understand? So the auditor does, in a direct engagement or reporting, the auditor does not rely on assertions that are made by another responsible party. No, the auditor goes direct to the subject matter. He evaluates the subject matter and makes an opinion directly on the subject matter. Do you understand? An example is a review of internal controls over financial reporting. The auditor may evaluate the internal controls directly and make an opinion give an opinion as whether the financial controls or internal controls are effective or not directly. That's why you get the word direct reporting engagement, direct engagement. That's one distinction. the second distinction between attestation and direct reporting candidates is in relation to the auditor's role. The auditor's primary responsibility is to express an opinion on the assertions made by a responsible party. So when answering these questions, candidates sometimes have them, if you are distinguishing things, have the distinctions in a columnar format. It becomes easy for the one who is marking. This is direct reporting, and this one is attestation. So see, another distinction could be on the basis of the role. Here, the auditor under attestation engagement expresses an opinion on the assertions. Expresses an opinion on the assertions by a responsible party. Whereas in direct reporting, the auditor's role is to directly report, reports on the subject matter. Here the auditor expresses an opinion on assertions made by a responsible party. For example, the audit of financial statements is a good example of an attestation engagement. The auditor attests, the auditor confirms if the financial statements are accurate or they portray a true or fair view based on given criteria. But under direct reporting, the auditor directly reports on the subject matter. A good example here is a review of internal controls. The auditor directly reviews the internal controls and gives his opinion directly on whether the controls are effective or not. You understand? The auditor's role is to directly report on the subject matter, providing an opinion on its accuracy, completeness, or other relevant attributes. At times, candidates, you can distinguish things even by just giving examples. Examples of attestation assertions is the audit of financial statements, review of financial statements, audit of financial statements, review of financial statements, examination of prospective financial information. These are examples of attestation engagements. Examples of direct reporting are talked about review of internal. This is a review of internal control system, reviewing the internal controls, review of internal controls. It could be assessment of compliance, assessment of compliance with regulations. The auditor may be called upon to assess whether the company is complying with the regulations and rules. So moving on to the next, candidates were to give how many in the context of auditing assurance, describe how assertion engagements differ from, and the distinctions are not given, but the marks are given, 4 marks. So how many points do you give here? You give as many points as you can, because you are not sure whether the examiner is awarding half a mark. If it's half a mark, then you need to give 4 distinctions. If it is 1 mark for each, I mean half a mark, 4 points. Okay? But you may have to give just 2. But if given that it's not clear, the mark that the points that are required, you try and give 4 distinctions. You understand? So we've said number 1, a distinction. What the first distinction is based on focus. The focus of assertions is evaluating the focus of attestation engagements is evaluating assertions made by a responsible party, whereas direct engagement, the auditor independently evaluates the subject matter. Another distinction is based on the auditor's role. In attestation engagements, the auditor expresses an opinion on the fairness and accuracy of the subject matter. Whereas direct reporting engagement, the auditor directly reports on the subject matter. Another distinction could be on the basis of evidence. The basis of the nature of evidence. An attestation engagement relies on evidence. This is 1, 2, 3. There's another one I gave but I didn't write. Relies on evidence by a responsible party. Attestation, the auditor relies on evidence provided by another party. But in direct reporting, the auditor gathers evidence independently. The auditor gathers evidence in direct reporting independently. We can also distinguish these two by level of assurance. All right? The attestation engagement, the level of assurance can range from limited to high assurance. Level of assurance, limited to high assurance. But for direct reporting, the level of assurance for direct reporting, typically provides moderate level. This one typically moderate level of assurance. Moderate level of assurance. You understand? Then part C of the question reads, artificial intelligence is often described as an evolving technology that is equipping computer systems with something akin to human intelligence. With reference to the above statement, argue 2 cases for and 2 cases against the use of artificial intelligence. Cases for artificial intelligence. Part C. Case for artificial intelligence, AI, in relation to auditing. Now, the first advantage of using AI in audit is that AI enhances efficiency and productivity. Enhances efficiency and productivity. Enhances efficiency and productivity. Isn't that obvious, candidates? That through AI, we may automate routine tasks. That is done through automation of routine tasks. Through AI, the audit practice can automate routine tasks. Automation of routine tasks. AI can automate repetitive tasks like data entry, like reconciliations, document reviews, freeing up auditors to focus on more complex and value-added activities. Now, efficiency is also enhanced through faster processing of large data sets. Faster processing of large data sets. AI can help the auditors to process large data sets. Faster processing of large data sets. AI power tools can quickly analyze large volumes of data. They can identify anomalies and trends that might be missed by manual reviews. So, enhances efficiency and productivity through automation of routine tasks and faster processing of large data sets. The second advantage of application of AI in auditing, the second advantage is that it improves accuracy and reliability. Improved accuracy and reliability. Leads to improved accuracy and reliability by reducing human error. That is achieved through reducing human error, because here the auditor relies on machines. Right? AI algorithms can minimize the risk of human error, leading to more accurate and reliable audit results. Enhanced risk assessment. Accuracy and reliability can also be achieved through enhanced risk assessment. Enhanced risk assessment. AI can identify potential risks, it can identify potential anomalies more effectively, which allows auditors to focus their efforts on high-risk areas. 3, it leads to enhanced insights. AI can lead to enhanced insights and decision making. Enhanced insights and decision making, because we are talking about data-driven insights. Insight that is driven by data. Data-driven insights, candidates. AI can uncover hidden patterns and even insights within data, which then provides auditors with a deeper understanding of the client's business and financial performance. AI also comes with the predictive analytics. Predictive analytics is a big advantage, candidates. AI can predict future trends and also potential risks, which then enables auditors to proactively identify and address issues. AI number 4, we can go on and on, candidates. Candidates were to give 2 cases for AI, but there are many advantages of AI. Many advantages of AI. AI may strengthen audit quality, strengthens audit quality. AI can strengthen the quality of audit. Strengthens the quality of audit through consistent application of standards. We know how AI can ensure consistent application of auditing standards and procedures across different engagements. It can also strengthen the audit quality through what we call real-time monitoring. AI tools can monitor financial data in real time, which enables early detection of fraud and other irregularities. So then what is a case against AI in auditing? Now, the first obvious case against the use of AI in audit practice is the issue to do with the ethical concerns. Ethical concerns and bias. We may have what we call algorithmic bias. We have algorithms that may be biased. Algorithmic bias. AI algorithms can perpetuate biases present in the data they trained on, leading to unfair or discriminatory outcomes. There are also ethical implications of using AI in audit. Ethical implications. The use of AI in auditing raises ethical questions about accountability, transparency, and the potential for misuse. Number two is cost. Cost is an obvious disadvantage, and complexity. We know AI applications can be highly complex. Implementing an AI solution can require significant upfront costs, including hardware, software, training, and so on. It may also be complex implementing or integrating AI into existing audit processes, which can be complex. It can be time consuming, so on. 3, job displacements. That's a disadvantage. Reduced need for human auditors. AI can become more sophisticated, and there could be risk that it could replace human auditors for certain tasks, which may lead to job losses. So these are reasons why AI may be a problem. That is part C of the question. Part D of the question reads, evaluate 4 differences between forensic audit and historical audit of financial statements. Now again, candidates, when distinguishing differences, it's important to have them in columnar format. Forensic and what is it? Forensic and historical audits. Try the much you can, candidates, when making distinctions of terms like these ones. You have them in columnar format. Then you can have another column here for basis of distinction. So the first basis for distinction could be the objective. What's the objective of forensic audit? What's the objective of historical audit? You may also distinguish the two based on the scope. What is the scope of financial audit? What is the scope of historical audit? Now, beginning with the objective. What is the objective? We know the primary objective of a forensic audit is to investigate specific allegations of fraud or misconduct or financial irregularities. That's the objective. It's an investigation. But the primary objective of historical audit, the primary objective is to express an opinion on the fairness and the accuracy of financial statements in accordance with established accounting standards. For example, the audit of financial statements. The objective is different from the objective of forensic audit. Then, number two, the scope. What is the scope of forensic audit? Now, the scope of forensic audit is typically narrow. This scope is narrow. The scope of a forensic audit is narrow, and it focuses on specific transaction or accounts or time periods related to the suspected fraud. So it's narrow. But the scope of historic audit is broader. Here the scope is broader. It's broad. It encompasses the entire financial statements and related disclosures. We can distinguish the two again based on methodology. The methodology taken by the forensic auditor is different from the audit of financial statements. Methodology. Forensic audit candidates, the methodology is investigative in nature. The methodology is investigative in nature, involving techniques like document analysis, interviews, and so on. But historical audit, the methodology is based on established accounting standards and procedures, including risk assessment, internal control testing, substantive procedures, and so on. The fourth basis for distinction is level of detail. The level of detail. Forensic audits, the level of detail is much higher because the investigation often requires in-depth analysis of transactions and documents to identify discrepancies and anomalies, because at the end of the day, the forensic audits may be used in a court of law as evidence. So the level of detail, its depth is deep. But for historical audit, the level of detail is generally lower, focusing on the overall financial position and position and performance. So this is deep, the depth. Okay, it is higher. But for historical audits, the level of detail is lower. Then, of course, we can distinguish these two again on the legal implications. Forensic audit, the findings of forensic audit may be used as evidence in legal proceedings, such as criminal trials or civil lawsuits. But for historical audits, the findings of historical audits are primarily used to inform decision makers and the other users, like the investors and other stakeholders. So that's it, candidates. We've done question 5, question 4 in our today's lesson. So that means effectively we've covered the August 2024 sitting. Do you have any question? We will, I'm organizing candidates. May have a mock test maybe in our next session. If I manage to have that test together, we'll do it when we meet next. If not, we continue to revise the past paper questions. We've done August 2024. We're now moving to April 2024. Bye-bye.
Hello, welcome back to this revision session. We are still on the August 2022 setting of advanced taxation. So in this session, we shall answer question 2 of the paper. Question 2A is a mathematical question. So have your calculator and other materials ready, and let's go through the question together. It says, Bell Limited, a small-scale retailer, operates 2 sales outlets, one at the head office and the other at the branch. For the year ended 31st December 2021, the following results of the head office and the branch were presented to you. So we have an income statement for the head office. We also have an income statement for the branch. So the income statement starts from gross profits. They have other incomes for the year, they have expenses, and then the net profit reported for the year. Now the topic being tested here is advanced aspects of taxation of business income. Advanced aspects of taxation of business income. So under that we have several subtopics. We have taxation of companies, we have taxation of specialized institutions like banks, like contractors, like insurance companies, and all that. So that reminds you to have a look at that topic keenly and be able to answer the questions correctly. So I want us to go through the additional information one by one and be able to understand the effect of each on our computation. So additional information 1 says, goods worth 600,000 shillings were transferred from the head office to the branch at 10% below the normal selling price. First of all, you should understand that a branch of a company is not an independent taxpayer. Now that reminds you about the rules in taxation of groups of companies. Number 1, in case of a group of companies, that is a parent company having subsidiaries and all that, each member of the group is treated by law as a separate and independent taxpayer. So if, for example, A Limited is a subsidiary of B Limited, then A and B are separate taxpayers. But on the other hand, a branch of a company is not an independent taxpayer. It is part and parcel of the head office. So when determining taxable income of such a firm, we do not separate the branch from the head office. So in this case, in fact, the question requires compute the combined adjusted taxable profit or loss of the year for the year ended that. So we have to combine the income statement of the head office together with that of the branch so that we determine the taxable income or loss of the entire firm. So let's go back to additional information 1. Goods worth 600,000 shillings were transferred from the head office to the branch at 10% below the normal selling price. Now, if you look at the income statement, we have a gross profit of the branch at 7 million shillings. Now, what is the effect of this? It means, in short, the head office transferred goods to the branch at a price below the normal price. So in short, the purchases of the branch were underestimated or were undervalued because the branch got these supplies at a price below their normal price. So what is the effect of that? if purchases are undervalued, it means the cost of sales will be undervalued, and so the reported profit will be overvalued. So to correct that, what we shall do is to work out the undervaluation of the purchases of the branch, and then we shall deduct it from the reported profit, so that we correct that profit to get the exact performance of the branch. So we shall do that in the course of our computation. 2, 70% of insurance recovery was in respect of stocks destroyed by fire. The balance was on compensation on capital items. Now, if you look at the income statement keenly, under other items, there's what we call insurance recovery under the head office. The branch has none, but the head office has insurance recovery of 30,000 shillings. And we are told in note 2, 70% of that figure was in respect of stocks destroyed by fire. Then the balance was a compensation for capital items. The rule is here. Insurance compensation for loss of revenue items like inventory is a taxable income. But insurance compensation for loss, or rather for capital items, is not a taxable income. So in this case, what we shall do is short. 70% will be a taxable income, but the remaining 30%, being a compensation on capital items, will not be a taxable item. So that means this income has been overstated by 30%. So what we shall do is to deduct the 30% of 30,000 so that we arrive at the correct taxable income of the firm. 3. Staff salaries include provision for leave accruals equal to a third of the total salaries for the head office and the branch. Staff salaries include provision for leave accruals equal to a third of the total salaries for the head office and the branch. Now, for tax purposes, expenses are classified into two. We have allowable expenses and disallowable expenses. So in this case, there is this expense in the income statement called staff salaries, the first expense in that income statement. For the head office is 240,000, for the branch is 90,000. Now, the statement is a third of this is staff, so provision for staff leave accruals. Now, for tax purposes, staff salaries are allowable expenses, but provisions are not allowable expenses. So what we shall do is, in short, is to separate the staff expenses and the provision for leave accruals, so that we disallow the leave accruals, but we allow for the staff salaries. 4. The interest income recorded in the books of Bay Limited was gross, although Bay Limited received net of withholding tax. The interest income recorded in the books of Bay Limited was gross, although Bay Limited received net of withholding tax. Now, interest income is an investment income. Remember, investment income can be the form of interest income or dividend income. Now, for a company, withholding tax on interest income of 15% is not final tax. So in this case, we are told that the interest income recorded in the income statement were gross, although the company received the net amount, that is net of withholding tax. So what we shall do is simple. The gross amounts are taxable, yes, but when working out the tax liability of the company, we shall deduct the withholding tax on interest already paid by the company to arrive at the correct net tax payable or tax liability of the firm. 5. Bonus shares were from a company where Bay Limited has 30% control. Bonus shares were from a company where Bay Limited has 30% control. So if you look at the income statement keenly again, under other incomes, there is what they are calling bonus shares of 120,000 shillings received by the head office, that is Bay Limited. Now, bonus shares are a form of dividends. You know, there are many forms of dividends that a company can pay. A company can pay cash dividends. A company can do bonus issue of shares. A company can do scrip dividends and all that. Share split and reverse split and all that. Now, in this case, we are told these bonus shares were received by this company from another company where it controls 30%. Now, the rule is for dividend income received by a company from another company in which the receiving company controls 12.5% or more of the voting power of the paying company, then such dividends will not be taxable in the hands of the receiving company. So in this case, Bell Limited is controlling 30% of the paying company. What does that mean? This will be exempt dividends in the books of Bell Limited. So in short, I'm saying the bonus shares received by Bell Limited of 120,000 shillings will not be a taxable income. So we shall treat it so, because it should not be taxed, because it is a form of exempt dividends. 6. Rent, rates and insurance paid for the branch. At the beginning of the year, rent accrued amounting to 24,000, and as at 31st December 2021, rent prepaid was 42,000. These had not been adjusted for in the accounts. Rent, rates and insurance paid for the branch. At the beginning of the year, rent accrued amounted to 24,000. And as at 31st December 2021, that is at the end of the year, rent prepaid was 42,000. These had not been adjusted for in the accounts. Now, if you look at the income statement, there is an expense they are calling rent, rates and insurance paid. Rent, rates and insurance paid. So the amount paid by the head office was 410,000 and for the branch was 110,000. But we are told this did not include the rent accrued at the beginning of the year and the prepaid rent at the end of the year. So what we shall do is simple. We shall adjust the rent rates and insurance account so that we work out the correct amount to be shown in the income statement. We compare that with what is actually recorded in the income statement, and then we shall treat the difference as required. Number 7. The lorry purchased was imported and duty paid was 130,000. This was omitted from the cost of the lorry. The lorry purchased was imported and the duty paid was 130,000. This was omitted from the cost of the lorries. Again, if you look at the income statement, under expenses, there is an item called purchase of a lorry at 3.2 million shillings. Now, purchase of a lorry is a capital expenditure which is disallowable for tax purposes. So we disallow the purchase of the lorry, but we should allow for capital allowance, that is wear and tear allowance. Now, in this case, the purchase price of the lorry, we are told, was 3.2 million shillings, and that excludes import duty of 130,000 shillings. So what we shall do is simple. We shall get the total cost of the lorry, that is the purchase price plus the import duty. Now, for purposes of computing investment allowances, input duty paid on imported machinery is capitalized. That is, it is added to the purchase price so that we get the qualifying cost for purposes of the investment allowance. So what we shall do is simple. Add the 130,000 shillings to the 3.2 million. Use the sum to work out the investment allowance, which should be allowable instead of the purchase price of the lorry. 8. Retrenchment costs analysis. Retrenchment costs. Now, if you look at the income statement again, there is what they are calling retrenchment costs. For the head office, 2.5 million. For the branch, 1.3 million. But we have a breakdown here. Number 1, we have provision for staff gratuity. Now, for tax purposes, provisions are not allowable expenses. So here we are told provision for staff gratuity for the head office 800,000, then pension payments 1.7 million. Now, what we shall do is to disallow the provision for the staff gratuity, then we allow the difference. So for the head office, we shall only allow 1.7 million out of the 2.5. For the branch, we shall allow 800,000 out of the 1.3 million shillings. 9 is about loss of stock. Fire razed down a warehouse where goods are stored before they are transported to the head office and branch. VAT at 16% was included in the stocks destroyed by fire. So if you look at the income statement again, there is what they are calling loss of stock for the head office at 200,000 and for the branch at 500,000. So we are told this included VAT at 16%. Now we know VAT is not an expense for a farm. VAT is a tax, and taxes are not allowable expenses for a farm. So what we shall do is simple. Work out the VAT part of these figures, then we shall disallow the VAT parts because they are not expenses to the farm. And lastly, 20% of loan interest relates to a loan obtained to finance purchase of shares. 20% of loan interest relates to a loan obtained to finance purchase of shares. Now, interest on loan to purchase shares are not, or rather is not an allowable item for tax purposes. So what we shall do to disallow the 20% of the interest expense from the income statement is so loan interest is 360,000, so we shall disallow 20% of that. Good, and allow 80%. Required 1. Compute the combined adjusted taxable profit or loss for the year ended 31st December 2021. And 2. Compute the tax payable or refundable for the year ended 31st December 2021 based on your results in A1 above. Now, in this case, we have an income statement already prepared for both the branch and the head office. So it means we are able to use the net profit approach to work out the adjusted taxable income. So we present it like this. The company is called Bell Limited. So we say we are answering question 2A. So we say Bell Limited, taxable income computation. For the year ended 31st December 2021. So we have the head office, we have the branch, then we have total. Show currency, and we can carry 3 zeros to ease in our work. Good. So because we are using the net profit approach, we start with the reported net profit. So we say reported net profit for the head office is 2,310,000. We are carrying 3 zeros, so we write 2310. This is 4027. We can get the sum of that. So that is 2310 plus 4027. I'm getting 6337. Then we adjust this reported profits by 1, adding back. So we say add back. Now here we should add back 3 sets of items. Number 1, we should add back disallowable expenses which have been deducted according to the statement provided. So we go through the additional information and identify them from there. 1, we have note 2. Sorry, no. We have provision for loan for leave accruals. That is note 3. Provision for leave accruals. Provision for leave accruals. So note 3 says staff salaries include provision for leave accruals equal to a third. So we get a third of each of the figures. So staff salaries is the first expense in the income statement. Head office is 240, so we get a third of 240. 240 divided by 3, I'm getting 80. For the branch is 90, a third of 90 is 30, that is 110 in total. Number 2, we have the rent rates and insurance. Rent rates and insurance. Rent rates and insurance. We need to run a working for this because of note 6. So we need to run a small working one. I'm doing it here. We are running rent rates and insurance account. Rates and insurance account. So I'm starting with the head office. So we go to note 6 of the question. It says rent rates and insurance paid for the branch. So this is for the branch. It is particularly for the branch. Sorry, not the head office. The head office is not affected. It is for the branch. So we are told rent accrued amounted to 24,000 at the beginning of the year. Rent accrued is a liability, so we credit that. So we say balance brought down 24. Then as at the end of the year, rent prepaid was 42. Prepaid rent is an asset, and at the end of the year we should credit it. So we say here balance carried down 42. Then if you look at the income statement, rent paid, rent, rates and insurance paid for the branch was 110, which we should debit. So we say bank 110. We balance off the account. This is 110. 110. We work out the balancing figure. That is 110 minus 42 minus 24. 44. So the correct figure to be shown in the income statement is 24. This is what should go to the income statement. But what do we have in the income statement? In the income statement we have 110, to mean that the expense shown in the income statement for rent, rates and insurance is overstated. So to correct that, we should add it back. We should add back the difference. So we do 110 minus 44 is 66. We should show that here because it was an overpayment for rent, rates and insurance. 3, we have loan interest to finance purchase of shares. Loan interest to finance purchase of shares. Talking of note 10. So loan interest in the income statement is 360,000. So we get 20% of 360,000, and that is 72. So we disallow that. We add it back. Next we have note 8. We have note 9, which is about VAT on stock destroyed by fire. VAT on stock destroyed by fire. So if you look at the income statement, loss of stock was 200,000 for the head office and 500 for the branch. So this includes VAT. So what we do is simple. We exclude the VAT component, that is 16 out of 116 of 200,000. I'm getting 27.59 for the head office. And then we are told fire raised down that where goods are stored before they are transported to the head office and branch. Then for the branch, it will be 16 out of 116 times 500,000. I'm getting 68.97. We get the sum of the two, 27.59 plus 68.97. I get 96.56. Note 8 is about retrenchment cost analysis. That includes provision for staff gratuity, which is disallowable. So we write here provision for staff gratuity. For the head office is 800, for the branch 500, a total of 1.3 million. We have note 7. Note 7 is about purchase of the lorry that cost 3.2 million. Then the duty paid was 130, which is exceeded. But purchase of lorry, we know, is a capital expenditure. We should disallow that, but we shall allow for capital allowance. Purchase of lorry, it is 3.2 million for the head office, which is a disallowable expense. We have retrenchment costs. We go back to the income statement and identify any other disallowable expenses. So we move through the income statement, be very keen, and identify the items. So one, we have staff salaries, which we have dealt with in part 1. We have maintenance expenses, those should be allowable. Preliminary expenses are allowable. Retrenchment costs, we have the analysis which we have taken care of. Rent rates and insurance paid, we have dealt with. We have goodwill written off, that is not an allowable item. So we write here goodwill written off. Goodwill written off is 20,000 for the head office. We have legal and accountancy fee allowable. Depreciation is a disallowable item for tax purposes. We add it back. Depreciation is 180 for the head office, 70 for the branch, 250 in total. Interest on overdue tax is disallowable because it's relating to a tax offense. Interest on overdue tax. 80 for the head office, nil for the branch, 8 in total. We have subscriptions to golf club for directors. Subscriptions to clubs for business purposes are allowable, so we don't have to add it back. We have donations. Now donations can be allowable or disallowable depending on whether they meet the conditions, the required conditions or not. So here we just have donations. We are not told whether this met the conditions or not. So we can go either way. One, we can assume that the donations met the required conditions so that they're allowable. And if they're allowable, we do not add them back at this point. Two, we can also assume that they did not meet the required conditions so that they are disallowable. In that case, we shall have to add them back. So we can make a note and an assumption. So under notes and assumptions, we can write, if we assume, let's assume these donations met the conditions. So we can write under notes and assumptions, one, that donations are assumed to have met the conditions, the required conditions, hence allowable. I repeat, the donations are assumed to have met all the required conditions, hence are allowable. By the way, we should also know those conditions. The conditions are only 4. Number 1, the donations must strictly be in the form of cash. Number 2, the recipient must acknowledge receipt of the donations. Number 3, the recipient must be an institution exempted from tax. That means they should have a tax exempt certificate. And then number 4 is that the donations, the donor must not receive any consideration for the donation. In other words, there must be no consideration for the donation, to mean the donor must not receive anything in exchange for the donation. So if all those conditions are met, then donations are allowable for tax purposes. If not all of them are met, then such donations will not be allowable for tax purposes. So in our case, we are assuming that the donations met all the required conditions, and so they are allowable. So in that case, we don't add them back here. Okay, we continue. Next, we have general administrative expenses. Administrative expenses are allowable for tax purposes, so we don't add them back. We are using the gross net profit approach. Purchase of a lorry is already here as a disallowable expense, but we shall allow for investment allowance. Loss of stock is an allowable expense, but we have the VAT component, which we have added back as a disallowable item. Loan interest we have taken care of in note 10. Yes, note 10. Directors' remuneration is allowable. For a company, directors' remuneration is an allowable expense. Then lastly, we have pension contributions, which should be allowable expense for tax purposes. So up to there, we can now get total disallowable expenses. But in other questions, you could meet other items that need to be added back. So I said at this point, we add back 3 sets of items. Number 1, disallowable expenses which have been deducted according to the statement provided. Number 2, we should add back any taxable items or incomes which have not been taxed according to the statement provided. Then 3, we should also add back any items understating the reported performance of the firm. In our case, we do not have the last 2 sets. So this is all we have to add back. So let's do it keenly and get the correct figure. So I'm on the head office, 2310, 80, 72, 27.59, 800, 3200, 20, 180, and 80. I'm getting 69.59. I move to the branch, 4027, 4027, 30, 66, 68.97, 500, and lastly 70. And that should give me 61.97. We get the sum of the two, 69.59. I get 11,531.56. That is the first step. The second step is to analyze the deductions. So I'm continuing from here. We have the head office. We have the branch, and then total continuation. So here we say less. What do we deduct? We deduct 3 sets of items again. Number 1, we deduct any non-taxable incomes which have been taxed according to the statement provided. 2, we should also deduct any items overstating the reported profits. And then number 3, we should deduct any items that any allowable items or expenses which have not been deducted. So I want us to pick it from there. Number 1, we should have investment allowance on capital expenses. Investment allowance. I want to run a small working too. Now, if you look at the income statement, there was purchase of a lorry. There was a lorry purchased at 3.2 million, which has been shown as an expense. So we disallowed that, remember, under disallowable expenses. And then we have note 7, which says that 3.2 million does not include 130,000 that was import duty paid on the lorry that was imported. So we disallow the cost, but we should allow for investment allowance. So I'm working it here. So investment allowance. So investment allowance on the lorry, that is. So a lorry is a vehicle. Vehicles qualify for investment allowance at the rate of 25% currently. So we shall have 25% of the purchase price, that is 3.2 million, plus the import duty, that is 25% of 3200 plus 130 should be 3330 times 25% gives me 832.5. So we should allow this. This is what we bring here, 832.5. The sum is still the same figure. Good. Other items to be deducted in the income statement, they are showing bonus shares as an income, and we discussed and agreed that is an exempt dividend which should not be taxed on this company. So we write here bonus shares. Bonus shares. You pick it from the income statement at 120. 120. Next we have insurance recovery. Insurance recovery. On note 2. 70% of insurance recovery was in respect of stocks destroyed by fire. The balance was on compensation for capital items. So the balance is 30%. So we get 30% of 30,000. 30% of 30,000 should be 9,000. So we write here 9. Next we have understatement of purchases for the branch. Understatement of purchases for the branch. In note 1, we are told goods worth 600,000 were transferred from the head office to the branch at 10% below the normal price. So we argue like this. 600,000 in this case represents 90%. So then what is the 10%? We can run it as a small working 3. Working 3, I'm doing it here. Understatement of purchases. So that will be 10 over 90 times 600,000. We work it out. 10 over 90 times 600. I'm getting 66.67. 66.67. Okay. I move to the income statement again. Under the list of incomes, we have what they are calling gain on sale of land and buildings. Now that is a capital gain which is taxed at a specified rate of 5%. Remember the the capital gains tax rate is 5%. So that cannot be taxed at the corporation tax rate. So we write here gain on sale of land and buildings at how much? 600 for the branch. Next we have gain on shares sold. Gain on shares sold. 30 for the head office, nil, that is 30. And interest income, we were told in note 4 that they have been stated at gross, though the company received them net of withholding tax. So those are taxable as they are, so we don't deduct them at this point. And up to there, we have analyzed all the incomes, so we can now get the adjusted taxable income. Adjusted taxable income. So we start with the head office. So the adjusted taxable income will be the reported net profit plus the additions less the deductions. So we start like this: 69.59 less 832.5 less 129 and 30. That gives me 5778.09. For the branch is 4761.97 less 66.67 and 600, giving me 4095.3. The sum of this must also be equal to the vertical sum. So we do plus 5778.09. It should be 9,873.39. We can confirm that this way. We do 11,531.56 less 832.5, 129, 66.67, and then 630. I get 9873.39. Good. So that answers part A, Roman 1, the determination of taxable income. Part 2 is asking for tax liability. We can do it like this: tax liability. Now this is a company. Companies pay taxes at the prevailing corporation tax rate. So we shall say gross tax liability is equal to 30% of the adjusted taxable income. That is 9873,390. I'm now bringing in the 3 zeros we had carried. So we have 30% of 9873,390. I'm getting 2,962,017. But remember, we were told in note 4 that the company received the interest income from the finance companies, institutions, net or withholding tax. So withholding tax is already paid on the interest income. So we should bring here, say less withholding tax on interest income. So we go back to the income statement. There were 2 interest incomes. One was from Lex Bank. So we say Lex Bank. Withholding tax rate on interest income is 15%. So we do 15% of the gross amount. We are told the stated figures here were gross or withholding tax. So this is 180,000. We do it together. We shall have 15% of 180,000, which is 27,000. We deduct that. 2, we have the interest income from Beta Microfinance. So we write here Beta Microfinance. That is 15% of the amount there is 200,000. We do that. 15% of 200,000, I'm getting 30,000. Good. And that is the last one. So the difference between that should give us net tax liability. So we do it like this. We shall have the gross tax liability less the withholding taxes. So 29,62,017 minus 27,000 minus 30,000. I get, just a minute, 29,62,017 minus 27,000 minus 30,000. I get 2,905,017, and that becomes the firm's net tax liability for the year 2021. Okay, that is question 2A, computation on taxation of business income. We can now move to question 2B1, 2B Roman 1. It says, a tax agent is an important stakeholder in the alternative dispute resolution ADR process. A tax agent is an important stakeholder in the alternative dispute resolution ADR process. Analyze the roles of a tax agent in relation to the ADR process. So there are two key important terms we should understand here. One is tax agent. A tax agent is simply a person licensed and authorized to handle the tax matters of a taxpayer. And remember, a tax agent could be an individual person or a partnership. So in short, I'm saying a tax agent is simply a person licensed and authorized to handle tax matters of a taxpayer. The other key term here is ADR, alternative dispute resolution. And now ADR is simply a dispute resolution mechanism outside the normal court processes, outside the normal judicial system. Basically that. So we are asked to analyze the roles of a tax agent in relation to the ADR process. Now, they are numerous. I'll explain the required number. Now, we can say the following are the roles of a tax agent in relation to the ADR process. The following are the roles of a tax agent in relation to the ADR process. Number one is to apply for the ADR in consultation with the taxpayer. Now, if a taxpayer has an issue which they wish to have resolved through the ADR process, then they have to apply for that hearing. And so this can be done by the tax agent on behalf of the taxpayer. So in relation to the ADR process, number one, a tax agent can apply for the ADR process in consultation with the taxpayer that they are representing. Number two is to attend the ADR meetings on behalf of the taxpayer. Now, one of the requirements in the ADR process is that the taxpayer must be present either in person or through their agents. And so, where a taxpayer is an agent, then such an agent may attend the ADR processes on behalf of the taxpayer. Three is to prepare and submit all documents required during the ADR process in consultation with the taxpayer. In an ADR process, it may be a requirement that certain documents be presented before the ADR proceedings, normally chaired by a facilitator. So in that case, to argue for and on behalf of the taxpayer, the tax agent has to prepare and submit such documents to the ADR proceedings on behalf of the taxpayer. Number four is responsible for performing any duty or obligation imposed by the tax law on the taxpayer, including submission of returns and payment of taxes required during, or rather required or resolved to be paid by such a taxpayer during the ADR process. In short, I'm saying this tax agent has the responsibility of performing any duty that the tax law imposes on the taxpayer, such as payment of taxes and required penalties as resolved by the ADR proceedings. And we can add more, advise the taxpayer on the ADR processes to ensure adherence to compliance, to the guidelines and timelines set by the ADR agreements. So in ADR processes, there will be agreements on how to go through the ADR process. So there will be guidelines and timelines set to hear the case. So in that case, the agent will advise the taxpayer on the ADR rules and processes so that the taxpayer adheres to the guidelines and timelines as agreed through the ADR proceedings. So those are some of the roles of a tax agent in relation to the ADR process. Key things to pick from there: number one, know everything about a tax agent. Know who a tax agent is, obligations of a tax agent, know about qualifications of a tax agent, know about the licensing of a tax agent, and the roles of a tax agent in various tax issues, such as and including ADR. Lastly, part B of question 2 says, explain the circumstances under which the commissioner may cancel the license of a tax agent. Still touching on a tax agent, explain the circumstances under which the commissioner may cancel the license of a tax agent. Now, a tax agent must be licensed by the commissioner before they can serve a taxpayer as their agent. For a tax agent to be licensed, number one, they must apply for that particular application. Number two, they must receive a recommendation from what we call tax agent committee, and so on and so forth. So a tax agent can never practice until they are licensed to do so by the commissioner. Now, this license issued to a tax agent may be cancelled in certain circumstances, and that is now what the question is. So we have to explain the circumstances under which the commissioner may cancel the license already issued to a tax agent. There are many reasons, the circumstances under which this may happen. Number one is where, sorry, we can introduce that just to be organized. We can say the commissioner may cancel the license of a tax agent under the following circumstances. The commissioner may cancel the license of a tax agent under the following circumstances. Then you can go ahead and explain those circumstances. One is where the tax agent assists the taxpayer to evade taxes. Now we know tax evasion is a criminal tax offense, and if you are found guilty of tax evasion, and if a tax agent assists a taxpayer to evade taxes, then the tax authority may punish that tax agent through cancellation of their practicing certificate or license. Two is where the tax agent fails to notify, where the tax agent fails to notify the commissioner as required under Section 22(1) of Income Tax Procedures Act. So Section 22(1) requires the tax agent to notify, rather to inform the commissioner of certain issues affecting the taxpayer in relation to taxes they should pay. So where the tax agent fails to do that notification, or to give that notification to the tax authority, then their punishment could include cancellation of their license. Another one is failure to pay all prescribed fees during application and renewal of practicing license. Now, this license issued to a tax agent must be renewed after a given period of time. So where a tax agent fails to renew or even to pay the relevant fees prescribed for this, then the commissioner may cancel their license. Another one could be cessation to carry on the business of a tax agent and fail to notify the commissioner within the required time. Now, if you are licensed to serve a taxpayer as their tax agent, then you cease to do that business, you cease to offer that service, and you do not notify the commissioner about that cessation, then that is an offense under tax law. And so one of the punishment you may receive from the commissioner is the withdrawal or the cancellation of that license. Another one is where the tax agent takes advantage of the taxpayer's lack of technical knowledge about tax law. Now, in taxation, we have what we call ethical guidelines for tax practitioners, where a tax agent is a member. Now, some tax practitioners may really take advantage of the ignorance of the taxpayers and, loot their resources or, get undue benefits from them for themselves from such a taxpayer. Now, where it is determined by the commissioner that a tax agent has taken advantage of the ignorance or lack of technical knowledge of the taxpayer, then the commissioner may withdraw or cancel the license of such a tax agent. And lastly, is recommendation, where there is a recommendation to cancel such a tax agent's license by the tax agent committee. We said that for tax agent to be licensed, they must receive a recommendation from the tax agent committee. So where there is a recommendation from the same committee to withdraw such a license already issued, then the commissioner will not have no otherwise but to withdraw or cancel such a tax agent's practicing license. So all those are possible circumstances under which the commissioner may cancel the license of a tax agent. Good. That is question 2B, and that is the end of question 2. So that is the end of the paper. It was quite a detailed paper with a lot of deep questions, both theory and computation. That reminds you to take your time, be sure you can go through each topic keenly so that you get every single detail of each concept. If you look at the paper keenly, number one, you realize that there were 2 questions touching on taxation, advanced aspects of taxation of business income. One, we have question 2, which is about taxation of companies, advanced aspects of taxation of companies. Then we had question 4, which is about taxation of insurance companies. So in a typical advanced taxation paper, you expect that. The only thing is you may not know which part will be tested when. So be keen to do that topic keenly and be able to answer such questions. It is a must you'll have 2 or more questions on the topic of advanced aspects of taxation of business income. Another very common computation today is VAT. So make sure you understand VAT, both the theory and mathematical part. You remember we had a good question on VAT computation. It was majorly testing the concept of tax point in VAT computation. So we had both a theory and a computation question. Take your time to do that. Question 5 was a question testing a bit of theory and a computation on preparation of capital statements. Almost a must in the exam. The topic of tax investigations will hardly miss in any paper. So again, take your time and go through that keenly. Then lastly, the topic had a lot of questions on taxation of cross-border activities. So almost a must in the exam again. Take your time, know the concepts in that topic, know how to compute what we call double taxation relief, that is under double taxation treaty, understand the concept of transfer pricing, tax havens, and all that. So that was the paper, and you can continue doing the questions and other relevant questions so that you get more insight into them. Have a good day.
Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Lingwiri, and today, ladies and gentlemen, we are discussing about the Business and Data Analytics August 2023 paper. The question of focus today is question 22. It reads as follows. Riziki Limited is considering a project with the following details. Initial cost 40 million, residual value 2.5 million, selling price per unit is 1.1, variable cost per unit 500, I meant 1,100, pardon me. Then variable cost per unit is 500, fixed cost per year is 5 million. Additional information, annual number of units sold is 30,000. The project has a useful life of 5 years. The company uses a weighted average cost of capital or WACC of 12%. Required, A, compute the base net present value. B, carry out a sensitivity analysis of NPV assuming adverse variance of 5% for all inputs except project life and weighted average cost of capital. C, prepare an appropriate chart to indicate the different NPVs for each scenario in B above. Note, adverse variances in this case means a decrease in cash inflows or an increase in cash outflows. So what we're going to do, ladies and gentlemen, you can see towards the right of the screen over here that we've developed inputs: the initial cost, the residual value, the selling price, the variable cost per unit, and the fixed cost per year, and the project life there. So what we're going to do then, we're going to now identify the inputs or the major inputs towards the right. Like for example, what I mean is this. We are going to now talk about the base. Here we are going to talk about the base case, input based on the input, so base. That. And then towards the right, we are going to include a 5% initial cost or positive value of 5% initial cost. So we are going to have plus 5% initial cost like that, and then we will now then have the adverse scenario where we have negative 5% annual unit sales. So negative, I'm going to do like that, negative 5% annual unit sales. So with that, we proceed on to get or to also identify now the 5% selling price. So negative 5% selling price. Then we continue building on the model itself. Right here we have variable cost. Now increase in variable cost, 5% variable, 5%. I'll explain variable cost, and then we're just following these components right over here. So we began with the initial cost, then we went to the annual unit sales, then the selling price, then you're going to the variable cost over here, or 5% a variable cost, and then residual value there. So negative 5%, negative 5%, 5% residual fixed cost. I think I forgot fixed cost. So positive 5%. Apologies for that. Positive 5%. 5% fixed cost. And then we're talking about residual value right here. Residual value. %, residual value. That. So with that, we are saying that we are told to compute the NPV. So the inputs, then we just follow the inputs based on whatever we've been given. So the residual value right over here, we can come to the initial cost. You can see the initial cost is 40 million over here. So it's 40 million. We're just doing the base case scenario over here. So what I can do, I can put this perhaps on that side like that. So that now, and maybe perhaps I can, with your permission, I can just compress it a bit over here like that so that you can be able to fill out this part. So the initial cost right here, you can see is 40 million like that. So 40 million. And we come down there. So we want the comma format, guys. The comma format. So we highlight everything, put a comma, then just like that. So here the initial cost plus that value there. Then we have the residual value are going down. The residual value is given to us over there. That value there. Because we talk about the base case. And then the annual unit sales. The annual unit sales you can see is right here. Additional information number 1. So 30,000. So just put plus 30,000. Because this is in words, it's not separated from the words. So it's in figures combined with the words. So just put 30,000 there. We have the selling price per unit given to us. The selling price per unit, you can see, is given to us on the right here. So enter that. The variable cost per unit as well, given to us there. Enter. Then the fixed costs per year have also been given to us there. So plus. Enter there. The project life in years, we have been told in note number 2 that the project has a useful life of 5 years. So we just indicate here 5. That. So what happens then when we have an increase on initial cost? So the increase in initial cost will be, we can put 5% over here because we're saying it's going to be 5% increase over here. So you put just 5%, and we increase. So this will all require this to have a percentage. So allow me to do this. To do the following, to put this as percentage over here, comma format here. That. So don't worry about this. These are just the marks that are being allocated towards the entire question. So you can see it's 30 marks over here. So with the permission, then I can just do away with that, or rather I can just put them beside the questions over there. However, I can just do away with them for now. So with 5% increase, we just come over here plus that value times a factor of 1 plus, we're increasing it by 5%. That's what it gives us. 42 million. With 42 million, we are saying the residual value remains as the way it is over here, because we're saying that the residual value will remain as 2.5 million all through, whether there's going to be an adverse effect or so on and so forth like that. So here is 2.2 million like that. We proceed on, and even the number of units, this will be the same. The annual unit sales will be the same, 30,000. Here we are saying it's going to be 1100 like that. So I can just copy these values as the way they are towards the right there with your permission. Because we are saying that the initial cost is the one that is only increasing. So here is a copy, paste special values. Let's say okay, that. So if that's the case, what happens when we have a decrease in unit sales? 5% decrease in unit sales, because we're seeing from the question right here that carry out a sensitivity analysis for the NPV assuming adverse variance of 5% for all the inputs except the project life and weighted average cost of capital there. So we are saying that now we want to put adverse effects over here. So we are going to have negative 5% like that. You can see it's even indicated to us over here. So here we are saying is going to come back now back to this, because we're saying we increased it from this to this based on the 5%, but now it's going to come down. And so I'll increase now each of these items moving towards the right there. The annual unit sales, the selling price, the variable cost, and so on and so forth. So that now right down over here we can now do the workings effectively. So you can say plus that value times 1 plus it should be because you're decreasing this value over here 1 no so this is the formula, it's plus that value. We're decreasing it by 5%, so it should be delete plus this value, and then we're multiplying it by, open the brackets, 1, decreasing it means, so it's going to be we're subtracting it from 0.05, so 1 minus 0.05, that. It shouldn't give us 1 minus 0. We talk about 5% adverse effect, because we're saying from here, if we increase this one by 5%, so then decreasing it should be able to give us it should be able to give us take us back to where we actually were before, were there. So it should be just 40 million, that. And with 40 million, then we are saying that we can move ahead and say that variable cost is going to now also selling price in the variable cost is going to decrease over here. So we put negative 5% in terms of selling price, sorry. So negative 5%. So we put that, and it remains the same. Over here I'll explain that. If you're talking about the variable cost itself, also it also remains the same like that. So it's going to remain including the residual value like that. But what we're saying is that here we will need then to put 5%, because we're saying it's 5% variable cost, 5%, then negative 5%. Because it's positive there. So we are saying what? That in terms of the initial cost, if it's going to increase, it's going to increase by 5%. If the unit sales decrease by 5%, then it's from this increase, it's supposed to decrease to 40 million back again. Then what about the residual value? The residual value should remain the same, with the exception of the very final residual value down over here. So it should remain the same here. So we just maintain it like so up to there. But you're saying that the very final one over here is going to, this residual value is going to be plus that value times, open the brackets, 1 plus should be that value there. The residual value represents an inflow of money when you sell the asset. So we are saying that at this point over here, the residual value, a 5% decrease in residual value will cause it to be over there. That. So that's what we have. We proceed on to discuss the next item, talk about the annual unit sales. The annual unit sales will affect what? Will affect this component right over here, this column over here, the annual unit sales. So here we are saying it's going to decrease, so plus that one times, open the brackets, 1 plus that 5%, negative 5%, 28,500. But the rest remain the way they are. These other values remain the way they are. So 30,000. So plus sorry, pardon me for that. So it should remain 30,000. That should remain the same. Control R. It's only the unit sales. Why? Because you're saying that the unit sales are the ones which are being affected. The sales, we're dealing with unit sales. So this annual unit sales component should actually change. Next item is the selling price per unit. So what would change? So selling price per unit, this is what is going to change. That part there is going to change, pardon me, that one is the one that's going to change. So here we are saying it remains at 1100. So here we are saying it's just going to be that, because it has already changed. This one remains the same, but the selling price changes based on that component there. So we are saying the selling price is going to be plus that one times, open the brackets, 1 plus selling price comes to 1045, but the rest remain the way they are. How about the variable cost per unit? Variable cost per unit remains the same with the exception of the variable cost component. So here we expect it to remain the same. So we drag it up to there. But that value times, open the brackets, 1 plus the variable cost is increasing. 525, then the others remain the way they are. The fixed cost per year. The fixed cost per year, we are saying is going to be 5 million with the exception of the fixed cost component. Or just put it like so, up to there, Control R. So this one is just going to change plus that value times, open the brackets, 1 plus that value, then we enter. Then we remain with enter. We will have it like that. How about the project years? The project years remain the same. We've been told it's 5 years, so it goes without saying that it's going to remain 5 years. Just leave it like that. And with that, now those are the inputs that we've worked out. We now want to proceed to work out the solution. So the unit sales, we start by identifying the unit sales over here. Unit sales, over here we have, and of course here we have the base case given to us there. This one should be slightly above here because we do not fill in. So base case. That. Then here we are saying we're going to now put in the figures. The unit sales, 30,000. So we have them there. And then we copy these components towards the right here. Copy. Towards just the right here. Database, just the same way. Then we have the initial cost is going to be how much? We're just going to copy and pick it from there. So the initial cost in terms of the unit sales is just going to be the same. You can see that because we're talking about the initial cost here. So when you're talking about the initial cost, we're just going to copy it like that. So enter. So the initial cost, we just pick it over there, just from above over here, because the initial cost is going to be an increase. So then the annual unit sold. So we just then autofill, Control R, with the exception of this one, where we're saying the annual unit sales changes over here. Remember how we did it over here? Is what we're saying actually changes there. The next component is the selling price. Selling price. So we move like so. Selling price. Price. And the selling price or SP is given as plus that value. Enter it like that. Remember where it changes. It changes at the point where we have the selling price component there. So if it picks from above there, so just put it like so. You can see the selling price changes at that point here. Next component, next item is the total sales. Total sales. And you're saying the total sales is going to be given as we multiply you're just going to pick the values here given to us over here, total sales plus, from the question, just to clarify over here, one second, I get it. It's just going to be this value of here selling price times that value. That's what we're getting. Sorry. And once we have that, we proceed on to identify the next component there. And with that, we're saying we'll just be able to just pick the values, dragging them over here. Sorry, I was just having a bit of a small hitch. Sorry for that. So Control R. And you can see what happens there. We just pick the selling price and then we multiply with the unit sales. So what happens then now with the next component? So those are total sales. Once we have the total sales, we pick the variable cost per unit. Variable cost per unit. Sorry. Per unit. And the variable cost per unit given to us there is just going to be 500. You can clearly see it, it's just given to us over here, 500. So we just pick it. Remember, we're just picking the values the way they are over in the base case. Enter. And you remember the variable cost component changed at this point. You remember it changed at this point here where the variable cost was actually increasing at 5%. So it changed to 525. So we just move towards the right and then Control R. How about the total variable cost? So here, with the permission, I'll just move this a bit towards the right. Over here, I can say variable cost, total variable cost. Total variable cost. And the total variable cost will be given as variable cost in terms of shillings times the units. Put towards the right, Control R, and it picks. Once we have the total variable cost, we can be able to pick now the sales in terms of the variable costs, the sales variable costs, so sales. Variable cost. Sales variable cost. And we can see that it is just going to be the total sales and then we add the total variable cost. That's what we are going to do. So it's going to be the sales, which is there. Then we add that value. But there's one thing. The variable cost is a cost. Please note. So what we're supposed to do is that we're supposed to put this in form of a negative sign there. So apologies for that. Put a negative. Put it like that. Then I move it towards the right there. So that now we can be able to indicate or be to show that it is actually indeed a cost. And so you can see the sales variable cost actually changes there. So now what is left is for me now to just drag it like so. Please note one thing, that the unit sales were given to us there. The selling price was also given to us there. the total sales is just the unit selling price times the unit sales. The variable cost per unit, we had already computed it right above over here, and we say that this variable cost component over here is going to change by an increase of 5% increase variable cost. The sales variable cost right over here is just given to us as the total sales minus variable cost. So the sales less variable cost gives us this value here. How about the fixed costs? The fixed cost is given to us there as follows. 5 million. It's right here. So we enter, and because we're saying it's a cost itself, so let's put a negative sign there to show that it's a cost. Then we move towards the right like that. Remember, the component of fixed cost over here changed, 5,250,000. So we're putting it a negative over here just to indicate that it's a cost. And with that, we can be able to then identify the cash flows. Cash flows. So the cash flows we have over here are just going to be 18 million, and then we subtract 5 million. Or we add. Why I'm adding is because we need to, is because we're going to subtract. Please note. So we're going to add. If I subtract, it's going to be 18 minus minus, which comes to plus. So you should be able to just add it right there. So get 13,000. 13 million, pardon me. So 13 million. Control R. Move towards the right. And those are the cash flows. But remember one thing, that there was a residual value over here that we didn't factor in. So we just put it in there. So the residual value year 5, so you can put it year 5, is a cash inflow. So how much? We pick those residual values from up above here, please. There. Then, because there's a change in residual value over here of 2.375, we need to factor that in. So Control R, but we do not subtract it. It's a cash inflow. So then we are going to, or we'll need then to get the present value interest factor. So down over here we'll have PVIF, present value interest factor, year 1, times cash flow. Times cash flow. Which cash flow? These ones here. So we'll do the same, PVIF year 2 times cash flow up to year 5. So year 1, year 2, so I'll just change this. It's going to be easier to change that. Year 3, year 4, then year 5. Cash flow there. And how do we get the present value interest factor? We're just getting the present value interest factor. Could put the interest rate right above over here. So interest rate, it's at 12%, all through 12%. So here we put that, and we 12%. So it's going to be plus the cash flow and then we are discounting it against open the brackets 1 plus that value, close the brackets, power 1 times, not times the cash flow, it's already been multiplied like that, so we enter. So once we have that, we shift Control R, that is year 1. Notice that I've done over here, you can see even the formula is power 1. So here I'll do power 2, power 3, power 4, and so on and so forth like that. So because I want the cash flow, so it's going to be plus that value over 1 plus that one, power 2, that. Then you do the same thing. One plus R power 3 like that. So here is going to be this power 3. Yes, power 3. So power 4. Sorry, I was just having some trouble with the mouse. Sorry. So plus the cash flow over, open the brackets, 1 plus power 4, that. Then finally we have power 5, but we will also need to work out the residual value right here. So the residual value, then the cash flow is going to be plus that value over 1 plus power 5. Enter. Control R. Then we have what is called the residual value. So you can see